Hello everyone, welcome to JAIIB CIB Prep. In today's video, we'll start Module B. We'll start with unit number 22, Principles of Lending, different types of borrowers and types of credit facilities. So in this particular unit, we'll understand about different principles of lending, different types of borrowers like individual, companies, LLPs, partnership, proprietorship, and different types of credit facility, fund-based, non-fund-based, and other credit facilities. So let's start today's video. So one of the main jobs of a bank is to give money. This is called lending. When a bank lends money, it cannot do it blindly. The bank must follow certain safe and tested principles so that the money is recovered on time and without loss. And a banker must also know the rules and laws that apply to different type of borrowers, the needs of a customer so they can give the right type of loan, and the different credit facilities available and how the legal relationship works in each of them. We'll start with principles of lending. Lending money has risk, especially because bank mostly lends using depositors' money and not their own. And to reduce risk, bankers follow some key principles. Number one being safety. The most important rule that the loan should be safe and the money must come back. The bank is a trustee of public money and it uses deposits collected from people and lend it to borrowers. So repayment depends on borrower's capacity to pay, borrower's willingness to pay, and whether the loan is used for something that generates income to repay. Second being liquidity. So loan must be repayable on time so that the bank can meet withdrawals by depositors. Banks prefer short-term loans or loans for working capital so the money is not blocked for too long. If the borrower fails to pay, the bank should be able to sell the security easily. This is why assets with good resale values are preferred. Number third is profitability. So banks are businesses. They need to make profit and pay salaries, cover costs, and give returns to the shareholders. And usually the bank earns by charging 3 to 4% more interest on loan that it pays on deposits. Now, loan pricing depends on type of loan, whether it is a housing loan, personal loan, business loan, what is the credit rating of borrower, and how much risk is involved. Higher the risk, higher the interest the bank will charge. And sometimes the bank may accept a low profit on one service if the same customer is profitable in other service. This is called customer profitability analysis. For example, a big company may get a loan at low interest but pay high fees for foreign exchange service. Overall, still profitable for the bank. Purpose, bank lend only for productive and legal purpose. So no speculative purpose, no banned purpose are allowed, no money for gambling and no money for speculative activities. So example of productive purpose involved buying machines, education loan, housing loan, and by speculative and banned purposes, we mean financing illegal trade, high risk gambling, betting. So this is not allowed. Diversification of risk. So the bank should not put all its eggs in one basket. If it lend too much to one industry, area, or borrower, a single bad event could cause a heavy loss. So risk can come from business cycle, political unrest in area, natural disasters, global crisis. So bank don't put too much money into one industry, one area, one person, so on and so forth. Bank diversify its risk. Security. So security is an asset given to the bank as a backup in case the borrower cannot repay. It can be land, building, gold, shares, bonds, or even personal guarantee. However, security should not be seen as a last resort. The main focus is still be the borrower's ability to repay. If a borrower defaults on a car loan, the bank can sell the car to recover the loan. So it is like a cushion. Seven C's of credit. So they are character, honesty, and track record. Capacity, it's the ability to repay. Capital, it is own money is invested in the project. Then collateral is the asset which is placed. Conditions, the economic and industry factors. Cash flow is regular income and credit worthiness is past borrowers borrowings history. Now we have different types of borrowers. Let's understand them one by one. We start with individual, then we'll go proprietorship, partnership, company, HUF, so on and so forth, and we'll cover all types of borrowers. So bank lend to individuals for personal or business purposes, for personal and business purposes, but the person must be competent to contract under Indian Contract Act of 1872. Now we have minor. Minor are basically person below 18 years of age. So they cannot enter into a contract, and a loan to a minor is void. So bank cannot recover the money. Hence, bank will not enter into a contract with a minor. Now exceptions are there. So loan for necessities can be recovered, like food, shelter, education. So they can be recovered, but again they can be recovered from minor's estate. Then we have person of unsound mind. So a person who cannot understand the meaning of a contract at the time of signing it is not competent. So, simply stating, a person who is not able to form a rationale, what is good for him, what is bad for him, is a person of unsound mind. And again, such contracts are not valid. Disqualified persons. So some people are legally barred, like undischarged insolvent. They're declared bankrupt, but they're not yet cleared. The name is not clear, so they cannot enter into a contract. Married woman, she can take a loan in her own name as if she is independent, and husband is not responsible unless husband is a co-borrower. Pardhanasheen women, they're women living in strict seclusion as per community customs. They can borrow, but again, bank must take extra care to verify their identity and ensure they understands the contract. Illiterate person, so they can borrow but signs with thumb impression or mark. Documents must be read aloud and explained in the presence of witnesses, and witness detail should be recorded for safety. Then we have proprietorship firm. So proprietorship firm is a business that is completely owned and managed by one individual. Legally, the owner and the business are same person. This means if the business earns a profit, the owner keeps it. If the business suffers a loss or has debt, the owner is personally liable to pay them. Some of the key features are one person. The ownership and control is in the one person. So there's no separate legal entity. The person who controls take all the decision. There is no need to consult anyone. When a bank deals with proprietorship firm, it is dealing with that individual, because proprietorship firm and the owner are one and the same. Even though in law the owner and the firm are same, in accounting we treat them separately. This avoids mixing personal expense with business expense. So in accounting it is treated separately. Again, they have unlimited liability. The liability is unlimited. The owner is personally responsible for all debts. So creditors cannot claim only business assets but also personal assets like house, car, and jewelry. And the proprietorship firm is governed mainly by the Indian Contract Act. Partnership firm. A partnership firm is formed when two or more persons agree to run a business together and share profit. The definition of partnership is provided under Section 4 of the Indian Partnership Act 1932. With respect to legal position, so it is governed by Indian Partnership Act of 1932 and Indian Contract Act of 1872. Legal position, a partnership firm again is not a separate legal entity from its partner. Partners and the partnership firm are not distinct like a company. And according to Section 18 of the Partnership Act, each partner is an agent of the firm. This means any partners act in the usual course of business bind all the partners. Registration is optional, it is not compulsory, but again, it is highly recommended that a person registers the firm, because unregistered firm cannot sue others for breach of contract. Authority of partner. Partners have an implied authority provided in Section 19 of the Indian Partnership Act to do things that are normal for that type of business. For example, in trading firm, a partner can borrow, and these powers are not provided in non-trading firms. So a partner can sell goods or pledge goods as securities in trading firms. which is not the case in non-trading firms. In non-trading firms like law firms, accounting firms, these powers are not automatically given unless it is agreed in writing. A partner cannot, unless authorized, so there is some limits to the authority. So a partner cannot give guarantee. A partner cannot submit to arbitration. They cannot submit disputes to the arbitration. They cannot admit another partner on behalf of the firm, or they cannot sell or mortgage property which belongs to the firm. So these are certain limitations to the authority of the partners. Some essential ingredients are at least two persons are required to form a partnership, and maximum 50 persons uh, can be there for profit making partnerships. Agreements can be oral or written. Sharing of profit and losses are equal unless it is agreed. Business can be carried by all or any one of them by or anyone on behalf of all. And there are certain bodies like societies, club, HUF. They are not partnerships. So need to understand that societies are not partnership. Hindu undivided families are not partnerships. Registration of partnership firms, again optional but highly recommended. Why to register? A registered firm can sue others. Partners cannot deny the existence of the firm, and it encourages transparency. The procedure. So you apply to registrar of firms within 1 year of starting the firm. You submit firm's name, address of office, main branch, main head office, branch offices, name and address of partners, date when partners joined, duration of the firm, and you pay the prescribed fees. Now, registrar enter details in the register of firm and issue a certificate of registration. Giving false details can lead up to 3 months of imprisonment or fine or both, and anyone can inspect or get the copies by providing a certain fees. Then there are consequences of non-registration, like partners cannot sue each other for contractual rights, firm cannot sue outsiders on contractual matters. Again, exceptions are there: suit for dissolution, realizing dissolved firm's property, insolvency proceedings, and small cause suits. So these are exceptions. Even if the partnership is not registered, these cases can be filed. Banking and business operations by partnership. So the rights and duties, it is determined by the partnership deed. The managing partner usually operates immovable property transactions. So a partner cannot mortgage or sell firm's property unless authorized, and all partners must sign mortgage documents. Insolvency of firm, banks must stop all transactions immediately. Credit balance is handed over to the court receiver, the official receiver, and debit balance must be claimed in the court. Insolvency of partner, remaining partners can operate the account with a fresh mandate. And when a partner is dead, so partnership dissolves automatically unless it is agreed otherwise. And banks should stop credit facilities and finalize the liabilities. The bank should consider uh, things before lending, like whether the firm is registered or not. The bank should scrutinize the partnership deed for any clause which can affect the loan security. And if the partner is a limited company, register banks charge with the registrar of companies. Now, for example, Ravi, Amit, and Sunil starts a partnership, RS Traders, to sell hardware. Amit buys goods worth 3 lakh on credit, binding on loan partners. Sunil tries to sell the shop building without others' consent. This is invalid unless authorized. If the firm is unregistered, If a supplier breaks a supply contract, RAs cannot sue and Amit becomes insolvent. So Ravi and Sunil can still run the business but must give our new bank's mandate. Hindu undivided family. So in Hindu undivided family, or HUF in short, is a special type of family setup recognized under Hindu law. It is not something you create by signing a contract or filling a form. It is formed automatically when a Hindu family exists. So it includes all the people who are descendants from a common male ancestor. That means father, grandfather, great grandfather, and so on, along with the wives and unmarried daughters. So for income tax purposes, in income tax, HUF is treated as a separate person under Section 231 of the Income Tax Act. This means the HUF can have its own PAN card, it can own property in its name, and it can file its own income tax return separate from the return of its members. Some of the key features of HUF, let's study it. Constitution of the HUF. So male members get a right to ancestral property by birth. A major male member is called a co-partner. He has a legal right in the ancestral property. And after the Hindu Succession Amendment Act 2005, daughters also become co-partners and have equal rights like son. The head of the family is known as Karta. The head is known as Karta, and the members are known as co-partners. So Hindu Succession Hindu Succession Act Amendment 2005. So this particularly gives right to daughters, and uh, so daughters can also become co-partners. Law governing HUF. So we have two laws, Mitakshara and Dayabhaga. Mitakshara in most of the India. So it is right to property by birth, and then we have Dayabhaga. Amel in Bengal and Assam. So it is right to property comes only after the father's death. Status of HUF. When we talk about status of HUF, HUF is not a single person but a group of person. It has its own PAN card, and the family needs to know which law applies to them, Mitakshara or Dayabhaga. So this law, Hindu Succession Act, this applies to Hindus, Buddhists, Jains, Sikhs, and others by custom. Management of HUF, the Karta is the head, and the Karta manages the Hindu undivided family. Usually, the senior most member becomes a Karta, and if there is no adult male member, a female member can also become a Karta. With respect to rule and powers of Karta, so he manages family property. He represents the family in legal and financial matters, can sell property for benefit of the family, and can borrow money for family needs or businesses. So these are the powers of Karta which I am talking about. And with respect to duties, we'll discuss it once we'll discuss the duties. Don't worry. With respect to duties, the Karta runs the business for the benefit of all members and keep proper accounts of income for the family property. The liability of Karta is unlimited, but the liability of co-partners is limited to their shares. So the Karta can borrow money for family purpose, and lender must approve it for the necessity. Property transfer by the Karta without necessity is voidable by other co-partners, so they can claim that this transfer of property is not valid. They can challenge actually the Karta's decision, and if no one challenges, so it remains valid. Banking with Hindu undivided family. So when dealing with banks, the bank must identify the Karta first. The account opening form should be signed by all the members and not only by Karta. For loans, bank must make all adult members jointly responsible, and the Karta can borrow for family business, but if it's not for family benefit, other members can challenge the decision of Karta. So the important pointers for HUF is that HUF is automatic, so no contract is needed. Daughters have right now. Daughters now have the right in property. Karta is the eldest member. Separate PAN and law differs for Mitaksha and Deyabhaga. Now let's understand companies. So a company is like an artificial or juristic person created by law. It is not a living being, but in the eyes of law, it is treated like one. This means it can own property, borrow money, enter into contracts, earn profit, and be sued or sue someone its own name. In India, companies are registered and governed by Companies Act. So at present, we have Companies Act 2013. Previously, we have Companies Act 1956. And once a company is formed, it has perpetual succession, meaning to say a person may come, person may go, but the company remains forever. Uh, and only a legal process can dissolve it. Company differs from its owners. So a company has a separate legal identity from its member. This is the biggest difference from other forms of businesses like partnership or sole proprietorship. Let's understand the famous case of Solomon versus Solomon and Company. So the principle of separate legal entity was established in this case. So Mr. Solomon owned a shoemaking business. He formed Solomon Company with himself and six family members as shareholders. The company bought his business for some 38,700 pounds and he received 20,000 shares and debentures worth 10,000 and some cash. When the company later went bankrupt, unsecured creditors claimed that Mr. Solomon should personally pay them since he was the company. The House of Lords rules that a company is different person from its shareholder. Even if one person holds almost all the shares, company is still separate and shareholders are only liable up to the value of their unpaid shares. Now, this established two key principles. Number one, separate corporate personality, and number two, limited liability. So members are only liable up to their unpaid share value or guaranteed amount and not more than that. And this was reaffirmed in Tata Engineering versus State of Bihar by the Supreme Court. So the Supreme Court explained that a company has its own name and seal, and it can own asset, and these assets are separate from its members. It can sue or be sued in its own name. Creditors of the company cannot claim assets of shareholders, and creditors of shareholders cannot claim company's assets. Liability of shareholders is limited to the capital they have invested. Let's understand the key characteristics as well. So it's a voluntary association. People freely come together to form it. Perpetual succession. Again, people may come, people may go, and the company remains forever. Transferability of share is there. So in public company, shares can be freely bought and sold. In private companies, there are legal restrictions. We have limited liability. Ownership of the property is separate. The company owns the property and not the shareholders. And then the company has right to sue and be sued. It can take legal action or face legal action in its own name. Types of companies, we can have different types of companies based on liability, based on structure. So on based on liability, we have limited by shares. Most common liability is limited to unpaid share value. Then we have limited by guarantee. A member agrees to pay a set amount if the company winds up, often for non-profit clubs and education trusts. Then we have unlimited companies. So no limit on members' liability. It is rarely used. Based on ownership or structure, we have private company. Private company restricts the share transfer. It restricts and not prohibits. Keep that in mind. The maximum number of members can be 200. Uh, Restriction is different from prohibition. When we say prohibit, it is a you absolutely cannot do something, and we when we say restriction, then there are certain conditions. When met, it is permissible. So, public invitation for securities is prohibited, share transfer is restricted. Public company, the shares are freely transferable, there is no limit on the maximum number of members, and it can invite public for investment. Government companies, the companies where more than 51% of the stake is owned by the government, be it central or state, then the company is government company. For example, ONGC, SAIL. So these are the examples of government companies. We have one person company. So in one person company, it is a concept introduced by Companies Act 2013. We have only have one members and then we have one nominee. It loses one person company status if the capital exceeds 50 lakh rupees or the turnover exceeds 2 crores for 3 consecutive years. Then we have small company. Earlier, the paid up capital was 50 lakh and turnover was 2 crore, but it was amended and the paid up capital now has been increased to 4 crore and turnover. The paid capital should be less than or equal to 4 crore and turnover should be less than or equal to 40 CR. Uh, this limit can go up to 10 or 100, 10 CR or 100 CR. But again, at present, the notified limits are 4 crore and 40 CR. It excludes public holdings, subsidiaries, and Section 8 companies. Then we have foreign companies, companies which are incorporated outside India but operating in India are foreign companies. Then we have holding companies, the companies which control other companies, and the companies that are being controlled are subsidiary companies. So the holding company can control the decisions, can change the board of directors, has the voting power. So the holding company controls the decision of the subsidiary company. Now, how the companies are formed? Basic laws which are governing the company. So for formation, public companies, minimum of 7 members are required. For private companies, minimum of 2 members are required. For one person, only 1 member is required. Unregistered organizations, uh, exceeding prescribed limits, they are illegal. Now the key steps is to choose the name. Name must be unique and not misleading, and it should end with the word limited or private limited. For example, Infosys Limited or Bennett and Coleman Private Limited. Then we have memorandum of association, an article of association which needs to be filed. The memorandum of association is a public document. It is a charter which defines the objective for which the company is formed. Uh, it also provides the liability, the location, the capital, and article of association is an internal rule book. It is a rule book and it is a charter. The rule book for internal management, say director's power, meetings, share transfer, so on and so forth. Memorandum, association, and article of association, and other documents are to be submitted to the registrar. They must be filed with the registrar. Then we have certificate of incorporation. The registrar issues certificate of incorporation. The company legally comes into existence after this date. So we have done with this. Then we have commencement of business. So, for companies with share capital, they must declare that the share capital is paid up and the registered office is verified within 180 days. Then we have some other provisions like common seal is optional now. Certain documents can be signed by 2 directors or 1 director plus company secretary, and it will work if there is no common seal. And the company limited by guarantee are often used for non-profit purposes. Then we have statutory companies. So the companies are created directly by Act of Parliament. They are created by statute and not under the Companies Act. For example, State Bank of India Act. So State Bank of India is formed under State Bank of India Act. LIC formed under LIC Act of 1956. Then Nationalized Bank under Banking Companies Acquisition and Transfer of Undertaking Act of 1970 and 1980. and they are governed by their own acts but still function as corporate bodies. Trust and cooperatives. So, clubs, societies, other non-trading associations. So, these are group of people who come together for non-profit activities. Like sports club, education society, cultural association, and they are not allowed to carry out financial transaction unless they are properly registered under law. Common laws under which they can be registered is Society Registration Act, Cooperative Societies Act. For example, a sports club like XYZ Cricket Club may be registered under Society Registration Act. Then we have trust. So, what is a trust? A trust is a legal arrangement where someone manages property or money for the benefit of others. The person who manages is known as trustee, and for the benefit, for the person for whose benefit it is managed is known as the beneficiary. Beneficiary. So there are different types of trust like private trust, public trust, religious and charitable trust. So private trust are governed by Indian Trust Act of 1882. Public trust, they are governed by Public Trust Act. For Muslim trust, they are known as Waqf and they are managed by Waqf Act. The person managing the trust is the trustee. Their powers are written in trust deed and they are regulated by law. Uh, in Muslim Waqf, the trustee is called Mutawali and it is supervised by the Waqf board. Now, bank giving a loan to trust has to ensure that all government approvals are there and permissions are obtained. A charitable trust, if a charitable trust wants a bank loan to build a hospital, then the bank must check that the trust registration date, trust deed, PAN card of the trust, documents of the person authorized to operate the trust, so on and so forth. Then we have LLPs, Limited Liability Partnership Act. It is a fusion of partnership and companies. So it provides the flexibility of partnership and the benefits of a company. So a business form that combines flexibility of partnership with protection of limited liability, like a company, it is created under LLP Act 2008. It is separate from its partner. So LLP has a separate legal entity and perpetual succession. The key features include that minimum two members are required to form LLP and one must be a resident in India. People cannot be partners if they are declared mentally unsound, undischarged insolvent, or insolvency applications pending. So the person should be competent to contract, simply states. A person should be competent to contract to enter into a LLP, and LLP can sign contracts in its own name, can own property, sue or be sued. Liability of the partner here is limited, and the partners are not responsible for other partners' mistake if done independently without the approval. We have small LLP, so the total capital contribution should be less than 25 lakhs and turnover should be less than 40 lakhs. So it qualifies as small LLP. Now there are certain documents which are needed for documents which a bank need to open LLP accounts. So they are LLP certificate of incorporation, PAN card, proof of residence, LLP agreement, and this is plan of LLP and plan of partners as well. And bank may also require any other document. Type of credit facility. So there are two types of credit facilities. So bank give money or financial support to customer in different ways depending upon whether the banks actually funding it. So the funds are flowing or not. So we have fund based facility. Here, the bank actually give money to the customer. The bank's fund flow out and interest is charged on the amount given. Cash credit, overdraft, term loan, bill finance. Then we have non-fund based facilities. So the bank does not give you money directly, but gives a promise or guarantee on your behalf. This help you to do business without paying cash immediately. So it includes bank guarantee, letter of credit, acceptance facility, and we'll understand them one by one later in this unit as well. So we'll discuss CC, OD, term loans. So don't worry about it. Then there is a segregation of borrowers based on retail and commercial loans. So retail loans is given to individual or small businesses, and commercial loans is given to larger businesses in bigger amounts, and it requires detailed assessment and monitoring. So again, these loans can be further divided into term loans and working capital loans. So what is a working capital? It is money needed for day-to-day running of business. It is used for buying raw materials, spare parts, wages and salaries, and it used to pay the electricity bill, water bill, utility bills, and to pay the tax, transportation charges, and other running expenses. So it is the money for a work operating cycle. Now, what is an operating cycle? It is time taken from buying the goods to receiving the payments. A person, a corporation buys goods, works on them, sell the goods, receives the payment, and again buys the goods. So this is an operating cycle. There are two types of working capital: gross working capital, net working capital. Gross working capital is the total funds needed for assets, uh, for current assets like cash, stock, receivables, and net working capital is current assets minus current liabilities. It shows the amount of short-term assets funded by long-term resources. Adequacy of working capital. So, too much of working capital means the money is idle. There are low returns. You are just piling up the money. The money can be invested somewhere else, but money can bring some extra money. And if the working capital is inadequate, then the business operation will suffer. There will be delay in payments, and again, risk of losses are there. Risk return link the relation. So lower the risk, lower the return. Higher the risk, higher the return. So there's a direct relationship between risk and return. If the risk is higher, then the return will be higher. If the risk is low, then return will be low. Long-term funds. So businesses also need money for buying land, machinery, vehicles. For this purpose, term loans is provided. The duration of term loan is more than a year, usually up to 10 years, and sometimes it goes up to 15 to 20 years. Now, term loan is used for fixed assets or expansion purposes, and it is repaid in installment from profit. Repaid from profit, and sometimes used to finance a permanent portion of the working capital. So these long-term funds are used. Now, what is the difference between term loan and working capital? So, term loan, the purpose is for buying fixed assets or long-term needs, and for working capital, it is required for day-to-day operational needs. The duration, again, it is medium to long. It is usually a year. It is renewable in nature. Payment, it is fixed installment over a period of time. Working capital loan is payable on demand, and it is a revolving account. Disbursement, one time disbursement or a few on a few installment. Then there are continuous withdrawals in working capital loans. The nature is that it ends after full repayment, and the working capital continues as long as the business continues. fund-based working capital facilities. So when a business runs its day-to-day operation, it needs money for short-term purpose like buying raw material, paying wages, stocking goods, and covering bills until sales money comes in. Banks provide fund-based working capital facilities to meet these needs. These are called fund-based because the bank actually gives cash or directly makes payment on behalf of the borrower. So they are generally linked to company's current asset, which means stock of the goods, raw material, and money receivable from the customer. We have cash credit in OD facility. So the bank allows the business to borrow up to a certain limit called sanction limit. The business can borrow only as much as it needs and whenever it needs and repay when it has funds. Interest is charged only on the amount which is actually borrowed and it is calculated daily. Now there's a difference between cash credit and OD. So cash credit it is mainly used for working capital needs. When the working capital needs are regular, the account usually shows a debit balance, meaning you owe money to the bank. And in OD, it is linked to a current account, usually when funds are needed occasionally. The account is normally in credit, but sometimes goes in debit when the borrowing happens. We have drawing power, so you can always use the full limit. The maximum you can draw depends on the stock and receivables after keeping a margin of safety. The legal aspects is that CC and OD is a contract even without a written agreement. If a bank lets you overdraw it, it's treated as an implied contract. Courts have made borrowers repay with interest in such cases. Then we have Clayton's rule: when money is deposited in such account, it first repays the earliest debt. For example, you have a debit balance of 1000 in March, and then say 750 in April. You deposit 750 rupees, so it will go towards this 1000 first. So this is Clayton's rule. Termination: so bank cannot end OD suddenly. If an OD has been enjoyed for years, then the bank cannot abruptly stop it without notice. Court have treated such arrangement as binding contracts. Bill finance: so instead of lending against stocks, bank can also finance against sales bill. When the businesses sell goods, the buyers may uh, take some time to pay. The banks step in and give the seller money immediately, and the later collects from the buyer. This is common for businesses that sell on credit. So we have different types of bill finances. Number one is bill discounting. So bank gives seller the bill amount minus interest for the credit period. For example, bill value is 10 lakhs, which is payable in 90 days. So bank gives you 9.9 lakhs and keeps 10,000 as interest. Bill purchase: for immediate payment sales. So bill purchase are demand bills. Bill discount is usance bills. Advance against bill collection, bills for collection. So loan given against total bills under collection after keeping a margin. Draw bill acceptance: it is reverse of receivable financing. So bank pay on behalf of buyer so that buyer can pay later. Bill co-acceptance: bank adds its guarantee to the bill, giving extra comfort to the seller. Uh, Term loans and demand loans. So term loans, again, these are long duration loans which are repayable in installments over short, medium, or long terms. So term loans for short duration, it is usually less than a year. For medium, 1 to 5 years, and for long term, it is 5 years. These are demand loans. Demand loans are payable on demand. Whenever the bank demands it, the person has to pay. Bank can also finance long term and infrastructure projects. So, for acceleration of repayment, if it is agreed, bank can demand full repayment on any default. For example, the bank lends money to a person on the condition that if this person defaults, the bank will be able to recall all the loan amount. So, if this person defaults, the bank has the option to recall all the money if it is agreed. Then the limitation period: the term loans have 3 years of limitation period from date of default of installment. For demand loans, again 3 years, and wait until last bank may wait until the last installment due, or bank can file a case on the first default, but losing claims on earlier defaults. Again, there's a risk of losing all the claims on earlier default if bank waits till the last date. Non-fund based facility. So when bank give loan on credit, they usually give money upfront, right? Like a cash loan or overdraft. So this is called fund based facility. But sometimes the bank does not give you money immediately. Instead, it promises to pay money if something happens in the future. So this is called a non-fund based facility because no money leaves the bank immediately. These are called contingent liabilities, meaning the bank's liability depend on uncertain event or happening. Bank guarantee. A bank guarantee is like a promise from the bank to pay a third party if, say, you, the customer, fails to fulfill your contractual obligation or payment obligation. We'll understand bank guarantee in detail in unit number 31. It is governed by section 126 of the Indian Contract Act, which says that a guarantee is a contract where third party agrees to pay if the main person, the customer, defaults. So there are three parties involved: surety, principal, debtor, and creditor. The bank which gives guarantee is surety. The person on whose behalf the guarantee is given is the principal debtor. So the customer is the principal debtor, and the person to whom the guarantee is provided is the creditor. The purpose again is to support working capital or long term obligations. So customer often needs bank guarantee to support their business transactions, especially when dealing with big companies or government departments. So these guarantee help them to avoid blocking cash as security deposit. So there are different types of guarantees, say performance guarantee, financial guarantee, DPGs, which we'll study in unit 31 in detail. Performance, financial, deferred payment guarantee. So we'll discuss them in unit number 31. DPG will discuss in unit 33. Then there are some special types of guarantee, which like bid bond guarantee. So when bidding for a project, bidders often must deposit earnest money to show seriousness. So instead of cash, a bank guarantee can be given. Earnest money. So same as bid bond, a guarantee is placed in cash earnest money. Advance payment guarantee. If the buyer pays you in advance, you can give a bank guarantee promising to return the advance if you fail to deliver. Then retention amount guarantee. Sometimes a buyer holds back some payment until after the contract is satisfactorily completed. The supplier can give a guarantee for that amount. Letter of credit, we'll discuss it in unit number 32. So let's discuss it in short. So a letter of credit is a written promise from the bank to pay a seller on behalf of a buyer once the seller submits the required document proving goods have been shipped or services delivered. It is commonly used in trade finance, especially for buying and selling goods internationally or domestically without upfront cash. So how does it work? So the buyer asks their bank to issue the letter of credit in favor of the seller. The bank promises to pay the seller on presentation of specified documents like invoice, shipping papers, inspection certificates within a certain limit. We have some important points for letter of credit, like the bank's promise is conditional. The payment only happens if documents conform exactly to letter of credit terms. It should not be similar, it should be the same. Letter of credits are governed internationally by Uniform Custom and Practice Documentary Credits, UCP 600, from the International Chamber of Commerce. Although widely used, the use of letter of credit had declined somewhat in recent years with new payment technologies. Underwriting and credit guarantee. So underwriting means the bank agrees to buy securities or share if the company or borrowers cannot sell them to the public or investors. So this guarantee, the company will get the needed fund. So this guarantees that the company will get the needed fund. Derivative products. So bank now offer derivative products such as forwards, futures, swap, and option to help customer manage risk related to currency and interest rates. Let's understand other credit facilities now. So apart from the above business related fund and non-fund facilities, bank also provide loans and credit for personal needs. So what are these needs like education, medical, housing, buying vehicle, purchasing durables, travel and leisure? So a bank can provide loans for all these activities. Uh, there are revolving credits and then there are one-time loans. So in one-time loan, you get a fixed amount and repay in installments over short, medium, and long term. And in revolving credit, like a credit card or OD, you can borrow and repay and borrow again repeatedly within a credit limit. So in this particular unit, we'll understand about credit appraisal techniques, methods of assessment of loan, what is a working capital, what is gross working capital, net working capital, and we'll understand about the assessment of working capital. We'll understand different methods to assess fund based, non fund based working capital. Then we'll understand about term loan and we'll check our progress and do some practice questions. So, what is credit? Before understanding the credit appraisal, we need to understand this term credit. So, credit means a loan or money that a bank gives to its customer in any form. And this word appraisal means checking, evaluating, or reviewing something carefully. So, credit appraisal is a process by which the bank or lender checks if the borrower is trustworthy and can pay the loan amount back. So, whether the customer can repay the loan or not. So, we done this via credit appraisal. And when the bank appraises credit, it looks at things like the borrower's character, collateral, their capacity, and the bank also considers the borrower's income, nature of people depending on the borrower. So, what it is the family size, borrower's monthly expenses, employment history, year of service, and any other factor that affect the borrower's ability to repay. Bank will consider it. So, credit appraisal in a nutshell means carefully checking a loan request from the borrower, and the main goal is to make sure that the money lent is safe and will come back to the bank. The loan is profitable for the bank, and the bank uses different tools for this, such as bank studies the borrower's financial report and documents, checks how the borrower's business or product is doing in the market compared to others in the same industry, checking if the loan will remain a performing asset, meaning the borrower will repay on time. And credit appraisal is more than just verifying documents. It is a judgment or on whether to approve or reject the loan based on the risk involved. In the past, credit appraisal was mostly based on bank officers' personal judgment, but now the focus is on credit risk appraisal, meaning the bank looks carefully at the risk in giving the loan, and the evaluation is more objective and based on facts and numbers rather than just feeling and guesses. So it is more objective and less subjective. Credit appraisal techniques. So, credit appraisal is a process that starts the moment a customer asks for a loan and continues until the loan is given. The bank must verify and check all facts carefully. The goal is to measure how risky the loan is and then decide whether to approve it or reject it. Some risk is always there, but good appraisal can reduce the risk. So, this process involves identifying and verifying the borrower. So, confirm who the borrower really is, checking the borrower's business, understand how the business work and if it is good or not, understanding the credit requirement, why the borrower needs the loan and how much is required. Then we do due diligence, detailed study of borrower and its business. We select the loan product, picking the correct type of loan for the borrower, whether it's a working capital requirement, a term loan, fund based exposures required, non fund based exposures required, so on and so forth. And last but not the least, we finalize terms and conditions, agreeing on repayment, interest, collateral, etc. Validation of proposal. So validation means not just getting the facts right, but also getting the right facts in the first place. The bank must ask for only important information that will help decide about the loan. Too much unnecessary information can confuse the things. Steps involved in validation is that to check the documents the borrower gives, like company registration paper or financial reports, visit the borrower's office or factory to see how the business is actually running and to understand how good the management is. Check if all license and approval needed for the business are valid and available, and make sure that the borrower has the legal right to borrow the money. For example, if a company is borrowing, the board of director must approve it officially. Credit risk. So, credit risk is the chance that the borrower will fail to repay the loan. This can happen because the business fails due to bad management, poor decision, or market problems, or the borrower intentionally does not want to pay. If borrower is not honest and he does not want to pay you back. So, in the past, bank relied on report from other bankers to understand this risk, but now they can use credit reports and credit ratings from the rating agency as well as their own evaluations. But there can be many reasons for default, but we can segregate those reasons into two components: internal factors and external factors. So internal factors include poor management, wrong financial choices, or bad marketing, and the external factors include economic downturn, sudden change in the market, etc. And bank checks the borrower's management team, their experience, financial health, and how well they handle money to assess the risk. Credit risk rating. Credit risk rating uh, is a tool to measure risk by giving marks or scores to different risk factors. Each important factor, like borrower's financial condition, management quality, business performance, gets a weight or score, and these are added to get total risk score. If the score is above a certain limit, the loan may be approved. If not, it may be rejected or need some special conditions. And this rating helps the bank make a clear and objective decision about giving the loan. Criteria for decision. So when a bank decides whether to approve or reject a loan, it mainly looks at three things. Number one, credit rating score. So this is the number that shows how reliable the borrower is in repaying loans based on the past behavior. Second is the purpose. This is second. The bank checks if the reason for taking the loan fits their rules and policies. Some types of loans or purpose may be banned or restricted. If the loan purpose is not allowed, the bank rejects the loan. And third is the concentration limits. So banks exposure limits. So bank don't want to put all their money in one place. They set limits on how much they can lend to one person, one business group, or one industry to avoid too much risk. Aspects of appraisal. So before giving a loan, bank evaluate four main things. Is the borrower trustworthy and able to repay? Why does the borrower need the loan? Does the borrower have enough money coming in to repay? And what collateral or security does the borrower offer? And to cover these areas thoroughly, bank checks on seven key factors known as 7 C's. They are credit worthiness. So, second is character. So, credit worthiness. This means checking the borrower's financial history and reputation. For individuals, the bank looks at credit reports from credit bureaus like CIBIL. For businesses, financial statements like balance sheet and profit and loss account are analyzed. Second is character. This looks at the honesty, integrity, and reliability of the borrower. The bank may do the background checks and market inquiries to understand the borrower's reputation. Third, capacity. This means the borrower's ability to repay the loan from their income and business profit. The bank examines the income, expense, and cash flow to see if the borrower can handle the loan repayment. Number four is capital. This refers to the borrower's own money invested in the business or project. A higher personal investment means the borrower has more skin in the game. reducing risk for the banks. Fifth is collateral. Collateral is something valuable the borrower pledges to the bank as security for the loan. If the borrower cannot repay, the bank can sell this collateral to recover money. While collateral does not improve the loan quality, it provides a safety net for the banks. Conditions. So this cover the overall business environment and loan terms. The bank checks if economic conditions, industry trends, or loan terms may affect the borrower's ability to repay. Last but not the least, the cash flow. So this is about how much cash the borrower's business or income generates regularly. The bank prefers the loan repayment from normal business operations or regular income rather than selling asset or borrowing more money. So evaluation of credit worthiness, the bank looks at the borrower's credit history and financial strength. For individuals, again, credit reports are look into. They shows past loan repayment, their behavior, and for companies, we look into their financial statements, public records, and the goal is to confirm the borrower can and will repay the loan. Purpose of the loan, the bank needs to know exactly why the loan is being requested. Business loan can be for long term needs, for buying land, machinery, or short term needs like working capital requirements, for purchasing raw material, for disbursing salaries to pay the wage, so on and so forth. Or it can be individual loans. Individuals ask loans for various reasons, for marriage, for education, for medical emergency, to buy a house, to buy a vehicle, or to buy a consumer goods. The bank wants assurance that the loan is for proper purpose and the borrower is serious about repayment. Security and collateral. Again, collateral does not make the loan better, but it protects the bank if the borrower fails to repay. So this is nothing but a cushion. If borrower fails to repay, the bank can fall on this collateral. Bank can count on this collateral, and the bank wants this collateral that is valuable, easy to sell, and legally enforceable. Cash flow. So again, this is the most important factor. The bank checks if the borrower's business or income can generate enough cash to pay back the loan regularly. For businesses, cash can come from sales revenue or other income, selling assets, borrowing more money, or adding fresh capital. And for individuals, stable income sources like salary, rent, or profession fees are checked. Methods of assessment of loan. So bank provide different loans and methods to check, approve, and monitor. A loan depends on the type and purpose of the loan. And we divide these loans into two categories: commercial loans and retail loans. We'll discuss retail loans in the units to come. In this particular unit, we'll be more focused towards commercial loans. Commercial loans are big loans like project loans, which have long repayment period. Because the amount is large and the repayment period is long, banks need experts to check whether the project is viable, how much money is needed, and whether the borrower can repay. And retail loans are small loans given to customers for personal loans, vehicle loans, for purchasing consumer durables, etc. In retail loan, everything is standardized and the customer's detail are entered into computer systems, which generates a scorecard to help the sanctioning officer to decide. Monitoring of repayments is also automated in retail loans, and the system can track EMI payments and send the alerts. Now, different assessment methods based on loan purpose includes loan to businesses and loans to individuals. For businesses, again, working capital requirement and capital expenditure are there. Capital expenditure loans for buying long-term assets like machinery, building, technology, and for individuals, housing loan, vehicle loan, consumer durable loan, etc. Uh, Now, what is working capital? Every business needs fund for two purpose. Number one is for fixed capital for long-term investments, and number two for short-term needs like buying raw material for smooth operations of the business. So, working capital is money that keeps circulating, spent at the start of production cycle and recovered when goods are sold. So, working capital refers to the fund a business requires for the smooth operations or smooth daily operations rather, and it starts from buying the raw materials, then working on those raw materials to convert into finished goods, selling those finished goods and recover the cash. And once the cash is recovered, this cycle is complete. We have three types of working capital which we need to understand. Number one is gross working capital. So this is the total amount invested in current assets, things that can be turned into cash within a year. For example, uh, stock, accounts receivable, etc. And the purpose is to show total short-term resources available, to show how much money is tied up in asset that can be converted to cash within a year. So the purpose is to show total short-term resource available and help the business to plan and ensure enough money is available when required. Net working capital. So net working capital is the difference between current assets and current liabilities. Current liabilities are short-term debts like money owed to supplier, wages payable, and short-term loans. If net working capital is positive, the company has more short-term assets than debts, meaning it can easily pay its dues. If it is in negative, then it is a risky situation. Debts are more than the assets. And net working capital should be at least 1:1. Meaning to say assets are equals to liabilities. Working capital gap. So this is a term used in Indian banking to decide how much working capital loan is required to give to a borrower, and it is determined by deducting current liabilities from the total current assets, and current liabilities exclude bank borrowings. So if current assets is 10 lakhs, current liabilities is say 8 lakhs, bank loan is 2 lakhs. So here the current liabilities, from current liabilities will exclude the bank loan, and the current liabilities will stand at 6 lakh rupees and the gap is 4 lakh, which bank will finance as a part uh, of this. Components. So now we understand working capital. Working capital means the fund a business needs to run its day-to-day activities. It is not used to buy big machines or building. It is used to buy things like raw material, to pay workers, keeping goods in stock and managing bills. So the component includes raw material naturally. Second, stock in progress, goods that are partially completed, goods that are partly made but not yet ready for sale. For example, half stitched shirts lying in a tailoring unit. So it is an example of stock in progress, work in progress. Then we have finished goods, products that are complete and ready to be sold, but still they lie in the warehouse or on the way to customers. Other consumables, items like packaging material, lubricants for machine, cleaning supplies, etc. And receivables or sundry debtors. So this is the money owed by customer who have bought goods on credit. For example, a shopkeeper buy goods from a wholesaler, promises to pay after 30 days. So this is an example of receivables. Again, this also includes other expenses, small daily expenses like electricity, minor repair, petty cash which is required. So these all are included in components of working capital. So working capital, it starts right from purchasing the raw material and ends when the cash is collected. Again, it includes these four things which we have just studied. So it is the component of the working capital cycle. The cycle repeats with cash from sales funding the next cycle of raw material. So it looks like this. So you have cash, the business has cash, business purchased raw material, Then we work on this raw material. So it enters into another stage called work in progress. Once finished, it gets converted into finished goods. So you purchased clothes, bale of clothes. So you worked on it, you converted them into shirts, into pants. So now those shirts and pants are your finished goods. Then you sell them. Uh, there are two possibilities. You sell them on credit or directly on cash. So if sold on cash, well and good. If sold on credit, we collect the credit from the customers, and then we get, and this cycle gets repeated. So one thing you also need to understand is that working capital is not fixed. The amount of working capital a business needs keeps on changing. So this is not fixed, not the cycle, but the working capital. The amount of working capital depends on the size of business, the nature of business, if there are any seasonable variations, production policy, what is the amount of profit retained. So it keeps on changing. And with respect to the time gaps in the cycle, so in real life, there are always delays between stages. There's a time between ordering and receiving raw material, time taken to produce goods, time goods stay in storage before delivery, credit period allowed to customers. So there's always a time gap in real life. Now there are some computations of operating cycle components which we need to understand. Number one is raw material storage period. So it is the average stock of raw material divided by average daily raw material consumption. For average stock, we simply add opening stock and closing stock and divided it by 2. So we obtain average stock. And for average daily sale, we divide annual consumption of raw material by 360 and we'll get average daily sales. For work in progress conversion period, every time when I say average stock, you just need to add opening stock and closing stock and divide it by 2. So in work in conversion period and in finished goods as well, what we do, we for average we just add opening, closing divided by 2, and for average daily cost of production, we divide the annual cost of production by 360. Similarly, for annual daily cost of sale, for average daily cost of sale, divide the annual cost of sale by 360. Average collection period, average balance of Sunday debtors, so opening plus closing divided by 2. And for average daily credit sales, you divide the annual credit sales by 360. For average payment period, for sundry creditors, we follow the same creditors opening balance plus closing balance divided by 2. And we uh, divide the average for average daily credit purchases, just divide the annual credit purchases by 360. Now let's understand the fund based methods. So there are four main methods we which need to understand: turnover method, operating cycle method, MBPF method. So it is maximum permissible bank finance method, also called projected net working capital method, and last but not the least, cash budget method. So turnover method, it is used for MSMEs with working capital limits up to 5 crore rupees. Working capital requirement is taken as 25% of projected annual turnover, and out of this, 20% can be financed by the bank, and business owner contributes with the remaining 5%. So out of this 25%, bank finances 80% and borrower contributes 20%. Why this 25%? So it assumes that the business completes one cycle one operating cycle in 3 months. So there are 4 cycles in a year, and that's why 25%. So assuming an operating cycle of about 3 months, making 4 operating cycles in a year. And if the cycle is longer or shorter, the requirement changes. Let's take an example. If a small manufacturing unit projects annual sales of 4 CR, so the total working capital requirement will be 25%. So if the projected annual turnover is 4 crore, then the working capital requirement will be 25%, meaning to say 1 crore. And out of this, 80 lakh can be financed by bank, and remaining 20 lakhs should be borrower's own contribution. So let's take an illustration as well. Messrs. ABC is a manufacturer of molded plastic household goods. Average turnover is 80, and it has targeted 25% growth in 2022-23. The working capital requirement in the bank finance for it are estimated as follows. So the growth in turnover will be 25% of 80 lakhs. So 20 lakh rupees will be the growth, and the projected turnover will be 80 lakh plus 20 lakh, meaning to say 1 CR. Working capital requirement is 25%, that is 25 lakhs. Out of this 25 lakhs, bank can finance up to 80%. So bank can finance up to 20 lakhs, and the remaining 5 lakhs should be borrower's own contribution. Operating cycle method. So this operating cycle method is one of the oldest ways bank assess a business working capital requirement. What is an operating cycle? It is the time a company takes to buy raw material, converts them into finished goods, sell the finished goods, and collect money from the customers. The cycle repeats itself. The longer the cycle, the more working capital the business needs. And how does the bank calculate uh, under operating cycle methods? So, firstly, bank estimates the holding period of each major current asset, be it raw material, be it stock in progress, finished goods, or receivables. It estimates the holding period of major current liabilities as well. So, credit from suppliers, advance from customers are estimated. And if raw material are purchased on credit, no bank finance is needed for that portion until the payment is due. And if advance payment is received from customer, then also no bank finance is needed for that portion of finished goods. And in case of small and medium enterprises, special considerations are taken. Many small and medium enterprises face delay in collecting dues, especially from large corporate customers. And to help them, is no automatic set off happens. So bank do not simply subtract creditors from stock value while calculating working capital, and borrowers must give age-wise list of sundry creditors, sundry debtors, and stock statements. Only customers who owe money for up to 180 days are considered for working capital finance. There is a netting of process. So if eligible creditors are greater than eligible debtors, so excess creditors are deducted from stock value, and if eligible debtors are greater than eligible creditors, then extra debtors are considered for finance. Let's take an example. So Messrs. ABC is in ready-made garment manufacturing activity. The average holding period for stock and duration of creditors and debtors are given below. Its annual turnover is 70 lakhs, and annual operating expenses are 60 lakhs. So procurement of raw material takes 30 days, conversion time is 15, average time for holding is 15, and average collection period is 30 days. So total operating cycle will be 90 days. We add these four components and we'll obtain operating cycle. So operating cycle is 90 days. So how many operating cycles in a year? 360 divided by 90. So we'll get 4 operating cycles in a year. Now, what is the total expense per annum? It is 60 lakhs. So what is the working capital requirement per cycle? So it is 15 lakhs. So in every cycle will require 15 lakh of rupees. So working capital is 15 lakhs. Maximum permissible bank finance. So in 1974, RBI set up Tandon Committee, which is headed by Sri P.L. Tandon, the then chairman of Punjab National Bank, to improve the ways bank give loans for working capital. The main aim is to shift loan assessment from just security-based lending to need-based lending based on the borrower's operation, performance, and projections. And the committee recommended to avoid excess stock, so the company should not hold more inventory than needed and work with lean inventory and faster receivable collection. The second recommendation is the norms for inventory and receivables. So the committee fixed maximum limits for raw materials, stock in progress, finished goods, receivables. With respect to raw materials, it is fixed with respect to average monthly consumption. For stock in progress, it is fixed with respect to monthly cost of production. For fixed finished goods, monthly cost of sales, and for receivables, monthly gross sales. Norms were set initially for 15 industries, and RBI does not prescribe detailed item-wise norms. Now, bank decide what to include in current assets and what to include in current liabilities. Now, this concept of maximum permissible bank finance means that the highest amount a bank will lend for working capital after considering the borrower's own contribution and other current assets. So there are three methods of lending under Tandon Committee. First method of lending, second method of lending, and third method of lending. So in first method of lending, borrower must bring 25% of the working capital from long-term funds. In first method, borrower must bring 25% of working capital from long-term funds, and the working capital gap is calculated by deducting current liabilities from current assets, and here the current liabilities exclude bank borrowings. So bank will finance up to 75% of the gap, and a ratio of 1 is to 1.17 is to 1 will be used. So current ratio of 1.17 is to 1 is provided. And now this method is suitable, is used for new units, or weak units, sick units, or first time entrepreneurs. So this is more of a supportive measure. Then we have second method of lending. Borrower must bring 25% of total current assets from long term funds. Bank finance plus other current liabilities together should not be more than 75%. Here the current ratio of 1.33 is to 1 is maintained. If the borrower cannot shift to this method immediately, extra bank finance is converted into working capital term loan, which is repayable in installments, often with higher interest to encourage the repayment. Now, third method of lending is not implemented. It is only for academic interest. Borrowers must finance 100% of the core current assets from long-term funds. Core current assets means minimum stock, receivables needed to keep production running at all times. And borrowers must also fund 25% of the remaining current assets from long-term funds. So 100% of the core current assets and 25% of the balance current assets. The bank finance only the balance requirement after adjusting other current liabilities, and it is intended to meet seasonal or occasional spike in the working capital. CMA credit monitoring arrangement. So it is a set of forms that businesses submit to banks when they want a loan, especially working capital finance. Now these forms contain past financial data, current position, and future projections of the company. The bank uses this data to decide how much money to lend, is the borrower financially healthy, and can they repay on time. Now, different industries have different business models. NBFCs deal with loans and investments, and manufacturing units deal with raw material production and sales. So, the bank makes small changes in CMA format to suit each of the factors. We have seven forms in total. So, let's study them one by one. Form number one, particulars of existing limits. So, in this form, we get the list of all the loans and limits the company already has from the banks and financial institutions. So it shows maximum minimum usage of the credit in past 12 months, and it includes term loans and working capital limits. It helps the bank to compare past usage versus limit requested now, any overdrawing of limit, and whether rules like 25% of inland winds norms are followed. Form number two is with respect to operating statements. So detail of profit and loss account splits into items like gross sales, net sales, cost of raw material, power and fuel, labor cost, depreciation, selling and administrative expenses, interest cost, and it shows operating profit and net profit trends. And bank check in Form 2, are projected sales realistic compared to capacity and market demand? Is there any modernization or expansion plan? Are the reasons for declining sales or profit are cost like raw material valued at current price, and is depreciation adequate, and method use is correct or not? Form number three is with respect to balance sheet analysis. It presents last 2 years actual, current and current year estimate and next year projections. It is breakdown into current liabilities, term liabilities, net worth, current asset, fixed assets, and non-current assets. And bank uses it to seize financial position and trend. So in this particular form, bank checks proper classification of assets and liabilities, are inventory and receivables within normal levels. Any abnormal increase in stock or data should be asked, like why is the increase abnormal? Inventory space should not exceed the norms. Adequate provision should be there for taxes, dividends, statutory dues, intangible assets being written off over the time, and net worth and reserve funds are to be checked. Form number four, comparative statement of current assets and liabilities. It shows current assets and current liabilities side by side, and it helps compare with the industry norms and past trends. Form number five is maximum permissible bank finance. In bank calculates maximum working capital finance bank can give using RBI's method, and if it checks if sales growth and limits increases the match. It also ensures export bills and third party checks are treated correctly. Form number six is with respect to fund flow statement. It shows how funds are generated and used. It differentiates between short term and long term sources and uses, and reveals if short term funds are being misused for long term assets. Checks in form number six that the long term funds cover long term uses, and short term borrowings increases only in line with current assets. Disproportionate increase in inventory versus sale, if there is any, it is checked under form number 6. Form number 7 projects cost and source of finance. It is taken only when term loan is requested, and it shows total cost of project and how it will be funded, like from equity, debt, internal accruals. So how will you fund these project cost? Cash budget method. So when a company needs a large amount of working capital finance, so more than 10 CR, so in that particular case, cash budget methods comes into force. So many banks access the requirement using cash budget method instead of just looking at the assets or securities. So cash budget is a plan showing cash inflows and cash outflows. So cash inflows are the receipts, and the payments. Cash outflows are the payments. So all the money expected to come in during a period are cash inflows, and all the money expected to go out during a period is cash outflows. And it differs from cash flow statements because cash budget predicts the future, the projection, and the cash flow statements shows the historical data. It shows the past. Cash budget only consider cash transaction, whereas in cash flow statements it includes cash plus non-cash items. And cash budget is used for planning ahead, and cash flow statements are used for reviewing past performances. So, what is the purpose of this cash budget? Now, the purpose is simple. Bank uses it to find out exactly how much working capital is needed, to identify when shortages occur, and to avoid overlending or underlending, and ensure loans are given based on actual cash requirement, not just on securities available. So, we have discussed about this receipts and payment, cash inflows and outflows. Now, what information is required for bank to use this method? The company must have a good uh, internal management information system. It should have a finance professional to prepare accurate statement. It should operate in computerized environment so data can be shared quickly, and information should be submitted periodically on time. So the cash budget is divided into four components. These four categories: business operations, so sales collection, payment to suppliers, wages, operating expenses. Non-business operations, so any cash inflow or outflow unrelated to the core business is non-business operation. Capital accounts, so buying machinery, selling goods, so this all is included in the capital account. And sundry items, so miscellaneous receipts and payments which are not covered in any of the three categories is the sundry items. And for working capital assessment, banks mainly look into business operations because these relate directly to day-to-day running of the company expenses. Period covered can be it can be prepared for 12 months, 6 months, or 3 months, and usually it is prepared for shorter intervals like weekly, fortnightly. Now let's understand how it is prepared. So firstly, list all expected cash receipts and cash payments for each month of the quarter. Second, calculate the monthly surplus or deficit. So if receipts are greater than payments, there is a surplus, and if payments are greater than receipts, then there is a cash deficit. Then adjust with the opening cash balance to find out the closing cash balance for each month. So closing balance of month 1 becomes the opening balance of month 2, and repeat for each month in the quarter, and you will get the quarterly cash budget. Now, what are the uses in working capital finance? So, particularly, it is particularly helpful in industries or activities where cash flow fluctuates seasonally. And how does bank decides the loan amount? So, the bank identifies the peak cash deficit, the highest shortage in the entire period. And this is considered the maximum working capital requirement. The bank finances this amount subject to available chargeable assets, of course, and borrowers must bring in at least 25% of this peak deficit from their own funds. Now, let's understand where this method is particularly useful. So, it is particularly useful in industries where cash flow fluctuates. So, opening letter of credit, bill financing, construction projects, sugar manufacturing, software development, rice milling, cardamom processing, etc. What are the advantages? So, better cash planning for borrower is one of the advantages because the borrowers, the customers, know their needs in advance and can arrange fund from other sources if the bank cannot provide more. Close monitoring by banks, so bank stays in close touch and can spot trouble early, helping the business take corrective actions. Better bank resource planning, so bank can allocate funds effectively to meet up any upcoming expenses. Assessment of non-fund based facilities. So non-fund based facilities are generally of two types: bank guarantee and letter of credit. We have also discussed it in unit number 22. And for bank guarantee, we'll discuss it in detail in unit 31. Letter of credit, we'll discuss it in detail unit 32. So let's get a brief Uh, Description of what is bank guarantee and what is letter of credit again. A bank guarantee is a formal written promise by the bank to a third party that if the bank's customer does not fulfill a contract or fails to pay the money, the bank will step in and make the payment. And in essence, the bank is putting its reputation credit on the line to support the customer. And before granting bank guarantee, the bank carefully examine the nature of the business of the customer and nature of the guarantee which is given to the customer, whether it is financial, whether it is performance based, what is the purpose of the guarantee, the details of the contract, the credit worthiness of the borrower, the relation between the customer and the borrower, the security and the margin, cash margin. So the bank may require the customer to deposit certain percentage of the guarantee amount as cash or to provide collateral. But for corporate customers, the bank ensures that a charge is registered with ROC, the registrar of companies. Types of bank guarantees. So there are various types. Let's understand some important ones. Permanent guarantee. So these are guarantees that will always be needed for the normal running of the business. They remain outstanding as long as the unit is operating or the business finance is in place. Second is business activity related guarantee. So these guarantees are connected directly to the main business operation. Then we have guarantee for export quota. So these are required when an exporter needs approval for a specific export quantity. Tax liability guarantees. So sometimes tax authority demands payment for disputed amounts. So instead of paying immediately, the borrower can provide a bank guarantee. Capital goods import guarantee. These are often required to import machineries or equipment under concessional custom duty schemes. Advance payment guarantees. So when a buyer makes an advance payment for goods or service, they may require a guarantee that the money will be refunded if the seller fails to deliver. Letter of credit. A letter of credit is another common non-fund based facility and we will understand it in detail in unit number 32. It is dedicated to letter of credit only. So letter of credit is a written conditional promise given by bank on behalf of its customers to the seller, stating that the bank will pay the seller a specific amount provided the seller presents the required documents exactly as stated in the letter of credit. This means the seller gets an assurance that they will be paid and the buyer gets the goods only when the agreed conditions are met. The purpose of the letter of credit is it is mainly used for purchasing goods both from within the country and through imports, and they are common in international trade because they reduce the risk for both the buyer and the seller. There are two types of payment terms in letter of credit. They are document against payment (DP) and document against acceptance. So here the bank pays the seller immediately upon receiving the goods in document against payments. So the bank pays seller immediately upon receiving the shipping documents, and in documents against acceptance, the bank pays the seller after specified credit period, giving the buyer time to sell the goods and arrange the payment. To assess letter of credit limits, uh, bank collects the estimated value of raw material which is required in the coming year. Out of that, how much will be purchased on credit, time taken for the letter of credit to be sent to the seller, time required for shipment and for the goods to reach the buyer's location, credit period agreed upon between buyer and seller, and the credit period considered for calculating maximum permissible bank finance while sanctioning other working capital limits. Okay, and there's a cycle of an letter of credit transaction. The bank issues the letter of credit to the seller. The seller receives the letter of credit, ships the goods. The goods arrive at buyer's location. The seller presents the required document to the bank, and the bank checks the document and makes the payment as per letter of credit terms. The goods purchased under letter of credit are hypothecated to the bank. These goods are not included again in stock value when calculating the drawing power for other fund-based limits, so to avoid double financing. And capital goods purchased under letter of credit are also covered under the hypothecation. Assessment of term loan. So a term loan is money borrowed from bank for buying long-term assets like land and building, factory, sheds, warehouse, plant and machinery, office equipments, and these are different from working capital loans because working capital loans are repaid for from the day-to-day sales collection, whereas term loans are repaid from future earnings. Repayment period normally ranges from 3 to 10 years, and in fixed installment it is paid. Now, the risk is higher in term loans. If the business does not perform well in the future, the borrower may fail to repay. So, the bank study the project carefully before lending. And the first step is estimating cost of project. So, before giving a term loan, banks find out the total cost of project. Now, typical items which are included in cost of project includes land acquisition, site development, plant and machinery. So land acquisition is the price of land, stamp duty, registration fees, legal charges. For site development, it is leveling, filling, approach roads, drainage, tube wells, gates. Plant and machinery includes purchase cost, import duty, shipping, freight charges, insurance charges. So it is all included in plant and machinery. Miscellaneous assets include furniture, fittings, lab equipments. Then we have electrical fittings, so the wiring, panels, lighting, preliminary expenses and pre-operative expenses. So preliminary expenses are feasibility study, legal fees. So bank usually don't fund this, and this must be paid by promoter. Uh, Pre-operative expenses like cost between company formation and starting operation, like staff training, advertising, and travel. Contingency. So keep that in mind. These preliminary expenses not paid by bank. Working capital margin, so the portion of working capital that must be funded from long-term sources. So these are cost of project and how uh, you will finance this. So what is the means of finance? First, you estimate the cost of project, then you look for the method to finance them. So the source of finance includes share capital, reserve, surplus. So share capital is the money invested by the owners or the shareholders. Reserve and surplus are the past profits which are kept aside for existing businesses. Capital subsidy is the government financial support for certain projects or locations. Term loan, again from banks or financial institutions. The ventures are debt instruments. Um, then there's deferred credit, unsecured loans, or incentives are there. The third step, so we have already understood about this land inside, building, plant and machinery cost, technical know-how. The third step is to detail examination of each cost of items. So the uh, bank officer checks whether the costs are reasonable and supported by the quotations and whether costs are reasonable or not. So the bank estimates the cost of each project, whether technical feasibility is sound or not, whether approvals are taken, building plan approval, uh, machinery import clearance, so everything is in place or not. And this fourth step is viability of business. Even if the borrower has enough funds, the business must be profitable enough to repay. Bank prepares projected financial statement for the whole loan period. They look at installed capacity, production schedule, capacity utilization plan, sales price of the product, cost of raw material, power, fuel, labor cost, maintenance overhead, so on and so forth. And the fifth step is debt service capacity. So bank uses debt service coverage ratio to measure the repayment ability. It is obtained by adding net profit, depreciation, other non-cash expenses, and interest on term loan, and we divide it with interest on term loan plus installment of term loan. So the average debt service coverage ratio should be equals to or greater than 1.5, which states that there is a good repayment capacity. If it is more than 2, it basically means that there is a very strong capacity, and if DSCR is low in early years, bank may keep smaller installments at first and increase them later. Unit number 24, operational aspect of loan account. In this particular video, we'll understand about interest rate on loan, we'll understand about base rate, system, MCLR, external benchmark rate, what is credit management, what is credit monitoring. We'll understand about some of the common operational terms and aspects in loan functions. We'll look into sample operating instructions and some aspects of a few common loans like education loan, vehicle loan. We'll check your progress and we'll do some practice questions. So let's begin today's session. So managing the lending business in a bank involves many day-to-day activities, and these includes deciding the interest rate for different loans, processing loan application, recovering the money lent, monitoring the loan, managing the loan portfolio, and all these tasks are part of the bank's asset related function. To manage loan properly, it's important to understand these aspects. So we'll understand them one by one. Interest rates on loan. Earlier, RBI controlled the interest rate banks could charge on loans. Later, this was deregulated, meaning banks could decide their own rates, but within certain RBI guidelines. And over time, the system for setting rates has changed. So, from benchmark prime lending rate, it moved on to base rate, from base rate to MCLR, and from MCLR, it moved on to external benchmark. And we'll understand each of them one by one. So, with respect to benchmark prime lending rate, it was used before July 2010, and after July 2010, base rate was incorporated. So, from 1st July 2010, base rate was put into the system. So, before July, banks were using benchmark prime lending rate. One of the problems with this rate, because of which base rate was introduced, is that it lacks transparency. So banks were providing low, were providing the borrowers, the prime borrowers, at loans which is lower than the market rate. So for suppose if they are offering loan at 8%, to these prime borrowers they are offering loans to 7%, and this was not acceptable to the RBI. So this system was not that transparent, so it lacks transparency, and hence RBI formed a committee headed by Shri Deepak Mohanty to review this benchmark prime lending rate. Now, this committee found that the bank offers often gave loans below this to certain customers below this benchmark prime lending rate, and it lacked transparency, and hence base rate system replaced this prime lending rate. Now the features of this base rate, let's understand the features. Just give me a minute. Says, so this base rate wasn't put in place from 1st July 2010, and it remained in the system till 31st March 2016. So all floating rate rupees loans sanctioned or renewed between 1st July 2010 and 31st March 2016 had to be linked to the base rate. So each bank could have only one base rate. And how are they calculated? So base rate were based on average cost of funds, marginal cost of funds, or other reasonable and transparent methods. So if using deposit rate as the base, the chosen deposit period must have the largest share in the bank's deposit, and once finalized, the calculation method could not be changed for at least 3 years. So the calculation of the cost could be could use average cost, marginal cost, any other reasonable method using card rate. So the largest deposit, and once finalized, the method could not be changed for next 3 years. Now this loan exempts. There are many loans which were exempt from the base rate, but before that, let's understand about the review and the transparency. So bank had to review the base rate at least every quarter. So it has to be reviewed quarterly, and the base rate had to be made public. So why it was introduced? To bring transparency, and that's why this rate has to be made public. And no other loan except the exempted loans could be given below the base rate. Now, what are the exempted loans? So, DRI advances, the loans which are provided to weaker sections under differential rate of interest scheme. So, loans to weaker section, it is exempted. Then loans to the bank's own employees and retired employees, to the meaning to say the staff loans, loans against a customer's own deposit in the bank, loans with government interest rate subsidy, and loans where refinance is availed. So these are exempted from this base rate system. Now, how base rate was calculated? So it included interest rate on retail deposits with 1 year maturity, and it is adjusted for CASA deposits, current account, savings account deposits. Second, adjustment for the cost of keeping CRR and NSLR, which does not earn interest, a portion of bank's overhead cost, and average return on the bank's net worth. So, base rate included all these components. So, it included interest rate on retail deposit, adjustment for the cost of keeping CRR, SLR, and a portion of bank's overhead cost, along with average rate on the bank's net worth. Now, the spread in the base rate, what is the spread rule? So, the extra interest charged to existing borrowers could only be increased if the borrower's risk profile got worse, or if there was a change in the tenure premium. Now, tenure premium changes had to be uniform for all loans with the same remaining time to maturity, and it should not be specific to one borrower or one loan type. So, no discrimination or no differentiation should be there. MCLR, marginal cost of funds based lending rate. So before 2016, banks used the base rate system to decide the minimum interest rate for the loans. In December 2015, RBI changed the rules and introduced MCLR from 1st April 2016. So all new floating rates from this date onwards must be linked to marginal cost of fund based lending rate, in short MCLR. Now, who it applies to? So, it applies to scheduled commercial banks except RRBs, small finance banks, and local area banks. And it does not apply to foreign branches of Indian banks. Keep that in mind. So, it is not applicable on the foreign branches. Every bank must have a clear written policy on how the bank decides interest rate for the loan. So, there are particular interest rate rules under MCLR. Okay. So there are particular interest rate rules. First being the bank policy. So every bank must have a clear policy. Secondly, floating rate loans, all floating rate loans must be linked to benchmark set by RBI. Benchmark set by RBI. So banks can give loans at fixed or floating rate, and the floating rate is linked to this benchmark. For floating rate calculation, the benchmark rate plus spread, meaning to say extra percentage based on factors of risk, is to be provided. the benchmark rate must be clearly written in the loan agreement, and fixed rate loans which are less than 3 years, they cannot be given below the benchmark rate for the similar period. Interest rate calculation is done on the month-on-month basis. Final interest amount is rounded off to the nearest rupee. Interest rate for small loans must be fair considering bank's cost and reasonable profit. And if one bank's take over another branch, customers should not be disadvantaged. They can stay with the old bank or shift to the new one. So, customer was given the choice, and there should be no lending below the benchmark, which was the case in BPLR. So, there should be no lending below benchmark in MCLR for any loan linked to that benchmark. A bank must have a fair policy, and penalty only for reasons like repayment delay or not submitting required documents could be uh, applied. For priority sector loans, for priority sector loans up to 25,000, no penalties allowed. Now, let's understand about the components of MCLR. So, there are particularly four components. Marginal cost of fund, it is based on the cost of new borrowings and returns on bank's net worth. Then there is negative carry on CRR. So, it is a loss for keeping mandatory cash reserves that does not earn interest. Then operating cost is there, expenses in giving loans, including fundraising cost and tenure premium, extra charges for longer term loans, same for all borrowers with same tenure. There are multiple MCLR. It is based on tenure premium. So bank must publish at least overnight MCLR, 1 month MCLR, 3 month MCLR, 6 month MCLR, and 1 year MCLR. So they may also publish longer maturity MCLRs. So at least these five need to be published. And there is a monthly review. MCLR for all maturities must be reviewed and published monthly on a fixed date. Now, the spread over MCLR include business strategy spread and credit risk premium. So, the spread includes business strategy spread and credit risk premium. So, business strategy spread, it is based on market competition, liquidity, product features, and credit risk premium is based on borrower's credit rating, relationship, collateral, etc. If there is a change in spread for existing customers, spread can only be increased if credit risk goes down, meaning to say credit risk worsens. So basically, if their credit score goes down, so there is increase in credit risk. If there is an increase in credit risk, then there can be a change in spread. And loan agreement must mention the benchmark rate and the reset interest reset period, which should be lower than 1 year. And for specific maturity, all loans linked to MCLR must be above or equal to it. So there should be no loan below MCLR. So no lending below applicable MCLR for that tenure. Exemptions from benchmark based interest rate. So some loans are not required to follow the RBI rules on linking interest rate for to internal or external benchmark. So these are government special scheme loans. So if the government of India has created a special scheme where interest rates are fixed under the scheme, bank must follow that rate. Secondly, restructured packages. So if there is any restructured package, loans like working capital term loan, is a restructured package. So, loans like working capital term loans or funded interest term loans given as part of loan restructuring plans are exempted. Refinance schemes are exempted. So, if loans are given under government or government undertaking refinance schemes, the interest rate fixed under the scheme will apply for the portion covered by refinance. For the remaining portion not covered by refinance, normal base rate or MCLR or external benchmark rules apply. Then loans to banks' own depositors against their deposits. So loans to depositor against their own deposit or staff loans, loans to bank employees, loans given to CEO, whole-time directors, loans directly linked to market-based external benchmark, or fixed rate loans with a term of more than 3 years. They are all are exempted. Kindly note for hybrid loans, which are partly fixed and partly floating, the floating rate must follow the MCLR rules. For fixed rate loans up to 3 years, the interest rate cannot be less than marginal cost of fund, negative carry on CRR, operating cost, and tenure premium for that maturity. External benchmark, the RBI's internal study group found that MCLR2 had some issues. So it recommended linking some loans to external benchmark, and it is applicable from 1st of October 2019. So all new loans uh, which are floating in nature, be it personal or retail, and loans to MSMEs. So all loans which are personal or retail in nature, or loans to micro and small enterprises. So this was applicable in 2019 and 2020. Medium enterprises were also included. So it is basically loans to MSME. So all new floating rates, personal or retail loans and loan to MSMEs must be linked to either RBI policy repo rate, 3 month Government of India Treasury bill yield, which is published by FBIL, 6 month Government of India Treasury bill yield, or any other market interest rate, which is published by FBIL. Banks can also offer external benchmark linked loans to other borrowers, and for one loan category, a bank must use the same benchmark. So it cannot mix different benchmarks in same categories. Keep that in mind. So it is here uniform benchmark for each categories. Existing loans under MCLR based rate or BPLR will continue until repayment or renewal. If a floating rate borrower can repay without charges, they can shift to an external benchmark without any extra cost. So the new interest rate must be the same as a fresh loan of that type. Other borrowers can also switch, but only on mutually agreed terms, and the change will not be treated as closing the old loan. So keep that in mind. Now let's discuss about credit management. Credit management is how banks and financial institutions handle the entire loan process, from checking if a borrower qualifies, approving the loan, giving out the funds, and the monitoring and recovering it. So here the credit includes short-term loans and advances, medium and long-term loans, and as well as offshore off balance sheet transactions. So these off balance sheet transactions like guarantees, letter of credit, so they are also included under the expression credit, right? So off balance sheet transactions like guarantee, letter of credit. So these are also included in the expression credit. So the process includes 5 stages. First is pre-sanction appraisal, from studying the borrower's need, repayment capacity, and risk factor before approval. Then sanction official loan approval. This is first. This is second. The third is documentation, preparing, signing legal papers, protect the bank's right. Fourth is disbursement, releasing the funds to the borrowers. And fifth, being post lending supervision. So, regularly monitoring the account to ensure repayment and detect risk. The Key areas in credit management includes capital adequacy norms, so making sure the bank has enough capital to handle its risk. Then risk management and asset liability management, so balancing what the bank owns and what the bank owes. So this is balance between what the bank owns and owes, right? Then we have exposure norms limiting how much can be lent to one borrower or group. Risk based pricing is there, charging interest based on risk and rating the borrower's credit worthiness. Asset classification, income recognition, provisioning norms, classifying loans like standard, NPAs, and deciding when to recognize income and setting aside money for bad loans. And loan review. So, loan appraisal, decision making, loan review to evaluate loan proposals and reviewing existing loans regularly. Credit exposure guidelines. So, credit exposures means total amount. So, this exposure means total amount, and it includes fund based as well as non fund based exposures. So fund based, like when this actual flow of funds from the bank, like actual loans are given, term loans, working capital loans, and then there are non fund based credit, so where the amount has not been released from the bank and it will be released when a condition will be met, so like guarantees, letter of credit. And it also include investment exposures, so investment in securities, underwriting, etc. And how are these calculated? So take whichever is higher between the sanction limit and amount outstanding. And for fully drawn term loans where no money more money can be withdrawn, only the outstanding is counted. uh, there's exposure limits to single and group borrowers, and are as per RBI's large exposure norms. For single counterparty, maximum exposure can be 20% of bank's tier 1 capital. For group of connected counterparties, maximum 25% of tier 1 capital. For NBFCs, for single NBFC, excluding gold loan companies, maximum 20% of tier 1 capital. For a group of NBFCs, 25%. And for gold loan focused NBFCs, then there are separate RBI ceiling which applies. So for gold loan NBFCs, exposure can be higher as per regulatory ceilings. There are separate RBI ceilings which apply to them. Then exposure to industries and sectors. So bank can set their own internal limits for different industries like textile, tea, jute, etc. So they don't put too much money into one sector. Um, for specific category exposures, we have unhedged foreign currency exposure. So bank must have board approved policies for loans in foreign currency, and loans for export may be exempt from some hedging requirements if receivables cover them. So they must have board approved policy for USD 10 million and above. Banks must have. So this is mandatory and not optional for the banks. Real estate exposure. So banks should set board approved limits and rules for lending to real estate, including special economic zone projects. Then we have leasing, hire, purchase, and factoring. So exposure to each activity should not be more than 10% of total advances. Then we have joint ventures, wholly owned subsidies. So loan or credit allowed up to 20% of bank's capital fund, again subject to RBI's guideline. Then we have loan review mechanism. So credit audit is there. This credit audit is a systematic check to ensure loans are handled properly according to bank and RBI's rules, both before and after sanction. Now the objective is to improve loan portfolio quality, to review big loan sanction and their compliances, to check regulatory compliance, to provide independent credit risk assessment, to provide uh, to provide independent assessments to detect early warning signals of possible defaults and to recommend corrective actions to improve processes and staff skill. Now, what are the functions of credit audit department? To analyze audit findings and inform relevant departments, to follow up with controlling authorities, to update top management on issues, to close reports after corrective action is taken, and to maintain record of all audited loans. Now, scope of review. So, key activities include portfolio review, loan review, and there are some action points. So, with respect to portfolio review, you assess overall loan quality. Overall quality is assessed and you avoid over concentration in risky sectors. With respect to loan review, you check all large loans and a sample of smaller ones. You review new loans with 3 to 6 months of sanction. With respect to action points, you check policy and RBI compliance. You verify documents. As a bank, you assess credit risk. You check how accounts are being monitored. Identify irregularities and early warning signals. The review frequency depends on the type of risk. If it is a low risk account, then once a year. If a medium risk, every 6 months. And if the account is high risk, then every 3 months the loan should be reviewed. So reviews also examine whether policies and reporting systems are adequate and they predict the potential future risk. So review covers regulatory compliance, procedures, practice, credit risk assessment methodologies, systems, exception handling, and staff credit administration. Let's talk about credit monitoring now. So, credit monitoring means regular and continuous checking of loans by the banks to make sure the borrower is doing well financially. Loan money is used only for the approved purpose. The bank's money is safe and not turning into an NPA, and all agreed terms are being followed. So it is not a one-time check, but it is a continuous exercise. So it is a continuous supervision. It is a continuous exercise for the whole loan period. Uh, let's talk about some key features. So, the supervision of the loan account. So, review the borrower's account and their business performance regularly. Again, it is a continuous process. Starts after loan sanction and continues till full repayment. You focus on the quality and you keep the loan as a standard asset under RBI's income recognition and asset classification rules, and you ensure borrowers stick to agreed terms and conditions. So, when a bank sanctions a loan, it sets covenants. Covenants means conditions to keep track of the borrower's health. So, common covenants includes stock statement. So it is detail of goods in stocks, receivables, book dates, monthly select operational data, QIS 1, quarterly information system 1, 2 quarterly information systems, half yearly statements, annual financial statements, and then there are special clauses like a negative lien. So borrower promises not to mortgage a certain property without bank's consent. So, why bank monitor loans? What are the goals? To avoid NPS, early problem detections to reduce the losses. Again, then there are no diversions to unrelated activities. You check performance versus the projections. You compare actual business uh, to what borrower promised. Then to spot early warning signals like sales dropping, stock piling up, delay in creditors' payment to avoid time and cost overruns, especially in projects, and to take timely actions to help revive the business or to recover the loans. Then there are certain parameters bank keep a close eye on, like asset transactions, stock levels, valuation of stock, performance indicators, and financial ratios. Um, so, for account transactions like are deposits and withdrawals matching the borrowers production and sales? Do actual stock matches the estimated given during the loan application? So, for valuation of stock, whether it is in line with the market practice, market price, or the cost price with the bank, like performance indicators like sales, profit, debtor days, creditor days, and for financial ratios. So, for example, maintain a minimum 1.33. For the current ratio should be greater than 1.33, except for exports or unit new units. Then the monitoring progress is there. Like earlier, the heavy focus was on physical inspection or verification, but now it is done mainly through periodic statements, use of computer generated exception reports to highlight unusual transactions, and physical stock inspection only as a supplementary check. Now, how stock analysis helps? So, high finished good stocks, it could mean slow sales or poor quality products. High raw material stock, it may indicate poor inventory management, and if there is a wrong or inconsistent data, so it could be due to deliberate hiding of facts or poor record keeping. So, regular discussions with borrowers about unusual findings will help to correct the problems early. There are certain challenges in monitoring. So, for first, let's talk about the challenges. Then, if covenants are broken, we'll talk about the event of default. So, what are the challenges? So for big companies with a large stock spread across multiple locations, physical checks are really time consuming, and banks rely more on financial reports and ratio monitoring for such cases. Now, what if the covenant are broken? So the conditions are not met. What about the event of default? So if borrower fails to follow agreed terms, the bank can increase the interest rates, say from 10% to 12%, demand reports more frequently, or the bank can order a stock audit and can recall the loan, meaning to say ask for repayment if the violations are serious. Now let's talk about tools, monitoring tools which are used by the bank. So there are some common or regulatory tools, the primary tools. So first being you scrutinize through operations, through reports. So automated reports in the bank system detect unusual transaction. Example, say large cash withdrawals, frequent checks, frequent check returns, sudden fund transfer to unrelated parties. So exceptional reports are generated in these cases. Then we have stock statements. So borrowers periodically submit details of inventory. It helps to ensure that stock levels are sufficient, stocks are marketable, and they match loan security requirements. Then there are inspection and field visits. So physical inspection of borrower premises are conducted, and it checks the actual stock with the reported stock, the condition of machinery, and whether the factory is operating normally. Then we have audit reports. So it can be stock audit or receivable audit. So to verify physical inventory and to check outstanding payments for the customer. So stock audit is for verifying physical inventory, and receivables audit is to check outstanding payment for customers. QIS, so quarterly information statements and half yearly statements. So it covers sales, production, expenses, and profitability, and it is used for tracking performance against budget. So it is used for tracking performance against budget. Then we have annual reviews or renewal or accounts. So it is done every year to decide whether to continue the loan, to continue the loan, to change the loan limit, and to change repayment terms. Then we have additional supplementary tools like certified statements of actual cost versus projected cost. So for project loans, actual expenses are compared to the original cost estimates, monthly cash budgets to monitor expected cash inflows and outflows. So it is used for seasonal industries. It is used for seasonal industries. Uh, Credit audit reports are uh, used for primary. So there are credit audit reports as well, which are used in primary. Then we have GST tax returns, so used to verify actual sales turnover and tax compliance. Market intelligence is there. Informal sources mainly, so like suppliers, customers, industry reports. RBI inspection reports are there. So RBI checks banks' own monitoring and points out deficiencies. Consortium minutes meeting are there. So when multiple bank finances the same borrower, they share updates and concerns. Steps in credit monitoring. So first there's early warning. There are early warning inspections. So in early warning and in identification, a loan overdue for 2 months signals risk. So bank identifies potential NPAs and they investigate. After identifying, they try to understand the cause. So whether there is a temporary liquidity issue. So example, say there's delay in customer payments, or is there any structural problem like declining sales, obsolete technology, etc. Once they understand the cause, they try to give the immediate response. So if there's temporary issues, so they give ad hoc limits like temporary loan increase, and if there is permanent issue, they work on restructuring or recovery. Then they do transaction monitoring. So they basically investigate any suspicious transaction. They investigate large cash withdrawals, if there are checks to unrelated parties, if there's any mismatch between withdrawals and stocks. Field level monitoring is done. So there are frequent factor visits, cross checks stock statement with actual stocks. Interest and repayment tracking is there. Like interest should be collected monthly. If there is any delay, immediate follow-ups should be taken. Documents and security monitoring is done to ensure legal documents are updated and conduct legal audit. Then we try to rectify the irregularities, fix issues which are pointed by concurrent auditor, statutory auditor, credit audit. Information gathering is there to track every media coverage of borrower. You check borrower's account with other banks and exchange information consortium meetings. Preventive actions are taken. Take steps to stop downgrade of good accounts into NPAs. We do scrutiny of statements. So banks look for sales. Look, you compare actual sales with the budgeted sales. If there is any large deviation, then it calls for an investigation. If COGS, cost of goods sold, increases beyond estimates, you check for raw material cost change or inefficiencies. You compare the operating profit from the current operating profit with the previous year. And if there's a drop in profit margin, then it's a red flag. profit before tax are scrutinized. So if there are any sudden changes, then it requires explanation. Inventory and receivable should not grow disproportionately. For statutory liabilities like PFs, dues, GST, they must be cleared. Pending dues can outrank secured loans during liquidation. So it has to make sure that all the statutory liabilities are cleared. And then any large purchases, any fixed asset investments, they require bank approval. Now let's understand about QIS returns, quarterly information systems. So for loans of 1 CR or above, 1 crore or above, QIS one statement should be submitted before quarter begins. So it forecasts sales or production, it compares liability with CMA data. For QIS 2, you compare, it is submitted 6 weeks after. This is before quarter. This is 6 weeks after quarter. So, submitted 6 weeks after quarter ends, it compares actual performance versus QoS. One estimates uh, any deviation of more than 10% must be explained, and you check for current ratio. QoS 3 should be submitted 1 month after half yearly ends, and it compares half yearly sales versus annual budget, and you check for net fund generation. Then there are annual reviews. You compare actual results with the projections. You review repayment history. You consider request for limit increase, and if there are any high risk accounts, are to be reviewed quarterly. CRILC, it is Central Repository of Information on Large Credit. It is maintained by RBI to track large exposures across banks, and the purpose is to detect over leveraging and to identify common borrowers between the bank. So it is basically to detect over leveraging. A reporting threshold is 5 CR and above. So 50 million is equivalent to 5 crore, and the reports are to be made monthly. For large credit, for defaults it is to be done weekly. Red flagged accounts are to be reported, and non-cooperative borrowers also should be reported. It includes SMA2 accounts and current account balances above 1 CR. CERSI, Central Registry of Securitization, Asset Reconstruction and Security Interest of India. It is government-owned database of all security interest. It prevents same property being placed to multiple banks, and it covers securitized transactions, asset reconstructions, and mortgages. So it is established under SARFAESI, and the main purpose is to prevent multiple lending against the same asset. Common operational terms, so end use of funds. So when a bank gives a loan, it must make sure that the money is used only for the specific purpose it is approved for. This is not just good practice, it's a part of bank's duty to manage risk and follow RBI guidelines. So bank monitors fund flow by checking invoices, conducting site visits, verifying that withdrawals from cash or credit or overdraft account matches the approved purpose. Primary and collateral securities. So, primary security is the main asset linked directly to the loan. It could be the asset bought with the loan money or any asset offered for the loan. A collateral security is the extra or backup security given to the bank to reduce the risk. So, if the borrower defaults, the bank first claim the primary security, and if that's not enough, then the bank will go to the collateral security. Personal security of guarantor. So this is when a third party, the third person, promises to pay the borrower's due if borrower's default. So no asset is directly placed here. It's a personal commitment. If the borrower fails to repay, the bank can sue the guarantor in court to recover the amount. So a contract of guarantee is there, and we'll study contract of guarantee in the coming units. Fixed and floating charges. So fixed charges are created on a specific and identifiable asset like a specific machine or a building. The borrower cannot sell or dispose of the asset without the bank's written permission. Floating charges cover assets that changes frequently, like stock in trade, raw material, trade receivables, and the borrower can use, sell, or replace these assets in the ordinary course of business. So, if the borrower defaults or the bank enforces its security, the floating charge crystallizes into a fixed charge. Margin. Bank usually finances only a part of the asset's value, keeping a certain percentage as margin. So, this margin is the borrower's contribution and it acts as a cushion for the bank. For example, if machine costs 10 lakh rupees, the bank keeps a 20% margin. So, the bank will lend 8 lakh rupees and the borrower must arrange for the remaining 2 lakh rupees. Refinance. So, sometimes bank borrows money from specialized institutions to provide loans in certain priority areas. So, major refinance provider in India includes Exim Bank, NABARD, SIDBI. So this is for small industries and MSMEs, for agriculture and development loans, and for export and finance. So even if a bank takes refinance, it still bears the full risk of repayment. So refinance does not influence whether the bank approves a loan or not. Credit risk management. So credit risk is the possibility that the borrower will not pay the loan as agreed. Banks have detailed policies to identify measures and control this risk, like setting lending limits, evaluating credit history, credit exposure norms. So RBI sets limit to avoid excess lending in one borrower or group. So this prevent concentration risk. So bank may also set sectoral risk, like cap on total lending to the steel, power sector to ensure diversification. Operational process of handling loans. Receipt of loan application. The process starts when a customer applies for a loan, either in bank standard form, a letter, or online. So the bank records the application in the loan application received register or in its software system, and all necessary supporting documents are collected, like ID proof, income proof, project reports, etc. Step 2 is the assessment of viability and creditworthiness. Once the application has been received, bank evaluates whether the loan proposal is sound by checking promoter's profile, industry comparison, existing loan accounts, technical feasibility, availability of inputs, security offered, financial health, credit checks, cash flow capacity, regulatory restrictions, so on and so forth. Each bank has sanctioning powers at different levels depending on the amount, customer, and type of loan. So, higher value loans are often sanctioned by loan committees instead of individuals. And if approved, the bank issues a sanction letter long term, detailing the loans and the condition. Once the loan is sanctioned, it is ready for disbursement. So, borrower accepts terms and signs the required documents. The bank creates and registers its charges over borrower's assets with authorities like Registrar of Companies, SERC, RTOs, Land Record Authorities. So for company asset, it is ROC. For securities interest, it is SERC. For vehicles, it is RTO. For mortgages, it is Land Record Authority, and only after these legal formalities are completed does the bank releases the fund. Once the funds are released, bank monitors and supervises. So inspections are there, regular visit to check funds are being used for the sanction purpose. Borrowers has not borrowed for other for from others without the permission. No asset has been sold or bought without bank consent. There is no misuse of short-term funds, and you review the account. So you regularly analyze the sales, the production, the profit, the cash flow. If problems are spotted, banks may ask for extra security or documents. Then there are renewal of advances. So whether it's a term loan or fixed loan, so term loan does not need renewals but are reviewed for health, and working capital loans are usually sanctioned for 1 year and they require renewal. So renewals can be at the same uh, or reduce or increase limit depending on the borrower's performance. Accounting aspect of loan products. So when a bank gives a loan, it follows double entry bookkeeping. Every debit must have a matching credit. So there are the types of loan accounts include working capital, OD, and then there are other loans. For working capital, these are running accounts where the borrower can deposit and withdraw money multiple times as long as they don't go over the approved limit. The limit is based on the sanctioned amount or the drawing power. For other loans like term loan, they are disbursed once or in fixed installments, so they are not running accounts, and repayment starts as per the repayment schedule. It is usually monthly EMIs. So whenever a loan is disbursed, you debit the customer's loan account because the bank is creating an asset, the amount which is owned by the borrower, and you credit another account with the same amount. The type of account credited depends on how the money is given. For example, if the loan is given in cash, then the cash account will be credited. If it is credited directly to borrower's account, then the customer's current or saving account. And if it is paid directly to the seller or service provider, then the third party or the vendor account. Also, there are special rules for term loan. If it is for purchasing goods or services, you have to pay to the supplier directly. And if it's for refinancing, then the money can go to the borrower's current account, cash credit or OD accounts. Loan repayment. So when the borrower repays the credit, you credit that loan account to reduce the outstanding balance, and you debit the account from where the repayment is made. So you debit the account from where the repayment is made. For example, a cash account if repaid in cash. If repayment comes from borrower saving or current account, you debit the deposit account. And if repayment is via check from another bank, then the clearing account is debited. There are multiple modes of repayment. For example, check, cash, electronic transfer, automatic debits are there in NCH mandates. So borrower authorizes the bank to auto debit their accounts periodically from EMIs. So why this NCH is important? So it avoids missed EMIs and saves the bank from a manual follow-up every month. Basic operating instructions. So operating staff should be aware of every step from application to recovery. So they should be aware of bank's loan policy, the type of loan product, whether it's a home loan, personal loan, business loan, uh, who can apply, what is the eligibility criteria, the age limit, the income requirements, the application forms, like specific form for each loan type. What are the required documents? The ID proof, address proof, income proof. What is the loan appraisal method? What are the margin requirements? Uh, what should be the borrower's own contribution? Then what is the repayment period? What are the processing fees, interest rate? So what are the charges and rates? Legal formalities, security management, disbursement procedures, loan account maintenance, and how do we monitor follow up? What are the RBI guidelines on lending? So they should be aware of all of this. Operating manual. So every bank has a loan and advance operating manual for its staff. So it covers principle on credit, loan policy, regulatory legal framework. So RBI guidelines like Contract Act, SARFAC, Stamp Act, and why it differs from bank to bank. So because each bank has a different risk appetite, each bank offer different loan product, and each bank has its own standard document and processes. Now let's talk about sample of operating instructions. So advance against goods. Let's talk about advance against good first. So the guidelines includes uh, goods which are used as securities should not be perishable. They should be easily marketable. They should have prices that are easily available in the market. Should be stable. Should be in good conditions. Um then they should fully belong to the borrower. Advance is usually given against hypothecation rather than pledge. So, what is pledge and what is hypothecation? So, banks take physical possession of goods in pledge. Uh, they are more secure. In hypothecation, the borrower keeps the goods. So, bank has a legal charge over them, but the goods stays with the borrower. So, banks take margin requirements. So, when lending against goods, bank don't lend 100% of the goods value. They deduct a margin to protect against price drops and risk of goods losing value. So typically, 25 to 30% of the margin is taken, and for certain commodities, as per RBI's instruction. So the drawing power is arrived at after deducting the margin. So value of stock minus margin equals to drawing power. So it is value of stock minus margin. And the safety of the loan depends on the value of the goods and how easily they can be sold. So, always value goods at the lower of the cost price or market price, or invoice value or market value. So, whichever is lower, you value the goods at that price. From traders, you take the invoice or the market price, whichever is lower, and for manufacturers, for raw materials, you take the cost price or invoice price, whichever is or the market price, whichever is lower. For work in progress, it is cost of manufacture. For finished good, it is cost of sales. So if borrower values stock lower than these rules, we accept the borrower's lower value. For small manufacturers where cost is hard to calculate, use the market value minus profit margin and trade discounts. We keep our daily market price register for all goods taken as securities. And if branch manager is not confident about valuation, he or she hires an expert valuer and cost of valuation is charged to the borrower. Storage and securities. So, go down signals are there, but before that, we need to understand one more thing, marketable indicator. So, a good indicator is a stock turnover, how quickly goods are sold and replaced. You check for stock statements, you ensure all stocks items move and not just few items which are sold in the market. Again, if there's slow movement, the risk of unsellable stock is there. And for agriculture goods, loan must be liquidated by end of season, and carrying stock to next season needs investigation. Storage and security. So you place a sign at the go down entrance, and the purpose of the sign is that you inform the public that goods belong to the bank, and you prevent others from buying them without the bank's consent. Insurance should be there. Goods must be insured against fire, burglary, riot if needed, war or emergency. So insurance it is very important. Full market value insurance should be obtained. It is essential. Insurance policy must be in the bank name. And insurance policy should have a bank clause. If borrower already has insurance, the policy must be assigned to the bank. And in case of accident or fire, you inform the insurance company and sanctioning authority immediately, and you file the claim quickly. Now, we have some go down requirements that the go down should be within municipal and panchayat limits so that it is easy for inspection. It must be secure, well built, it should be leak proof, the doors should be strong, there should be no termite risk. Ownership proof should be there if it is owned by the borrower or whether it is rented. For hypothecated stocks, borrower must submit stock statements regularly, and the statement is late, not clear borrower's check until it is submitted. As simple as that. For stock statement, it must be signed by the borrower and should be checked by the staff for quantity, value, and for the correct calculations. Abnormal purchases, if there are any, they must be investigated, and good valuation in statement must follow the valuation rules. Inspection should be monthly or quarterly as per the sanction terms. The purpose is to ensure that goods are real, in good condition, covers the loan amount. For consortium loans, the controlling branch inspects overall stock and other branches inspect stock in their location. At the time of inspection, you have to check for certain things like borrower's legal ownership, stock is as per stock statement, physical verification matches, the record, go down is safe and suitable, the signboard should be displayed, loan account is in good condition, insurance terms are followed, and stock movement is there. What is the age of good, accessibility of go down, who has the go down keys, whether the rent is paid on time, so on and so forth. So these things are to be checked. Advanced against warehouse receipts. Banks can give loans to customer by taking warehouse receipts as security, but again, some certain rules have to be followed. So the safest receipts are those which are issued by the government warehouses, central or state, doesn't matter, but they are considered as the safest receipts. So these are automatically accepted. And receipts from private warehouses are not accepted unless the bank has formally approved that private warehouse. A reason being government warehouses are regulated. Private ones may not be reliable unless they are verified. So that's why we do not take private warehouse receipts. There are RBI rules for certain goods. So some goods fall under selective control, credit control. So RBI imposes special lending conditions to prevent holding or speculation. The warehouse receipt is for such goods. The bank must follow RBI's current rule before lending. Uh, Warehouses are classified into four grades: grade 1, grade 2, grade 3, and grade 4. So grade 1 is of good quality, 2 is fair, 3 is average, and 4 is poor. So only grade 1 warehouses are allowed. So good quality warehouses which are classify goods into grade 1 goods, only for those good qualities loan is allowed. The receipt should be recently issued to avoid lending against old or possibly spoiled goods. The receipt must be in the name of borrower's name, and again, there are negotiable and non-negotiable warehouse receipts. So, negotiable warehouse receipts are those which can be transferred from one person to another, and non-negotiables can be transferred through a separate letter and only becomes valid when the warehouse is notified. So, bank does not give loans against non-negotiable receipts because the rights are not automatically transferred, and hence no advances against non-negotiable receipts. A borrower who must be the original depositor must endorse the receipt to the bank. The receipt must be describe the goods clearly. There should be detailed description. The borrower must give letter confirming that the warehouse receipt is genuine. Borrower must send a letter to the warehouse telling them the receipt is pledged to the bank and the bank has a lien on the goods, and the bank itself must send a notice to the warehouse confirming the pledge and the lien over the goods. Then physical inspection should be there. So before approving the loan, the bank should physically inspect the goods which is stored in the warehouse. Sample bags are whenever available, so samples are taken. Insurance requirement is there. So government warehousing rules require goods to be insured by the warehouseman. The bank should ensure that the goods are insured for full cost price or market value, whichever is higher. And the insurance policy details are obtained and recorded in the bank books. Authorized signatures So the bank should give the warehouse a list of specific signature of the manager and other authorized officer who can sign delivery orders and discharge warehouse receipts. Ongoing monitoring. After the first inspection, the bank should do periodic inspection of the goods in the warehouse to ensure that they are still there, the quality and the quantity has not reduced, and no damage is there. Now let's talk about certain operational aspects of a common loan products. We'll cover two loan products here: education loan and vehicle loan. So education loan, the purpose of this loan is to help poor and needy students to get basic education and to help bright students pursue higher professional or technical education both in India and abroad. So normally bank lend within their service area, and for education loan this restriction does not apply. Students can apply from anywhere. Indian Banks Association issues model guideline for these loans, but each bank can make changes as per their own policies. So I hope the purpose is clear. Now, with respect to eligibility, the student must be an Indian national. PIOs can get loans for studies in India only. So, if a person is of Indian origin, he wants to study in India, he or she can get education loan. And for students who the loan will follow FEMA rules for the PIO students, especially regulation 7C. Keep that in mind. Regulation 7C of borrowing and lending in rupees regulation and amendments for NRIs, PIOs, OCI students. Co-applicant must be permanent resident of India. If parents are also NRI, PIOs, OCIs, then in that case, another co-applicant who lives in India permanently will be required. For with respect to admission, must have the student must have secured admission to a recognized higher education course in India or abroad through entrance or merit basis. So, for merit, admission to the courses should be through a fair and recognized merit process. For professional technical courses, entry should be via common entrance test. For credit worthiness, most students will do not have credit history. So bank will treat them as credit worthy. If the student has a bad credit record, the bank may apply extra conditions depending on its risk policy. Classification. So bank may group education loans into three categories: student in top rated institutions, student going studies for abroad, and students in other domestic institutions. So the terms may vary depending on the risk, reputation of the institution, and job prospects after the study. The courses covered include all the major courses from India and abroad. So professional courses, recognized graduate, postgraduate diploma courses, courses at reputed institutes, courses under government subsidy schemes, job-oriented graduation or post-graduation courses, special professional qualifications, so all of them are included. Eligible expenses include college fees, library exam fees, book fees, uniform fees, caution deposit, building fund, travel, computers if it is essential for the course, insurance premium for the student borrower, and any other course related projects. So all the course related projects are more or less included. Quantum and margin. So need based financing should be there for up to 4 lakh rupees. No margin is no margin is required for 4 to 7.5 lakhs. 5% margin is required in India and 15% in abroad. And for loans above 7.5 lakhs, the margin is decided as per bank discretion. The scholarship and assistance should be counted towards margin. Margin can be bought in each year in proportion to the disbursement. With respect to security requirements, no security is required for loan up to 4 lakh rupees. For 4 to 7.5 lakhs, third party guarantee may be waived if parents or guardians have strong financial standings, and if loan is for computer purchase, it will be hypothecated by the bank. for 7.5 lakhs and above, the collateral is at bank's discretion. Sanction and disbursement. Loan sanctions are as per bank's power, ideally by branch near the student's home. No loan application should be rejected without approval from the higher authority, and disbursement will happen in each state directly to education institution or the vendor for any equipment or books. So to the institution or the vendor. Repayment terms. So a moratorium, the repayment holiday is course period plus 1 year. Repayment in EMIs over 15 years. So excluding study plus moratoriums, this 15 years is counted. In some cases, repayment can start small and increase over the time. Insurance. So bank may require a life insurance, credit life or personal accident policy for the student. Bank should regularly get progress report from the college or university. For foreign students, social security number details, Aadhaar, employment updates must be recorded. Aadhaar number should be noted once available. Student must submit job details after completing the course. No processing fees or upfront fees for is required for loans up to 7.5 lakh rupees, and for loans above 7.5 lakhs, the bank can decide. Capacity certificate, capability certificate. So basically, bank can issue financial capability certificate for students going abroad, because some universities require proof that sponsors can cover cost until the course is completed. Now let's talk about vehicle loans. So vehicle loan is money a bank gives to buy a new or used car, which can be repaid in monthly installments. So you can take loans to buy a new car or a used car, doesn't matter. SUVs, MUVs, two wheelers, not for commercial vehicles like trucks or buses in this case. These are non-commercial. Keep that in mind. So who can apply? So business people, traders, professionals, firm, companies, individuals, or they can apply. But the applicant age must be less than 65 years. So maximum age is 65 years. Certain documents are required, like last 3 years financial statement, last 3 years ITR, vehicle quotation or invoice, salary slips for last 3 months, bank statement for last 1 year, or KYC documents. Loan tenure is maximum up to 7 years or 84 months. Loan amount, so basically loan to value ratio is there. If the vehicle price is less than 10 lakh rupees, then 85% of the on-road price can be given. And if the vehicle price is more than 10 lakh rupees, then 80% of the on-road price is provided. Interest rate is decided by the bank, and with for interest calculation, interest is charged daily on the reduced loan balance, but again it is collected monthly. With respect to security, it is hypothecated. So the bank creates a charge of hypothecation. For charges, uh, processing fees is charged upfront. Again, no penalty for prepayment charges are there. For disbursement, banks give the loan amount directly to the dealer by RTGS or NEFT after all the legal requirements are met, and any government taxes or charges are paid. So, if there are defaults, so bank will remind the borrower multiple times via letter, call, SMS, email, or through recovery agents. If all details and documents are correct, bank must approve the loan within the stipulated time. RBI's guideline on recovery agents. So what happens is banks sometimes hire outside agents to collect money from borrowers who had not paid back their loans. So RBI has set clear rules to make sure that this is done in safe, legal, and respectful manner. So due diligence is there. Basically, before hiring recovery agents, banks must do a proper check on their past records. And when a case goes to a recovery agent, the bank must tell the borrower that the recovery agent uh, has been assigned, and the recovery agent must carry a copy of bank notice, an authorization letter from the bank, an ID card from the bank or the agency. Uh, then the details in the notice are provided. The letter must have the recovery agent's contact number, all phone numbers, public list agencies. So basically, the bank's website must have up to the date details of all the recovery agents. The pending complaints, if a borrower has complained about something, the bank should not hand over the case to recovery agent until the complaint is resolved. There should be a grievance system. So, bank must have a proper system for borrowers to complain about recovery agents. There should be no unlawful practice. This there should be ethical conduct. We need to say no unlawful practice. So, contracts should clearly say that the recovery agents cannot use abusive, unlawful, or questionable methods. Training should be provided to the recovery agents. The calling hours should not be before 8 a.m. and should not be after 7 p.m. They should respect borrowers' privacy. They should handle customers politely. All recovery agents must pass IABF recovery debt recovery certificate course. Banks should regularly check if their recovery process is working well and should improve it. Even if the work is given to an agent, the bank is still responsible for the agent's actions. So there should be no harassment. There should be no threatening calls, no public humiliation, no contacting family or friends to embarrass or sending bad messages uh, or repeated calls at odd hours. Fair practice code. So this is about how the bank should handle the loan request right from the start. For all loans, whether big or small, forms should cover every detail so borrowers know exactly what is required. So there should be comprehensive forms. Uh, the disclosure of charges should be transparent. What is the processing fees, whether any part of the fees is refundable or not, if there is any penalty, what are the prepayment rules. So everything should be there, and the information must be given in writing to the borrower and should be displayed on the bank's website. And when a borrower submits the application, the bank should give a receipt or the acknowledgement. Banks should define clear timelines for approving or rejecting the loan. These timelines must be public on the bank's website, in brochures, on notice boards, and this avoids unnecessary delays. If document details are missing, the bank must inform the borrower immediately for keeping the files ready. And if a loan is rejected, the bank must write to the borrower about the reasons for rejection and the main reason within that given timeline. Loan appraisal and terms. So this is about checking the borrower's ability to repay and finalizing the terms. So proper credit assessment should be there. You should not depend on the collateral. You should check the borrower's actual repayment ability. When the bank approves the loan, it should send an approval letter with all the terms and conditions. All terms decided between the borrower and the bank must be in writing. An authorized bank official must certify them. Loan agreement copy should be there, so the borrower must get a loan copy of the signed loan agreement and all reference documents. Discretionary facilities, so the bank has certain powers, these should be clearly mentioned in the agreement. Also mention that the bank may not increase credit limits without a review. Where several banks lend together, they should finalize appraisal and communicate decisions quickly. With respect to loan disbursement and changes, so once the loan is sanctioned, disburse funds quickly as per the agreement. If interest rates, fees, or other condition changes, the borrower must inform beforehand, and changes apply only to the future payments. Post disbursement supervision. So, for small loans up to 2 lakh rupees, bank should be helpful if borrower face genuine problems. If the bank wants the borrower to repay early or provide more security, it must give reasonable notices. Once the loan is repaid, all pledged asset must be returned promptly. If the bank has another legal claim, it must inform the borrower with full details beforehand before holding back the securities. And then there are certain general principles like banks should not interfere in the borrower's personal or business matter except where allowed by the loan agreement. There should be no discrimination, no biasness based on caste, religion, gender, etc. And bank can still participate in schemes meant for a weaker section. There should be no harassment for recovery, no repeated calls at odd hours, no abusive language, no use of physical force. And if a borrower or another bank asks for a transfer of the loan, the current bank must respond within 21 days, and the bank must have a system to resolve disputes. Complaints should be reviewed at a higher authority than the one who has made the original decision. Unit number 25, types of collateral and their characteristics. So in this particular video, we'll understand about different type of securities like land and building, loan against goods, types of shares, how a person can get a loan against shares, LIC, gold loans, term deposit loans, supply bills, vehicle finance. We'll do some practice questions in the end. So without further ado, let's start today's video. So lending by bank is always associated with risk because there is no absolute certainty that a borrower will repay the loan. The biggest risk for the bank is credit risk, which means the possibility that the borrower will fail to pay back the loan on time. To reduce this risk, bank generally ask borrowers to provide security, some asset or property that the bank can control if repayment does not happen. So when banks give loan, many times the money borrowed is used to create assets such as house, machinery, uh, business equipments. The bank then take those assets as security. If the borrower does not repay, then the bank shall have a cushion to fall upon, and the bank can sell these assets and recover the money. Apart from this, bank may also ask for collateral, which is any other asset belonging to borrower or even a third party. However, not all loans are given against security. So there are unsecured loans as well, which is known as clean loans. So in short, to reduce credit risk, bank take security. If borrower fails to pay, bank simply sell this asset and recover the money. Effectiveness of security. So the usefulness of the security depends on two aspects: economic and legal aspect. Economic aspect is whether the security has a stable and reliable value in the market. If the market price keeps fluctuating too much, or if the asset is not easily saleable, the security becomes less effective. And the legal aspect is whether the bank can legally enforce its right over the asset and sell the security when needed. So security particularly depend on these two aspects. For a security to be a good security, it must meet certain requirements. So it should meet certain characteristics in order to be called a good security. The borrower must be the true owner of the security, so there must be a clear title. Secondly, the asset must be easily identifiable, so there is no dispute with regard to security. So it should be easily identifiable, it should be freely transferable, it should be transferable and free from any legal burden. Ownership should be absolute. There should be no uh, encumbrances involved to it. So the ownership should be absolute and not partial. It must be marketable and have a stable price. It should be easily marketable. Its value should easy to determine. If placed, it should be possible to store it safely, and the asset should be durable and last for a reasonable time. Secured versus unsecured assets. So, secured asset is one where the bank takes security against the money it lends. This security can be in the form of immovable property like land and building, or movable property like vehicle, gold, or stock, or other valuable assets like bonds, shares, insurance policy. So, if the borrower fails to repay, the bank can simply sell the security and recover the money. For example, a person takes a home loan. So, this person goes to the bank and takes a home loan. Now, in this particular scenario, the house itself becomes the security. So, if a business borrows money for machinery, then the money can be placed as security. Uh, Most banks loan in India are secured because they reduce the risk of the loss for the bank. Secondly, is unsecured loans. So, an unsecured loan, as the name suggests, is given purely on the borrower's credibility and repayment capacity without any tangible security. So, here the bank relies only on the borrower's promise and financial strength. Such loans are riskier for bank because if the borrower default, bank has no direct asset to claim. Uh, Unsecured loans are also known as clean loans, and recovery depends on legal action against the borrower, which may not always be effective. Now, which class of loan will be preferred as a bank, secured or unsecured? So, simply, uh, without any doubt, banks prefer secured loans because the borrower's business may fail due to economic factors. If there's no security, the bank may lose its money, and security gives the bank a cushion to fall back on if a repayment fails, and also it acts as a psychological pressure on the borrower to repay since their property is at stake. So, in short, a secured loan reduces credit risk while unsecured loan increases it. Types of security. So there are four types of security: immovable, movable, financial assets, and intangible securities. So immovable property includes land and building. Simply the security which you cannot move from here to there. So land and building, a machinery which is fixed to the ground. Movable assets include goods, vehicles, gold ornaments, crops, etc. Financial assets or actionable claims include receivables, shares, bonds, insurance policy. Intangible assets are those assets which you cannot see or touch, like goodwill, brand value, intellectual property. And for banks, an ideal security should be sellable in the market. It should be easy to value through reliable sources. It should be stable in the price, so there should not be very much fluctuations, and it should be transferable without lengthy legal formalities. Securities can also be classified into primary security and collateral security. So, primary security is the direct asset for which the loan is granted. So, it is the direct asset for which loan is granted. For example, if a loan is taken to buy stocks for business, the stock itself is the primary security. Or for that matter, if an individual takes a home loan, so the house itself is the primary security. Collateral security is any other asset offered additionally either by the borrower or the guarantor. So, a borrower may mortgage his house as security for a business loan. So, in that particular scenario, this house becomes a collateral security. So, this is additional security. Now, let's move on to types of securities. We start with land and building. So the nature of the land and building is not self-liquidating, unlike goods um, or stocks which can be sold quickly in the normal business cycle. Land and building do not automatically generate cash to repay. If repayment fails, the bank has to sell them, which usually involves a legal process. Earlier, banks avoided land and building as security because of difficulties in valuation and legal complexities. But today, with law like SARFAESI, banks can sell mortgage property without going through a long court process, without going through a long legal process, basically. So, making it popular for collateral, especially in corporate loans. The nature of security is mortgage. So, in the next unit itself, we'll understand about various types of securities that can be created in the market, like pledge, hypothecation, um, mortgage, lease. So, we'll understand about those securities in the next unit. Now, what are the advantages and disadvantages of land and building? So first advantage is the value appreciation. Generally, the value of land increases over time due to inflation and scarcity, especially in developing or urban rural areas. Second is traceability. So the land and building will not move. So it is easily traceable. It cannot be moved. Then again, it is a stable security. In most cases, land is strong long-term asset for banks. So it is a stable security. Now let's talk about some of the disadvantages. Like it is very difficult to value a land. A building's worth depend on location, construction quality, age, amenities, surrounding developments. Industrial buildings again depend on factors like machinery, industry type. Since buyer differs in preference, valuation must be done conservatively. So keep that in mind. Whenever we do valuations, we while providing the loan, we do it conservatively, right? Then title verification can be an issue. The borrower must have a clear legal title. In India, succession laws and incomplete land records often create confusions. So lawyer must check documents in the registrar's office to confirm ownership and verify that the deeds are genuine. Then we have income branches. So third party claims can be there. The property might already be mortgaged, disputed in the court, or under government attachment. So banks need an encumbrance certificate to ensure it is free from prior claims. Liquidity is a problem because selling land takes time. The market may be slow, sale price may be lower than expected, cost may be high. Creating a mortgage involves stamp duty, registration fees has to be paid, which can be significant. Rent control issues can be there. So if the building is occupied by long-term tenants under Rent Control Act, the property becomes harder to sell and it loses its value. Agricultural land issues can be a disadvantage to the bank because there are land ceiling laws, incomplete records, restriction on transfers. So these are certain disadvantages of the land and building as a type of security. So when we understand about type of charges, we'll discuss in detail all about mortgage, pledge, hypothecation. So in this unit, we'll give a passing reference like what type of charge will be created, and in next unit, we'll understand in detail about those charges. Now, what are the documents required by the bank, the mortgager? So to safeguard their interest, bank collects several documents before accepting land and building as security, like title document, sale deed, gift deed, partnership deed, which provides the ownership. Then parent document, historical ownership record, which is usually for 30 years. Encumbrance certificate, typically for 13 years, which show whether the property is free from earlier mortgages or claims. Property tax receipts, It is a proof that borrower is in possession of the property. Court permission is required if the property is in minor's name. Court approval is needed in that particular case. Search report for company owned property. Bank check registrar of companies record for charges. And then there is a lawyer's report. The lawyer's legal opinion. Legal expert certifies that the borrower has clear marketable titles. Valuation of property. So before sanctioning the loan, banks get their property valued. This is done by approved valuers, which are engineers or architects. Inquiries with real estates are done for the valuation purposes, checking recent sale price of nearby properties, referring to official records or municipal valuations, and then rental value calculations are done. There are various factors considered while doing the valuations, like type of construction, age of building, conditions, nature of title, whether it is a freehold or leasehold, location and area, tax records, rent yield, cost of construction, and as stated earlier, valuation must be done on conservative basis. Uh, Meaning to say, if we are forced to sell, what is the price that this security will fetch? Ownership types. So particularly we have freehold and leasehold. So freehold is owner has full permanent right over the land. It is easier and more secure for the bank. Then we have leasehold. So property is owned only for a lease period. Say 99 years. This is prevalent in states like Uttar Pradesh. So value depends on how much lease is left. So bank check lease deed carefully to ensure there are no restrictions like requiring landlord's consent to mortgage, or loan repayment should not go beyond the unexpired lease period. In other aspects, basically inspection is done. So bank officials physically inspect property to confirm its existence. A mortgage deed must be carefully drafted and legally valid, which is witnessed by two people. It is witnessed by two persons. Insurance should be there, so the building should be insured against fire and natural calamities at the borrower's cost to protect bank security. And if the loan is given against land or building as primary security, the bank clearly specify that loan purpose. Now, um, let's move on to goods. So, advances against goods. A bank often provide loan to customers by taking goods as securities. These goods can include agriculture produce, raw material, semi-finished goods, or finished products. The choice of goods depend on the borrower's line of business. Since goods are tangible and have a market value, they are considered reliable security. But again, their nature, storage, and value fluctuations are carefully be evaluated. So there are two types of charges which can be created with respect to this security. So it is pledge and hypothecation. Pledge is particularly governed by Indian Contract Act of 1872, and this is governed by SARFAESI. Um, so the pledge is when possession lies with the bank. Here the possession remains with the borrower, but the charge is in the favor of bank. So in both cases, the ownership remains with the borrower and not with the bank. But again, the possession is transferred in case the nature of charge is pledge. It is not there if the nature of charge is hypothecation. Characteristics of goods as securities. So when goods are offered as securities, bank must study their key characteristics like natural durability, how long the goods can be used or consumed. For example, the fruits, food grains, or is it the chemicals? The physical strength, which is the ability to withstand force, pressure, damage. So glass, rubber, they have different physical strengths. Chemical nature, so whether the goods react with air or moisture or stay stable. So brass goods, salt, so they have different reactions with the atmosphere, right? Utility products, so it affects of long storage or appearance and composition. Fashion and lifestyle, effect of changing fashion trends on demand. Technological obsolescence, basically risk of goods losing demand due to new technology. Seasonal variability, it depends on demand depends on the season. And then intermediary goods, so the semi-finished or components used for other products. Now let's talk about the advantages and disadvantages of the goods. So with respect to advantage, goods have ready marketability. So goods can be usually be sold easily if the borrower defaults. Valuation is simple and straightforward. So market price and invoice makes valuation simple. Tangible security, unlike unsecured loans, goods provide physical security, usually given for short periods, which reduces the risk. They are short-term advances. Uh, they are cheaper. The charge created is cheaper than uh, land and building. So, except in few states where the stamp duty is heavy, the cost of creating the charge is low. With reputed borrowers, goods can be obtained. Bank can obtain valid rights over the goods. So, good title to the goods is possible when dealing with the reputed customers. Now, let's talk about the disadvantages. Goods like food grains or fruits, they deteriorate with time, so the perishability is an issue. Second, the risk of fraud is always there. Borrower may represent stock claiming that there are 10,000 tins, but again, some of the tins can be empty. So, risk of borrower fraud or manipulation in stock statement is a possibility. Market value may fluctuate, particularly for electronic goods or luxury goods. The market value may fluctuate. Uh, Valuation is difficult for certain items like antique items, diamonds. In that scenario, valuation is difficult. Selling large quantity of goods may reduce the price, so disposal may be a problem for bulk goods. Storage challenges are always there, so storage difficulties for bulky, hazardous, or delicate items which need careful handling. Cost of transportation is high. Moving goods to the market may be costly. Risk of default when goods are released under trust receipt. A borrower may not deposit sale proceeds with the bank, so there's always a risk of default on sale proceeds. And then warehouse keepers may hold goods for unpaid charges. Precautions which a bank may take before granting advance. So borrower must be genuine trader with sufficient experience. No advance for speculative or holding purpose. So this is true in every scenario. Whether you are providing loan against land and building, whether you are giving loan against gold, whether you are giving loan against shares. So no advance should be there for speculative purposes. Loan should be short term due to risk of deterioration. So short term loans only. Bank must obtain possession, actual or constructive, doesn't matter, but the possession should be with the bank. Written undertaking in case of hypothecation that the goods will not be given, uh, the goods will not be charged elsewhere. So for hypothecation, written undertakings should be given. Regular stock verification, borrower certificate on quality and value should be obtained. Proper care and storage should be done in order to prevent damage. Goods must be uh, the goods must be carefully stored, and the goods must be fully paid for avoiding double financing. Stock must be in demand and not obsolete. You verify borrower's ownership using original invoices. Maintain stipulated margin. Always separate storage of different goods for easy checking. Banks must study goods price, trend, market demand, storage needs. There should be adequate insurances against fire, theft, riot. Storage location must be easily accessible and it should be safe. And in case of warehouse, storage obtain undertaking for inspection, rights, and check that charges are paid regularly. So these particularly uh, precaution 15 to 16 precautions should be taken while granting advance against the goods inspection and monitoring. So storage requirements are there. So goods should be stored properly in proper go down with weather protection. Hazardous goods must be kept separately, and storage should always easy to access for inspection. So bank official must conduct regular inspections, and the storage should all allow always allow easy access for inspection. So regular inspection at least monthly plus surprise checks are there. Why at the time of inspection, count the bags, cartons, open random samplings. You verify with the purchase or sale registers, the GST paid, the excise records. You take the remarks in bank's internal reports. Do not put any remark on borrower's book. So remarks should be recorded in bank's internal records. Stock audit is there. So it is mandatory for working capital accounts above 5 crores. So stock audit is mandatory. It helps monitor stock levels, quality, and the borrower's financial health. Warehouse receipt, so it must be issued by approved warehouses. So advance against warehouse receipts. Uh, the warehouse receipt must be approved by warehouses, approved warehouses, government warehouses. Goods must match the description in receipts, and insurance and ownership verification is necessary. Valuation of stock. So stock value is the quantity multiplied by the price. Now again, valuation should be done on conservative basis. So valuation is usually done at cost price or market price, whichever is low. For non-moving or obsolete stock, discounted value is applied. Uh, Valuation method. So you cross-check with the purchase invoices. You engage professional valuers, independent valuers to determine the value. Market price reference are taken. So verify the prevailing market price. The quantity assessment should be correct. It is critical. Do not overstate the stocks in the stock statement. There's always a risk of overstatement. So quantity assessment should be done properly. Margin and recovery. So bank maintain a margin before calculating the drawing power, of the amount which can be lent to the borrower. So for example, stock value is 1 CR. Bank is maintaining a margin of 25%. So the drawing power is 75 lakhs. Bank will keep this 25 lakhs as margin. So adequate margin must be maintained. In case of default and the nature of charge is hypothecation, bank can take possession and sell goods under SARFAESI Act without court intervention. But again, it is subject to certain conditions. And in case the nature of security and the nature of charge is pledge, bank can sell pledge goods after giving reasonable notice under section 176. So if it is hypothecated, bank take the possession and then sell goods. If the nature of charge is pledge, bank already has the possession, bank only needs to give a reasonable notice to the borrower and then bank can sell the goods. Document of title to goods. Document of title of goods is defined under Section 2, subsection 4 of Sale of Goods Act. A document of title to goods, it is a document used in ordinary course of business as proof of possession or control of goods, which authorizes either by endorsement or delivery the possessor of the document to transfer or receive the goods. So basically, if you have the receipt, you will get the goods. So these are documents that represent ownership or the possession of goods. So whoever holds these documents can transfer or claim the goods. For example, bill of lading, dock warrant, warehouse keeper receipt, railway receipt, delivery order. So if you have these receipts, you can claim the goods. There are certain essential requisites which we need to understand. One more thing, uh, they are different from non-transferable documents like where a simple warehouse receipt. So it is not a mere acknowledgement, but it creates ownership. It intends to give the goods whoever has this document. So essential requisites include mere possession gives right to possess goods represented, meaning to say it create right to possess the goods. So possession of such a document gives legal or trade right to possess the goods it represented. Goods can be transferred by endorsement or delivery of the goods. The holder can receive goods in his own name, so transferee can take delivery. They resembles negotiable instrument, but they are not truly negotiable because a defect in the transfer title also affects the right of transferee. M- merits involves easy pledge. So by pledging the document, the underlying goods are pledged. Transferability is one of the merits. So simple endorsement or delivery transfer the goods. Transferee can claim delivery directly, and then the formalities involved are very less, so it is easy to use as a security. Demerits, documents do not guarantee the content, so bags may contain worthless items, so a risk of fraud is always there. Quantity and quality may be tempered, so forgery or alteration risk. They are not fully negotiable. Defect in transfer title pass on to the transferee, so not fully negotiable. Unpaid vendors right of stoppage, so seller can stop goods in transit if unpaid, which reduces banker's security. Lost documents, so borrower may misuse indemnity bond to claim goods fraudulently. Precautions required from bankers and you check the genuineness, verify authenticity, date, and completeness. All the copies of bill of lading should be obtained, which are usually in duplicate or triplicate. So all the copies should be obtained. Ensure no remarks about damage or defect good is there. They must be insured against fire, theft, transit risk, marine risk, if marine risk is applicable. So whichever risk is applicable, the insurance should cover that risk. And bank's name should appear as consignee for safe title. Trust receipt. So when a bank releases document of title to a borrower without a payment, it should take a trust receipt. Similarly, for hypothecated goods, a trust receipt is necessary. So why are they important? Because borrower must hold sale proceeds in trust for bank, and it protects bank in case of borrower's insolvency. The typical clauses which need to be incorporated. A borrower acknowledges bank's right in goods. It undertakes to hold goods or sale proceeds in trust. It undertakes to insure and store goods properly. The borrower agrees to direct buyers to pay directly to the bank and to return unsold goods or disposes as per the bank's direction. Advance against life insurance policy. So bank may also grant advances against life insurance policy either as primary security or collateral security. But the purpose for taking life insurance policy is to provide financial support to dependents after the death, and it can also serve as a saving tool with tax benefits and loan eligibility. So, what are the advantages of life insurance policy as a security? So, it is a reliable security. Life insurance business is regulated. Claims are paid if policy is valid. Then easy assignment is there. The legal procedure is simple, which give bank perfect title. Longer the duration of the policy, higher is the surrender value. So uh, it increases the value over time. On borrower's death, loan can be repaid from policy proceeds, so it acts as a debt protection. Policy can be surrendered in case of default, so immediate realization is there. And policy remains with the bank. Only premium needs regular monitoring. So it's a tangible security in bank's custody. Uh, every coin has two sides. Every type form of security comes with advantages and disadvantages. So there are disadvantages associated with life insurance policies as well. A lapse risk is there, meaning to say if premium is not paid, policy lapses. Misrepresentation makes the policy void. So good faith requirement is there. Policy without insurable interest is void. So the proposer must have insurable interest in assured's life, meaning to say a person taking life insurance policy in the name of his or her neighbor or a random person. This is not allowed. The proposer must have insurable interest. Bank should check for the restrictive clause which may reduce insurer's liability. So if there's a restrictive clause, it will reduce the liability of the insurer. Married Women Property Act needs extra care in assignment. So policies under this particular act, Married Women Property Act, they need extra care. Duplicate policies, risk is always there. The risk of duplicate policy. So the borrower may misuse duplicate copies. Now, what are the precautions required to be taken? The policy must be enforced with the latest premium paid. Original policy document, which is stamped and signed, is required. There should be no restrictive clauses. The policy should be free from restrictive clauses. Restrictive clause basically reduces liability of the insurer. The age of assured must be admitted. Policy must be assigned in bank's favor and it should be registered with the insurer. It should be ensured that the premiums are paid regularly. Some policies cannot be accepted as securities, which include child endowment policy, estate duty policies, deferred child policies, and policies with uh, nominations under Married Women Property Act. So, valuation of security or the loan basis. So, bankers lend on the surrendered value. So, surrender value is basically the amount insurer will pay if policy is surrendered. Assignment of policy. So assignment can be on the policy itself or on stamped paper. Again, it must be witnessed. Nominees consent uh, if not needed, because nomination gets cancelled automatically. So nominees' rights are cancelled after assignment. So their consent is not required. Assignment is valid only after written notice to the insurer company, to the insurance company. So assignment is effective only after written notice. On repayment of loan, bank reassigns policy back to the borrower, and bank may also accept Kisan Vikas Patrikas or National Savings Certificates as additional securities along with the policy. They can also accept these documents. Advance against shares. So when a person or company needs money, they can approach a bank and pledge their shares, equity share or preference shares, and the bank then provide loan or overdraft against those shares. So equity shares give ownership in a company and the voting rights, and preference shares give priority, the preference over equity shares in dividends and repayment of capital. Again, shares can be listed shares or unlisted shares. So listed shares are those shares which are traded on stock exchange, which are easy to sell and value. And then there are unlisted shares which are not traded on exchanges. They are difficult to sell. So bank usually avoid them. So bank usually accept listed shares which are fully paid up shares. They do not give loan against private company shares because there's no ready market for selling them. If the borrower default, bank cannot simply go here and there and ask persons whether they want to buy the shares of this private company. So banks generally accept listed equity shares. Again, the purpose should be productive purpose and not speculation purposes. So advances must be only for productive purposes and not speculations. Loan should not be provided to gamble, right? The nature of charge which is created on shares is pledge, meaning the shares remain in borrower's name but cannot be sold without bank's permission. And nowadays, bank insists shares to be held in demat form to make pledging simple and secure. Advantages. So the valuation is easy. Market prices of listed shares are available daily. Stable value of shares in normal times. So normally blue chip stocks are less volatile than other commodities. In demat form, the formalities required are very less. Depositories make it easy to confirm the ownership, like who owns the share. Uh, Cost of charge creation is cheaper than the mortgage. Uh, Shares also generate income via dividend, which can be adjusted against the loan. Release is very quick, so it is easy to return shares after loan repayment. Now let's talk about disadvantages. Since shares are liquid and easy to transfer, they can be misused if not properly secured. If they are partly paid, then the borrower may need to pay the future calls. Price fluctuations are possible, so in certain times there are very high price fluctuations, and sometimes due to restricted market they are not easily sellable. Now, because of these risks, banks prefer only fully paid up listed shares. Precautions which is required to be taken by banks: maintain an approved list of shares that the bank will accept. Update the card limit, so the maximum loan allowed per share regularly. For example, if the share of Infosys is 1500, the bank will provide say 1000. If the share of a particular company which is newly listed, say ABC Limited, so the bank will not provide loan against this the share of this company. It should be mentioned in this list, and this price like what is the credit card limit which the bank will provide. So the maximum loan value against per share. Periodic review should be there. So portfolio should be reviewed yearly or even more frequently depending on the stock market volatility. If we are accepting partly paid shares, which is in rare cases, don't transfer them into bank's name. Ensure calls are paid on time. Keep sufficient margin to cover the risk and verify the details in demat account. So in rare cases, if the loan is provided against partly paid shares, then these four requirements need to be fulfilled. Statutory limit. So statutory limit is provided under Banking Regulation Act. So section 19 subsection 2 of the Banking Regulation Act 1949 provides a statutory limit on shareholding, which states that a bank cannot hold shares of any company as pledge or as owner exceeding 30% of that company's paid up share capital or 30% of the bank's own paid up share capital plus reserves, whichever is less. So this 30% is a statutory limit. And this ensures banks don't end up holding too many shares of one company, which could expose them to excessive risk. And it applies to all shares, whether physical or demat form. Regulatory regulatory exposure limits. So banks' exposure to the stock market include direct and indirect exposures. So direct exposures means investment in equity shares, convertible bonds, convertible debentures, or equity mutual funds, and indirect exposure includes loan against shares, loan to individuals for IPOs, ESOPs, loan to companies secured by shares, financing to stockbrokers, underwriting commitments, exposure to venture capital funds. So basically, bank is not directly investing in the equity market, but taking an indirect route. Now, there are exposure limits on solo basis, like individual banks. The total capital market exposure should not be more than 40% of the bank's net worth, and the direct exposure should not be more than 20% of the net worth. So, in this 40%, the direct exposure should not be more than 20%. And on consolidation basis as well, this limit remains the same 40%, 20%. There are exceptions. So equity which is received due to restructuring of NPS, it is one of the exception. And secondly, loans for government PSUs disinvestment program, which are specially approved by the RBI. So these two are the exceptions for this exposure limits. General guidelines for advances against shares. So follow statutory provision. Secondly, the purpose of the loan is more important than the security. The purpose should be protective purpose and not a speculative purpose. You keep advance against shares separate from other loans. Verify marketability, financials, and reputations of the company whose shares are pledged. Again, value shares at current market price and not on the historical prices. uh, you should be careful of the large block of shares. Ensure that they are not used for taking control of the company. Never lend against partly paid shares. So no lending against partly paid shares. Proprietorships or partnerships cannot take loans primarily against shares. If loan is greater than 10 lakhs, you transfer the shares to bank name, and bank may decide how to use the voting rights. Ensure securities are genuine. Board of directors should fix internal guidelines and authority levels. And Indian banks cannot help overseas branches finance Indian national to invest in Indian shares. There are margin rules which should be followed. So, a uniform margin of 50% on loans against shares and IPOs, and within this, at least 25% must be cash margin. So, in case of guarantees for capital market operations, so 50% margin and 25% margin should be applied. Loans to individuals. So, purpose is personal needs, subscribing to the issue, or secondary markets. So subscribing to new issues include IPOs, FPOs, right issues. So these loans are meant to support genuine investment or personal requirements and not speculation requirements. There are ceiling to the loans. So if securities are held in a physical form, maximum 10 lakh rupees can be granted as loan as an advance to the individual, and 20 lakh rupees can be granted if securities are in dematerialized form. So if they are in demat form, maximum 20 lakh rupees per individual can be granted, and this ceiling ensures that the risk exposure for the bank remains controlled. Uh, you should prevent the collusive action as well. So there should be prevention of. So basically, these loans should not be misused by the group of individuals linked to corporates to artificially inflate or support the prices of a particular share. So if multiple individuals take loan to the same share, the exposure is treated as capital market exposure for the bank. And banks have a lending policy, so every bank must have a loan policy for such advances, which is approved by its board. Purpose has to be ensured. The it should be productive purpose and not speculative purpose. Financing of IPOs. So bank may provide loan to individuals specifically for subscribing to IPOs or FPOs, fresh public offerings or initial public offerings. There is a ceiling of 10 lakh per individual across the entire banking system, and corporates are not allowed to take bank loan for investing in other companies' IPOs. Such loans are treated as capital market exposure for the banks, and both IPOs and NPOs fall under this category. Finance for ESOPs. So bank may support employees in buying shares of their own companies under ESOPs, employee stock option plans, or employees quota and IPOs. But again, there is a ceiling. So employees may get up to 90% of the price or 20 lakh rupees, whichever is lower. So the extent of finance which is allowed is 90% of the price or 20 lakh rupees. Such loans are treated as capital market exposure, so they are counted within that 40% limit. And banks cannot finance their own employees to buy shares of their own bank under ESOPs or IPOs. And this applies irrespective of whether the loan is secured or unsecured. The logic is basically to prevent conflict of interest and safeguard the independence of banking operations. Employees borrowing for ESOPs or IPOs, they must provide a declaration of other loans taken against shares, securities from other banks, so that the ceilings are not breached. Loans to stockbrokers and commodity brokers. So only the SEBI registered stockbrokers and commodity brokers who meet SEBI or stock exchange capital adequacy norms get the loan. There are two type of credit facility which is provided to them. Number one is overdraft or line of credit against shares and debentures held as stock trade. Secondly is working capital to cover temporary cash flow gaps in delivery versus payment transactions for institutional clients like foreign institutions, mutual funds, banks. So banks must check the borrower's financial strength, turnover, income, and the marketability of the pledge secured. Margin requirements are same: 50% for loans, IPOs, of financing guarantees, and within that, at least 25% cash margin for guarantees in favor of stock or commodity exchange. Uh, there are certain restrictions like no credit for arbitrage operations, and uh, sh- it should avoid nexus with interconnected borrowers. Market makers. So who are market makers? Entities approved by stock exchanges to provide liquidity in securities. They are the eligible securities include equity, debt securities, government securities. Then there are financial rules. So finance should be need based working capital. Margin is same, 50% margin on advance guarantees with 25% minimum cash margin. Loans cannot be diverted for investment in unrelated shares. That has to be kept in mind. Finance for margin trading. So borrowers money to you buy shares by pledging those shares to the bank is known as margin trading. So borrowing money to buy shares by pledging those shares to the bank, this is margin trading. Must be within 40% capital market exposure. 50% of margin has to be maintained, and share must be in demat form and placed with the bank, and bank must continuously monitor the margin. As a safeguard, bank should avoid nexus with interconnected borrowers and spread financing among several borrowers to prevent concentration risk. Loan policy for brokers and market makers. So each bank must frame its own loan policy covering the purpose and permissible use of advances or guarantees. The pricing, the risk control features should be unique to capital market lending. Valuation methods and frequency of valuation should be determined. So at least quarterly revaluations of collateral should be there. Transfer rules, if shares need to be in the bank's name, so the loan policy must include this aspect as well. The periodic review and the exposure limits are also mentioned in this loan policy. So, if shares are in joint names, bank must be careful not to bypass RBI limit. For example, if A and B hold share jointly, say a person named A and a person named B, these two person hold shares jointly, and A has already took a loan. Now, the bank should not give another loan to B against the same shares to circumvent this limit, right? Advances against mutual funds. So, units must be listed or have a repurchase facility. The minimum lock-in period must be over, and the loan amount should be linked to NAV, net asset value. For equity-oriented mutual funds, the margin requirements are same, 50% and 25%. For debt-oriented mutual funds, bank may set their own policies, and no loan for subscribing to another scheme or for boosting mutual fund sale is allowed. Advances to corporate or industrialists. So normally corporate or industrial borrowers should not be given loan against shares as primary security. Exception are there. So share may be accepted only as collateral for genuine working capital or productive loans, but certain conditions are to be fulfilled, like share must be in demat form. Promoters share also must be in demat where possible, and temporary acceptance is allowed, maximum 1 year. So it should be a temporary acceptance when borrower is waiting for long term funds. Promoters contribution financing. So promoter contribution is equivalent to equity investment in new company. So if bank lend against shares for this purpose, it is treated as investment in shares, which is a part of 40% capital market exposure. Bank can fund Indian companies for acquiring equity in overseas joint ventures or wholly owned subsidiaries, and Exim Bank can refinance uh, if it is approved. Again, no funding for non-compete fees or related activities, and even overseas branches of Indian banks must follow all these rules. Advances against debentures. So, a debenture is a written acknowledgement issued by a company stating its indebtedness to the holder. It is a form of long term debt instrument that carries a fixed rate of interest which is payable periodically. Debentures may be either secured or unsecured, And then mortgage debentures. So these are secured by creating a charge over the company's asset in favor of trustee who safeguard the interest of investors. And then there are bearer debentures. Bearer debentures. So these are freely negotiable, payable to the holder, and do not require registration of transfer. Let's understand the advantages. Debentures are easy to sell, so liquidity is an advantage, especially if they are listed on stock exchange. Unlike shares, they do not fluctuate violently in the price, since their value mainly depends on the prevailing interest rate rather than the market demand. So they offer liquidity, they offer stability, they can be transferred at minimum cost, particularly in case of bearer debentures. So the transfer cost is low. Bearer debentures can be transferred by delivery and are treated as negotiable instruments, so negotiability is there. In liquidation, debenture holders rank higher in repayment priority compared to shareholders, so they have priority over the shares. And generally, debentures are backed by a charge on company property, giving lender an additional layer of protection. There are certain disadvantages as well. For instance, default risk is always there. So the company delays or fails to pay interest, debenture prices fall and their marketability reduces. Registration issues are there. If a charge on company property is not properly registered, subsequent charges may gain priority, reducing the banker's claim. And some companies may issue debentures without proper authority or borrowing power, making them invalid. They are ultra wires issue. Precaution which is required to be taken by bankers. So you ascertain whether debentures are secured or unsecured. Secured are always preferred. Verify the borrowing power of the company to ensure that the issue is within the permissible limit. Ensure the deposit of debenture certificate along with memorandum of deposit for demat debentures. Pledge must be created in borrower's demat account. To examine the nature and value of asset charge and monitor periodically to ensure security remains valid, and confirm that there are no uncancelled or redeemed debentures still in circulation which could dilute the lender's security. Loan against book debts. Book debt represent the amount receivable from customer on account of credit sales. They may arise in two cases: by drawing bill of exchange on purchaser, that is the bill receivable, or by debiting purchaser account directly, which is account receivable. Thus, book debt is equals to the claim of the borrower against buyer for goods or services sold on credit. So, borrower may assign these debts to bank as security to obtain the advances. So, let's talk about the legal basis and the conditions for valid assignment. So, they are governed by Section 130 of the Transfer Property Act, which permits assignment of actionable claims. The procedure of assignment or the condition for valid assignment is that they must be in writing and signed by the assigner or authorized agent. The notice of assignment must be given to the debtor. An assignment can be absolute or by way of charge. Absolute meaning to say there is complete transfer, by way of charge that the security is limited. Legal implication: so the bank can sue debtor directly in its own name, and debtor can exercise any right of set off against the bank that was available against the borrower. And future debts can also be assigned since they fall under actionable claims. Risk in lending. So debt may be fictitious, old, or disputed, and the borrower may lack integrity and misuse the facility. Borrowers may fail to remit the collection to the bank, or giving notice to every debtor may be administratively very difficult. So these are the risks involved in lending against the book dates. What are the factors which we need to consider before granting advances? So number one is the integrity and credit worthiness of the borrower. So it should be thoroughly verified. Secondly, the standing and reliability of the debtor company should be checked. Thirdly, finance should not be concentrated or receivables from a single buyer. Diversification should be there. Account should be audited and properly maintained, and the borrower must have an effective debt collection system. There are two methods of charging security. Number first is assignment, and number second is hypothecation. So by assignment, banks get the legal right to collect directly from the debtor, and when hypothecation is there, it creates only an equitable charge on receivables. Borrower continues to collect and must remit to the bank. There are three modes of financing book debts. Number one is factoring. So banks or financial institutions purchases the receivables at a discount and assumes collection responsibility. Second is forfeiting, outright purchase of receivables. It is mostly used in international trade. And third is overdraft or cash credit. So against hypothecation of book debts, borrower operates the account under the agreed limits. There are certain guidelines for book debt financing. You should restrict this facility to the first class borrowers of unquestionable integrity. Receivables should not be older than 3 to 6 months, depending on the bank policy. A book debt should arise from genuine trade transactions only, and the debt related to sister concerns, capital expenditure, or disguised advances, they should not be financed. Verification, so sale invoices and data ledgers must be verified. Data confirmation should be obtained for outstanding dues. You check overdue position and reasons for long pendency, and ensure receivables are not concentrated on one major buyer, and bills that are already discounted returns should not be refinanced. Other aspects, so obtain borrowers undertaking to remit all collection to the accounts. You should serve notice of assignment on debtors and seek their acknowledgement. In case of corporate borrowers, you ensure registration of charge with the registrar of companies. So these aspects should be taken into consideration. Loan against term loan. So bank often lend against their own term deposit. So fixed deposit, recurring deposit. Loan may be in form of demand loan or an overdraft facility, and security is created by a way of charge of the deposit receipt. So the form of charge created is pledge, margin and interest. So normally up to 90% of the deposit value accrued amount is advanced. So 10% of margin and 90% can be provided. For example, if the fixed deposit is of 10 lakh, so bank can grant loan up to 9 lakh rupees. Rate of interest charge is 1 to 2% above the rate payable on the deposit, and repayment by the borrower. Uh, Borrower may repay at any time before the maturity. On maturity, bank recovers the loan and interest first, and if there any surplus, it is paid to the depositor. And if deposit maturity proceeds falls short, then the borrower must pay for the balance. Deposit in minus name. Normally, no loan can be granted against FD in minus name. Exception is there that the loan to guardian for necessities of minor deposits can be given, subject to the undertaking by guardian that the loan proceeds will be used only for the minor's needs. Uh, Discharge of receipts. So bank obtain duly discharged deposit receipts from the depositors. If multiple holders are there, all must discharge and execute the loan document. If some holders cannot sign, an authorization letter from them is required, and the bank also obtain letter of appropriation authorizing adjustment of deposit maturity proceeds against the loan. Lien noting. So bank must note its lien in the fixed deposit register and on the fixed deposit receipt itself. To prevent accidental repayment of deposit, or deposit of proprietary and partnership concerns. So loans against proprietary concern deposits are not third party loans, whereas loans to partners against firm deposit is treated as third party loan, and it is charged at commercial rate of interest. Deposit held at other branches, so loan can be granted against deposits in other branches of the same bank, and the bank must mark lien at the deposit branch before sanctioning the loan. Deposit held by a company, sorry, a company deposit. So loan requires board resolution authorizing borrowings against deposit. There's no need to register pledge with the registrar of companies, and loans against deposit held under capital gain scheme or tax saving schemes are prohibited. They are not allowed. Third party deposits. So loan may be given if third party FD holder duly discharge the FD receipts and provide a written declaration authorizing bank to adjust maturity proceeds towards the borrower's loan account. Deposit in other banks. So no loan against deposit with other banks are allowed. Reason being, original deposit bank enjoys a journal lien over deposit and may refuse to register lien in favor of another bank. Loan against gold. Banks often provide loans against gold ornaments for both agriculture and non-agriculture purpose. So this is one of the most popular form of secured lending in India because gold is widely held by households and can be easily valued. The charge created in gold loans is pledge. The borrowers hand over the possession to the bank as security, but the ownership remains with the borrower. Some banks also allow overdraft facilities against gold ornaments, giving flexibility to the borrower. So, what are the advantages, disadvantages, restriction? So, let's talk about them. First, let's understand advantages. So, before moving to restrictions, let's understand advantages. So, the evaluation is easy in case of gold loans. Golds can be quickly valued as its price are publicly available. Golds can be safely stored in bank's vault. Gold does not deteriorate easily and is only marginally affected by environmental factors. So, durability is there. It can be easily carried and shifted. Portability, price stability offered by gold loans is higher, and it often rise during uncertain times. So, valuation is easy. Liquidity is also easy in terms of loans against gold because the ornaments can be easily sold since jewelers act as a ready buyer. Now let's talk about the restrictions. So no gold loan is allowed against the raw gold. So no loan against raw gold or the bullions, and loan is permitted against specially minted gold coins which is sold by bank. Again, the limit is 50 grams per customer, and as applicable in all other cases, the purpose should not be speculative in nature. Now let's talk about disadvantages. So ownership issues can be there because establishing ownership is difficult as ornaments are not always backed by purchase invoices. Now hollow ornaments are harder to value correctly. We need to destroy the jewelry in order to ascertain the precise purity. Jewelry fetch less than its market value because jeweler deducts making charges uh, for stones, and there's always a risk of theft and risk of loss. So handling and storage involves risk. Important aspects. So the gold loan must be given as per bank's board approved policy. So there should be always a bank board approved policy Loan to value ratio is capped at 75%, basic meaning to say the banks cannot lend more than 75% of the value of the gold ornament or the jewelry. Rate of interest depend on the purpose of the loan, whether it is a agricultural loan or a non-agricultural loan. Agricultural loans often have lower rate of interest. So for agricultural loan, the repayment is linked to their crop cycle, and for non-agricultural loans, maximum 12 months if bullet repayment is allowed. A right of lien is there, so banks are allowed to hold the on gold jewelry for other overdues as well, right? In case of default, bank have the option to sell the loan. So if repayment is not made, the bank can sell the ornaments after giving a reasonable notice, as per section 176 of the Indian Contract Act. And bank usually appoint professional appraisers for purity testing. So for this agriculture, it is harvest or marketing season. Now, what are the precautions which a bank must take while granting gold loans? So, ownership verification is very important. Borrower must comply with the KYC norms. Declaration required stating that ornaments belong to the borrower and he has full right to pledge them. Pledge or release must be done inside the bank's authorization room only. Appraiser must approve a jeweler which is appointed by the bank, and must provide valuation certificate showing description of ornament, fineness, gross weight, net gold weight, and value at prevailing market rate. The valuation of the gold is based only on the gold content and not on the labor or design charges. So RBI requires banks to value at the 30 days average of 22 carat price published by IBJA. Basically, this is Indian Bullion and Jewelers Association. And the ornament is less than 22 carats, then the value is proportionately reduced. Our preference is given to the hallmark jewelry for easier and safer valuations. Detailed record should be maintained in gold ornament register, and these ornaments must be stored in sealed bags which are tagged with loan account number and the borrower's name, stored in a strong room and fireproof safes under joint custody. Now, margin must be maintained. Loans cannot exceed 75% LTV, and normally it is provided for a period of 1 year. Gold loan is provided for a 1 year, which may extend to 60 months, which means 5 years. So the loan tenure is within 1 to 5 years. Ornaments must be returned after repayment. So part release is also allowed against proportionate repayment, ensuring sufficient margins are maintained. Delivery to third party should not be there. It should be avoided, but it can be done with borrower's authority and confirmation. If there is any default, again bank can issue the notice for repayment, and if unpaid, ornaments can be auctioned. Repledge of ornaments are not accepted to prevent misuse by the moneylenders, and ornaments must be insured against theft or burglary. Surprise check of pledge ornaments by an officer other than the custodian should be there in order to ensure the safety. Bullet repayment loans, so these are permitted for non-agricultural purposes with some special conditions that the loan amount should not exceed 2 lakh rupees. The tenure should not exceed 12 months. Interest is calculated monthly, but it is payable with principal at maturity. Banks maintain margin and fixed loan limit considering price fluctuations and accrued interest. Accounts become NPA even before maturity if margin is not maintained. So classify these accounts as non-performing assets if the margin is not maintained. Interest income should be recognized only on collection and not on accrual basis, and it is governed by RBI's income regulation and provisioning norms. Now let's talk about supply bills. So supply bill arise when a contractor or supplier executes work or supplies goods to government department or public sector undertakings. So after supplying goods or completing part of the contracted work, the supplier or the contractor raises a bill to claim payment, which is in line with the terms of the contract. These are not negotiable instruments like check or bill of exchange. Instead, they represent a claim. They represent a claim or debt which can be assigned to a banker for advance to the bank for advance finance. Now, what is the procedure? Supplier dispatches goods and provides documents like railway receipts or bill of lading. For contracts involving work, an engineer's certificate of completion or progress is obtained. Once it is supplied, the supplier or contractor prepares the supply bill along with the inspection note or the engineer's certificate. The bills are to be submitted to the concerned government department via banker, and supplier requests banker to give an advance against these bills. Since supply bills are not negotiable instrument, the supplier must assign payment right to the banker. A revenue stamp is affixed and the supplier authorizes the department to make payment directly to the banker. What are the risks involved in advancing against supply bills? So there can be delay in payment. Government procedures are sometimes lengthy and advances may take long to liquidate. Bills may not be passed for full value if goods are defective, delayed or unsatisfactory. So there is a possibility of deduction. Government can adjust dues against tax penalties or damages. So counter claims can be there, set-offs can be there. And since the charge is by way of assignment only, it is almost like an unsecured advance. So what are the precautions which we need to follow? So finance only experienced contractors which are familiar with government procedures who scrutinize the contract carefully about the volumes, rate, period, conditions, and obtain an irrevocable power of attorney registered with the department authorizing the bank to collect the payment. You insist on inspection notes, engineer certificates with no adverse remarks, and then prefer financing against interim bills as they are quicker to realize and handle finance bills on collection basis due to delays. So we prefer interim bills for advances and not financial final bills. And keep the right to demand payment if bill remain unpaid beyond a specific period. Vehicle finance, we have also discussed vehicle loans in detail. I hope you remember when we discuss education loan, vehicle loan. So vehicle finance refers to loan granted by bank for acquiring vehicles either for personal use or commercial use. The security created is hypothecation. You does not take the possession of the vehicle, right? You allow the borrower to enjoy the possession and the ownership, but a charge is registered with the registration authority, with the RTO, regional transport officer. So the security, the nature of charge is hypothecation in this particular case. Now, valuation is very simple. Manufacturers publishes prices and market values are transferable. And vehicle lasts for years, but again, they are prone to accidents. So they are somewhat durable assets. And being movable, vehicles can be hidden or relocated if borrower defaults. So mobility risk is always there. And ownership is registered with the regional transport uh, authority. Transfers without owner's consent is quite difficult. Charge creation, again, hypothecation is the charge created. Hypothecation charge is registered with RTA or Vahan database, preventing double financing. risk is always involved because in case of default, the bank can possess uh, the vehicle, but vehicle depreciate faster. So security values get reduced quickly. Loan tenure should not be more than the vehicle's life. Maximum is 84 months, 7 years, but we generally prefer less tenure than that. Insurance should always be there. The vehicle should be insured. Comprehensive insurance should be there. Bank's hypothecation again should be registered with RTA, and it must be endorsed in RTA records. Upon default, bank can seize the vehicle and sell it after the proper notice. Unit number 26, different modes of charging securities. And in this particular unit, we'll understand about a contract. So what is a contract? How is it formed? What are different types of contracts? For example, what is a valid contract? What is a voidable contract? What is an agreement? What is a void agreement? And we'll move on to contract of agency, contract of bailment, and then we'll study about different types of charges. So assignment, lien, set off, hypothecation, pledge, mortgage, and right of appropriation. In between, we'll also discuss about lease. And finally, we'll understand what is a charge, what is a floating charge, what is a fixed charge, how do we register a charge. We'll do our practice question and wind up this class. So we all know that bank faces a major challenge when they lend money. So credit risk is always there. And to reduce this risk, keep that in mind, we cannot eliminate this risk. This risk will always be there because of the nature of the business in which bank is involved. So what we can do is to reduce this risk, and to reduce this risk, we uses securities. So bank basically safeguard their advances by taking securities. So security is essentially any asset or property that the borrower offers the bank, so that if the borrower defaults, the bank can recover its money by selling or enforcing rights over that asset. So different types of securities are there: movable property, immovable property. Then there are debts, financial claims like book debt, insurance policy, bonds. So we have understand about different types of securities. We have already covered them. So the way in which a bank creates a charge, it depends upon the type of security. What is the type of security? For example, for land and building, we create a mortgage. Uh, for a vehicle loan, we create a charge of hypothecation. For loan against gold ornaments, we create a charge of pledge. So on and so forth. So it actually depends on the type of security. And there are some key laws involved in it. Indian Contract Act, Transfer of Property Act. So Indian Contract Act basically tells about the pledge, what is a contract of bailment, what is a contract of agency. Then Transfer of Property Act, mortgage is defined under Transfer of Property Act. So let me write it more clearly for you. Companies Act. So Companies Act require companies to register charges created on their asset. Registration Act is there, which deals with registration of documents like mortgage, lease, and SARFAESI Act is there. So hypothecation, the charge of hypothecation has been defined in the SARFAESI Act. So it basically empowers the bank to enforce security interest without even going to the court. So now let's understand what is a contract. So contract has been defined under Section 2H of the Indian Contract Act 1872. Since lending always involves agreement between bank and borrower, concept of contract is central to the banking. And according to Section 2H, any agreement which is enforceable by law is a contract. So this implies two things: that there must be an agreement between two parties, and that agreement, there should be an agreement, and that agreement should be legally enforceable. Thus, contract equals to agreement plus enforceability of law. Not all agreements are contract, keep that in mind. For example, if two friends agree to go out for a dinner, it is an agreement but not a contract because it is not legally enforceable. Again, if a person wants to engage another person into some kind of illegal activities, so it is an agreement, but it is not a contract. They cannot move to the court for its enforceability because it is not legally enforceable by law. And contract is divided into two parts. So there are two parts in which Indian Contract Act is divided. So there are general principles of contract, and then there are special contracts like contract of indemnity, contract of guarantee, contract of bailment, contract of pledge, contract of agency. So it is divided into two parts. First is general principles, and second is special contracts. Now let's understand about the essentials, about the key components of the contract. So we we are done with this. Let's understand these portions. So it is an agreement enforceable by law, which we have understood. Now, in order to say an agreement is a contract, free consent should be there, meaning to say the consent should be not obtained by means of coercion or fraud or misrepresentation or by mistake. So there should be a meeting of mind between the parties that they are speaking about the same thing in the same sense, and then this consent should not be obtained by means of force, coercion, by fraud, misrepresentation, mistake, or undue influence. Then the consideration for this contract should be lawful, and the object should be lawful. Uh, the consideration should not be something illegal or morally wrong, right? So then for the object also it should be lawful, and it should not be expressly void. It should not be expressly banned by the law. So if law prohibits something, you cannot do it, right? So it should not be expressly void. Key components: proposal or offer. So when one person expresses willingness to do or not to do something to get the consent of another, it is known as the proposal. For example, a bank offering a loan scheme. So you can take it, the loan, or you can just refuse it. So when a bank offers, showcases a loan, so a bank offers a loan scheme, it is a proposal. And when the other party accepts the proposal, it becomes acceptance. So a proposal is when one person expresses willingness to do or not to do something, it to get the consent of another. It is a proposal, and when another party agrees to the proposal, it becomes acceptance. So a proposal becomes a promise. Basically, proposal plus acceptance becomes a promise. For example, there are two individuals, A and B. Now, this particular person A offers his car to B for a sum of rupees, say 5 lakh rupees. Now, what is A doing? A is making an offer to B. Now, B can either accept the offer or reject the offer. If B accept the offer that, okay, Mr. A, I'll purchase your car for this particular sum of rupees, this 5 lakh rupees. So this is an acceptance. He has assent to the other party. He agrees to the proposal. So now this becomes a promise. A proposal that has been accepted becomes a promise. So the person who is making the proposal is known as promisor. So A is the promisor here, and one who accepts the proposal is the promisee. So B is the promisee. Now, what are the essentials of valid contract? Let's dive into it. First of all, in order To create a contract, there must be a proposal, there must be an offer. That offer should be followed by an acceptance. Once it is accepted, it becomes a promise. This promise should uh, be bundled up with consideration. If the promise and considerations are lawful, it becomes an agreement. So, agreement is nothing but a promise or set of promises along with a consideration. So, when it becomes agreement, it should be legally enforceable, and then it becomes a contract. So, the first step is offer, right? So, there must be lawful offer by one party and acceptance by the other party. For example, a borrower applies for a home loan. So, what the person is doing? The person is uh, offering to take the loan. So, that is a proposal, and when bank approves it, it is an acceptance. So, this offer is a valid offer. This is a lawful offer. So, borrower applies for a home loan. When there is a catalog, keep that in mind. When there is a catalog or there is a tender, it is not an offer. It is an invitation to offer. So, what bank does is when it advertises its loan schemes, it is you who will make an offer to the bank that I want to get the loan, and when the bank approves it, the bank is basically accepting your offer, and then it becomes a promise and followed by a contract. So there must be a lawful offer by one party and acceptance by other. You should not uh, mistake offer with an invitation to offer. Invitation to offer is, for example, when there is an auction and you are bidding for something. Now, what you are doing is an offer. You are offering things that I want to purchase this particular piece of art or a particular item for this particular amount. So, I am making an offer, and the auctioneer will accept your offer. So, when he invites you, he is inviting you to offer. So, that is an invitation to offer. An agreement can be oral or written. So, however, for certain matters like sale, mortgage, or lease, it must be in writing, registered, and attested. If the formalities are not covered, then the agreement cannot be enforced in law. Consideration is something in return. This is something in return. So each party must get something of the value. So when the bank gives you the money in the form of loan, so the borrower agrees to repay it with interest. So bank giving loan is consideration for you, and you repaying it along with interest is consideration for bank. And without consideration, an agreement is void. Of course, there are exceptions, and we'll discuss it. But as a general rule, an agreement without consideration is void. Now, there are certain exceptions to it, that an agreement made out of natural love and affection between parties standing in near relation to each other, and if it is in writing and registered, then this agreement will be valid. For example, a father promising his son that if you score say 90% of your marks in graduation, or if you clear your JIB exam, I'll gift you a bike or I'll gift you a car. So if the offer is made orally, then this is not a valid offer. But if the father made it in writing and gets it registered, then this agreement, even though son is not giving something in return, then this agreement also is a valid agreement, even though it lacks consideration from the part of the son. All right, so an agreement made out of natural love and affection between the parties standing in relation to each other, which is in writing and registered, it is a valid offer. and a promise to compensate to a person who has already done something voluntarily for the promisor in the past. And that is also enforceable by law. For example, a person has already played his part in the past, and for that portion, the promisee is doing something in return. So, a promise to compensate a person who has already done something voluntarily for the promisor in the past, or done something voluntary that the promisor was legally bound to do, is enforceable by law. And in this particular scenario also, the consideration will not be required. So, for example, there is a person A and there is a person B. Now, A has done something in the past for B, some work he has done, all right. And afterwards, B promises A uh, that he'll give him some money or he'll do something for him. Now, although in this promise, there is no consideration from the part of A, but he has already done something in the past voluntary for the promiser, or done something voluntary that the promisor was legally bound to do so, then this is also enforceable by law. Free consent should be there. We have already discussed free consent. Consent which is free from coercion, undue influence, fraud, mistake, or misrepresentation. If it is free from all of them, then the consent is said to be free. Consent is basically meeting of minds. For example, if I'm talking about a black car, and if I'm talking about a say Baleno, and you are thinking of a black car, say you are thinking of a Audi, then we are not on the same page. There is no meeting of mind. For example, if person A offers person B that I want to sell my black car for say 2 lakh rupees. Now A is talking about his Baleno and B is thinking that A also has an Audi, black Audi, and he want to sell his black Audi to me for 2 lakh rupees. So here there is no meeting of mind, hence there is no consent. And when there is a meeting of mind, then they should be free from coercion, undue influence, fraud, misrepresentation, and mistake. Capacity to contract. So, the parties must be competent to contract, meaning to say the party should be of the age of majority, they should be of sound mind, and they should not be legally disqualified. When we say age of majority, they should be 18 years and above. Sound mind meaning to say that the person is able to form a rational decision whether this particular agreement will benefit him or not. And when we say legally disqualified, so that person should not be legally barred by the law to enter into a contract. Say he should not be undischarged, insolvent, or bankrupt. So he should not be legally disqualified. Minus contract are void ab initio, meaning to say they are void from the very beginning, and a minor cannot enter into a contract. There's a famous case of Mohiri BB versus Damodar Das Ghosh. So it is an old case, around 1900s, early 1900. So minor mortgaged property to borrow money, and then he refused to return the money. So the court held that the contract between the minor and the other party is void, and they cannot compel the minor to repay, and then also uh, they cannot take the mortgage property into their arms. So they have to return the property, as well as they cannot compel the minor to repay, because a minor contract is a void contract. Exception is there. If the contract is for necessities, then minus estate can be charged for it, but again minor cannot be asked to repay. There are three types of agreement: a void agreement, voidable, and void contract. So void contract is a contract that is valid initially but becomes unforceable due to some event. Say there is a change in law, so a valid contract becomes a void contract. So valid becomes invalid, it is a void contract. Void agreement is they are not enforceable at all. Minus contract is a void agreement. A contract without consideration is a void agreement. And voidable contract is a contract which is enforceable at the option of one party but not at the option of another party. So if a contract is made using undue influence or coercion, so they are voidable contracts, except for mistake. If it is made by misrepresentation, fraud, undue influence, coercion, then the contract is a voidable contract. Contract Act and banking. So contracts are backbone of all banking transactions. Banking function are nearly impossible without enforcing agreements. Some key relationships are depositor and bank. So when a customer deposit money, the bank becomes a debtor and the depositor is a creditor. So we have discussed all of this in our unit 1. So all of these contracts are made possible, all of these things are made possible because of the Contract Act. So there's a contract between bank and the customer. So Indian Contract Act, this becomes very important. The contract of agency defined under section 182 of the Indian Contract Act. Agent is a person who is appointed to do something on behalf of another or represent another in dealing with third parties. And a principal is the person for whom such work is done or who is represented by the agent. So in simple words, an agent is like a representative. He acts on behalf of principal and creates legal obligations between principals and the third party. With respect to authority, the authority of the agent means the power he has to act on behalf of principal. This can be divided into two parts: express authority and implied authority. Express authority is the authority which is clearly given in words, which are spoken or written. So a person writes to his lawyer to sell his property. The lawyer now has express authority. Implied authority is not directly given but can be inferred from the circumstances. So a shop manager has implied authority to buy goods for running the shop. So that is implied authority. It is inferred from circumstances and it is given in clear words. Meaning of agency. So test of agency is one such measure. Meaning to say agent binds the principal by his authorized acts. So if he does something and the principal is bound by that act, then there is agency. Agent creates a contractual relation on behalf of principal. So for example, a person appoints another person as his agent. So A is the principal, B is the agent, and B does some act, B does some agreement with C. So here contractual relationship between A and C is also created. Relationship between agent and principal itself forms a contract. So there are three uh, relationships between which are created in a contract of agency. So it is first between A and B, second between B and C, and third between A and C. So principal and third party, agent and third party, principal and agent. And also there is no consideration required to create an agency. This is an important pointer which you need to remember, that consideration is not required in order to create a contract of agency. Authority of agent. So we have discussed about express and implied. Extent of authority. So an agent has authority to do everything that is necessary and lawful for completing the assigned task. In emergencies, the agent can take all necessary actions to protect the principal from loss, just as a reasonable person would do for himself. So, a shipping agent during a storm sells some goods from the principal's shipment to prevent a bigger loss, it is acceptable. Uh, Generally, an agent cannot pass on his authority, so there is no delegation. But a sub agent can be appointed if the business requires it or if trade customs permits. The main agent is responsible to the principal for the acts of the sub agent. Keep that in mind. And if the agent acts beyond his power without the principal's knowledge, the principal can rectify the act, then it will become valid, or the principal can disown it. Simply, principal can disown it, and the agent is personally liable for that particular act. Del credit agent. So del credit agent is a special type of agent. He not only sells good on behalf of the principal, but also guarantees payment from the buyer. So for this extra risk, he gets an extra commission. So this commission is known as del credit commission. So if buyer fails, this agent will pay. In simple words, taking he's not only acting as an agent but also a guarantor for the credit which is extended to the buyer. And if the buyer defaults, this person, this del credit agent becomes responsible, and that's why he's charging an extra remuneration. Termination of agency. So agency relationship does not last forever. It can end in ways like when the principal revokes the authority or the agent himself renounces the work, the purpose of the agency is completed, or either the principal or agent dies or become of unsound mind, or the principal is declared insolvent. So in all these cases, uh, the agency of the relationship of the agency becomes terminated. Duties of an agent. So an agent must act in the best interest of the principal, and his main duties include to follow the directions and the custom. So he must follow the instruction of the principal. If there are no instruction, he should follow the usual business custom. If he acts otherwise and a loss has incurred, then he must compensate the principal. He must keep proper accounts. So he should maintain proper accounts and show them whenever the principal demands. And he should not secretly deal for his own benefit. There should be no deal on own account. And if he does, the principal can cancel that transaction. Agent's remuneration. So normally an agent is paid after completing his work. However, he can keep money received on sales towards his commission even if all goods are not sold. If the agent misbehaves or acts dishonestly, he loses his right to remuneration, and the agent has a right to keep principal's goods or papers or property until the principal clear of all the agent's due. So, an agent has a right to lien. What is the legal position of principal for agents act? So, for lawful acts, the principal must compensate the agent for all lawful acts done within the authority. Even if the act unintentionally harms someone, the principal must indemnify uh, for the act of agent if the act is done in good faith. And if the agent commits fraud while acting within his authority, the principal is also liable for those frauds. The key point to remember here is that the agent is acting within his authority, whether for the benefit of principal or for himself. Now let's understand contract of bailment. A contract of bailment happens when one person delivers goods to another person for specific purpose under an agreement that once the purpose is completed, the goods will either be returned to the bailer, the person delivering the goods, or disposed of as per his instructions. So the person who is deliver the goods is known as the bailer, and the person to whom the goods are delivered for that specific purpose is known as bailee. And this contract of bailment is defined under section 148 of the Indian Contract Act. The key idea is that ownership of the goods stays with the bailer, but the possession shifts from bailer to bailee. So when you give your cloth to a dry cleaner, uh, it is a contract of bailment. Or you leaving your car at the service station for repair, it is a contract of bailment. Or when you hand over goods or your gold jewelry to the bank as security, it is a contract of bailment. So in all these cases, you remain the owner, but the possession transforms from you to that particular dry cleaner or that service station guy or to the bank. So the possession transfers. Now let's understand about the features of bailment. So there's a delivery of goods. Bailment requires physical delivery of goods. So delivery can be actual or constructive. Actual meaning to say handing over the goods, or constructive meaning to say handing over the keys of a warehouse where the goods are stored. Bailment exists only when goods are delivered for specific purpose. For example, delivering ornaments to a goldsmith for repair. There should be a return of goods. So there should be a return of goods. So the bailee must return the same goods, not their equivalent. So if you deposit your gold chain in a bank locker, the exact chain must be returned and nothing equivalent. So bailment arises from a contract. So there's a contractual relationship. It is based only on a contractual relationship. If property is deposited by court order, it is not a bailment. It arises only from contract. And possession should not be considered equivalent to the ownership. The bailer remains the owner. And bailment, when you deposit your money in the bank account, it is not bailment. Keep that in mind. When you uses bank locker and you put something into your safe custody, then there is a contract of bailment. Or when you give your gold jewelry against the loan, when the charge created is pledge, then it is also bailment. So pledge is a special type of bailment, and we'll understand it in types of charges. But the contract, main contract here is of bailment. Duties of the bailer. Uh, there should be a disclosure of defects by the bailer. So a bailer must disclose the known defects in the goods. If goods are hired, then bailer is responsible even for unknown defects. For example, if a person lends a scooter with faulty brakes without informing, then the person is liable for the damages. Bailor's duty of care. So bailee must take care of the goods as much as a reasonable person would take care of his own. So if you leave your laptop with a friend and he keeps it safely, but it is stolen during a burglary, he is not liable. But if he leaves it unattended in a park, then he is liable. There is return of goods. So bailee must return goods once the agreed time is over or the purpose is completed. If there is a delay, then he will be liable. There should not be an unauthorized use. So if bailee uses goods beyond the agreed purpose, bailer can terminate the contract and claim the damages. And bailment is voidable if bailee himself violates the condition. So the contract of bailment becomes voidable. If there is a mixing of goods, so mixing of goods can be done with the consent of the bailer or without the consent of the bailer. So if it is with the consent, then the bailer and bailee shares uh, the joint ownership in the proportion to their shares. For example, a baler has 100 kg of wheat, say particular A wheat, and B has say 50 kg of particular B wheat. So when they are mixed, so it becomes 150 kg. So A will be A will enjoy the ownership, two-third ownership, and B will enjoy one-third ownership of these goods. It can be done without consent, and there are particular two cases. If it is also done without consent, then the goods can be separable or inseparable. So in this case, in this particular case of wheat, the wheat will not be able to separate, we will not be able to separate the wheat A from wheat B. So if it is inseparable, then the baler is entitled to compensation for loss. So bailer must be compensated in this particular case. And if it is separable, for example, a particular a white bead is mixed with a particular red bead, so it is separable, although it will take some expense to separate them. So, but the property is separable. So the bailee pays the expense for separation. If there is any increase in the profit, so if there is any increase in the bail goods, it must also be returned. So if a bailed cow gives birth to a calf, so both cow and calf must be returned. Rights of bailee, this a right of compensation, right to compensation. So if bailer was not entitled to bail goods and bailee suffers a loss, then bailer must compensate. There is a right to indemnity if bailee delivers goods back in good faith as per bailier's instruction. He is not liable even if bailer has had no ownership. So if A gives B's watch to C, claiming it is that it is his own, and C returns it to A, then C is not liable to B. If bailment is gratuitous, so without any payment, bailer must reimburse bailee for necessary expenses. If you give your horse to a friend without payment, you must bear its feeding cost at least, right? So there is a right to recover expense. Now, Bailey's lien. So, if Bailey improves goods with his skill or labor, he can retain them until he is paid. So, if a tailor stitches clothes to make it a suit, so he can retain that suit until the payment has been made to him. And there are two forms of lien. There is a particular lien, and then there is a general lien. What I have just discussed is an example of a particular lien. And for general lien, then there are certain professionals like banker, policy brokers, factors who can retain goods for journal balance of accounts unless it is agreed otherwise. So bank can keep pledged jewelry not only for one loan but against all dues owned by the customer. So it is a journal lien. Now let's talk about type of charges. We start with assignment, then move on to lien set off. We'll understand what is a pledge, mortgage, and lastly we'll understand right of appropriation. So with respect to assignment, assignment is a way for a borrower to provide security to a bank by transferring a right, a property, or a debt to the bank. The borrower who transfers the right is known as the assigner, and the bank or the person receiving the right is known as the assignee. Now, what is the purpose in banking? Let's first understand it, then we'll move into technicalities. So, a borrower often assigns actionable claims such as book debts, government payments, LICs. So, book debt is money owned by a customer for goods sold or services rendered. There can be government payments, or there can be life insurance policies, which we have covered in our previous unit. So, the bank can claim this amount if the borrower defaults, right? So, borrower assigns them and borrows money from the bank, and if he defaults, the bank can claim these amounts from the say insurance policy provider or from the customer who owes something to the borrower in that particular manner. Uh, Legal basis of assignment is that section 130 of the of property act states that the transfer must be in writing and it should be by the assigner or authorized agent, right? So a transfer or actionable claim can only be through a written signed instrument. Actionable claim is defined under section 3 of the Transfer Property Act. So an actionable claim is a claim to any debt which is not secured by mortgage, pledge, hypothecation or any beneficial interest in movable property which is not in claimant's possession. Now assignment can be done with or without consideration. There is no prior notice to the debtor. So, though no prior notice to the debtor is legally required, and the bank can sue the debtor directly in case there is a default, and the bank inherits both right and liability of the assigner. So before understanding these case laws, let's understand types of assignment. So there are three types of assignment per se: absolute, equitable, and legal. So absolute assignment is full transfer of rights, which is legal in nature and requires written notice to the debtor. Equitable assignment is a transfer where formalities are not fully completed and there's less of its enforceability in the court of law. And legal assignments are fully compliant with writing and notification formalities, and they can be enforced in court of law. Now let's understand these case points. So in Dena Bank versus Bikabhai uh, Pare case, it is held that the government debts have priority over other debts if statutory provisions exist. And its Sirpur paper mill case, it was held that a machinery which is fixed to the earth may still be considered movable property for excise duty purposes. Installation does not automatically convert it into movable property. Lien, we have discussed lien in detail in our unit number 7. Lien in set off we discussed there. So what is lien? Lien gives the banker the right to retain possession of goods or securities until the customer paid its debt. So a lien, that's why is also known as an implied pledge, because it gives the banker the right to retain the possession. Section 171 of the Indian Contract Act states that a banker has a general lien on goods or securities which are received in ordinary course of business. So if a customer deposits valuables as part of banking business, the bank can hold them until the dues are cleared. For items which are left um, inevidently, which are not intended as security, so they cannot be held as lien. So if a borrower leaves a packet which contains shares, his life insurance policies in the bank, so bank cannot hold a lien over these uh, securities. A negative lien is a special type of lien where borrower undertakes not to create any charge on assets without the bank's permission, and it applies to assets which are not in possession of the bank, and no registration is required for these negative liens. Set off set off allows the bank to adjust a customer's debt with any amount the bank owes to the customer. So net result is the balance payable to the bank or to the customer. So it is a statutory right to adjust the mutual debts between the debtor and the customer and the creditor. So the creditor owes something to the bank. So creditor has fixed deposit, say, of 1 lakh rupees, and bank has given him a loan of 50,000 rupees. So a net amount of 50,000 rupees will be payable to the customer in this particular case. There are certain key features. So debt must be certain and existing. Future or contingent debts cannot be used set off. You cannot use set off against a guarantor until his liability is determined, and current account balances cannot offset contingent liabilities. Parties must be mutually indebted, and credit in partner's personal account can offset partnership account, which is a joint liability. Lien cannot be exercised at the same time as set off. Only one right is applicable at one particular time. Either you can use the right of lien or you can use a right of set off. Automatically set off. So meaning to say there is no need to provide a notice in this particular cases. So when there is a death, insanity or insolvency of the customer, insolvency of partner, or winding up of a company, receipt of a garnishee notice or notice of assignment of a credit balance is there. So in this particular cases, no notice is required to be provided. So status of availability of set off. So in particular cases, for example, if there's a deposit in the name of partnership and a partner has taken a loan, then you cannot use this balance which is in partnership firm's account to set off. So, but if there's a vice versa, if the deposit is in the name of partner and the loan is taken in the name of partnership firm, then then the right of set off is available. For single person deposit name and loan is taken jointly, then there's availability of set off. But again, if the deposit is in joint account and the loan is taken by one of the joint holders, then you cannot set off the amount from this joint account loan. Single name, same name, loan in same name, status available, proprietorship, again, they are not considered separate in the eyes of law. So status is available for set off. Uh, for trust and trustee, in either case, the status is not available. In dividend account of a company and the loan is taken in the name of company, then again the status is not available. And if the deposit is in minor's name and the loan is taken by guardian, then again this will the right of set off will not be available. Now let's understand hypothecation. Hypothecation is nothing but a charge which is created over movable property without transferring the ownership or physical possession. So there is no transfer of ownership or possession. Hypothecation is defined under SARFAESI Act. So in hypothecation, borrower retains the possession and the ownership, and bank has a legal right to claim or sell the goods if borrower defaults. It is primarily used for working capital loans. If I particularly quote section 2 definition, so it defines hypothecation as a charge in or upon any movable property which is existing or future, which is created by the borrower in favor of secured creditor without delivering of possession to the creditor as security for financial assistance, and it includes floating charge and their crystallization into fixed charges. So it includes present or future movable property. There is no delivery of possession. It includes floating charge and its crystallization. It differs from pledge and mortgage. So before that, just understand the key characteristics that it is for movable property only and not for immovable property, only for movable property. There is no transfer of ownership or possession. Then third is bank has a equitable charge. Bank has an equitable charge, and floating charge can convert into fixed charge upon specific event. So there is a crystallization, floating charge into fixed charge. Now, how it differs from pledge? Because in pledge, the possession also passes. The possession remains with the borrower and not the owner. And mortgage applies to immovable property and not movable property. If hypothecation, on the other hand, applies to movable property. Now, let's understand the aspects of related to hypothecation. So this particular facility is provided to respectable customers, number one, and it can be given to sole proprietors, partnership, joint companies, individuals. Bank generally provides this facility to trustworthy customers, especially companies because registration at Companies Act of which CERC makes charges legally enforceable and it reduces risk of multiple claims or disputes. So, in which situation hypothecation is used? So, hypothecation is particularly used when goods continuously change uh, or they are in use. For example, work in progress goods which are used in factories, or goods which are handled daily and in the processing units, goods which are sold daily and which requires constant turnover, say in showrooms, in retail shops. So, for these particular goods, the facility of hypothecation is used. Again, there are certain drawbacks that the borrower retains the possession, so bank cannot directly control or monitor the goods. A borrower may sell high value goods and leave obsolete stock for the bank. A borrower may pledge or hypothecate the same goods to other bank, or selling goods in default is time consuming, costly, and legal complications are involved. Floating charges created within 12 months of winding up of the company becomes invalid under Companies Act. And if market value of goods drop, hypothecated stock may not cover the loan. So these drawbacks are always there. But what are the precautions that a bank can take? There's also one thing which we need to discuss before the precaution of the bank. So legal registration and protection. So companies must register hypothecation. They must register hypothecation with registrar of companies. And if there is a failure, uh, then failure makes it void against liquidator or other creditors. With respect to movable property, charges registered with CERC provides public notice and legal protection and protects banks' right and prevent borrower from hypothecating same goods elsewhere. Right. Now let's move on to precautions taken by bank to reduce these drawbacks we have just discussed. The bank adopts several safeguards, like there should be a single bank borrowing. It ensures that borrower is not using the same stock to secure loans elsewhere. Public notice is provided, so on display boards at storage locations a notice is particularly placed declaring that the goods are hypothecated. We register the charge with registrar of companies or with CERC. We do stock verification on regular basis. So regular statements of stock with respect to quantity, quality, and values there. Periodic physical inspections are done. Periodic checks are done to ensure security margin is maintained. We track the borrower solvency, profitability, and market fluctuation, and we take steps if value of goods drops or borrower's financial condition worsens. A hypothecation is particularly governed by hypothecation deed. So we have hypothecation deed. So the hypothecation agreement is a legal contract that protects bank, and in hypothecation deed we generally include clauses like loan request, description of goods, that there should be no future income branches, inspection rights, insurance, that the borrower will insure the goods, uh, security will maintain a margin, borrower will pay for taxes, rents, or other expenses, that the bank can demand repayment of the loan anytime on default of the bank, the borrower acknowledges the debt, there is a continuous security uh, that the hypothecation remain valid even if account shows temporary credit balance, and the borrower agrees to hand over goods if demanded by the bank. Now let's understand pledge. So a pledge is a legal arrangement where the borrower deliver goods to a lender as security for repayment of a debt or promise or performance of a promise. So the lender can retain and if necessary sell the goods to recover the debt. in case of default. It is defined under section 172. So it is a special type of bailment. So section 172 defines the contract of pledge as bailment of goods for the purpose of providing security for payment of debt or for performance of a promise. The person who delivers the goods is known as pawner, and the person who receives the goods is known as pawnee. Uh, what are the essentials of a valid pledge? So there's a contract regarding specific goods. So the goods must be specified. It should be existing in nature. Pledge cannot be created for future goods. Keep that in mind. Hypothecation can, on the other hand, be created for the future goods. There is a delivery of possession. There can be actual delivery or constructive delivery. Bailment must be by authorized person. So the goods must be delivered by the pawner or someone who is authorized to act on their behalf. The delivery must be to secure the payment of a debt. So the purpose of delivery should be to secure the payment of debt or the performance of the promise. The pawnee gets special property rights. He gets the possession. So only special property passes to the pawnee while ownership remains with the pawner. Once the debt is repaid, the ownership and control they are fully revert to the pawner. Legal implications. So ownership retention is with the pawner. So the pawner retains the ownership and the possession is with the pawnee. So the actual or constructed delivery is essential. Without a transfer of possession, a valid pledge cannot be created. With respect to mode of delivery, there is physical delivery or there can be symbolic delivery. Atonement can be there. So with respect to physical delivery, we directly transfer the goods to the pawnee. With respect to symbolic delivery, the transfer of documents or keys are given, which gives the effective control to the pawnee. For example, goods are placed in a warehouse, and if you hand over the keys of the warehouse where the goods are stored, you are doing a symbolic delivery. There are atonements to a third party, like a warehouseman acknowledges holding goods for pawnee. It is known as atonement. So delivery can be actual, constructive, or symbolic. Agreement of pledge can be written or it can be implied. So pledge can arise from circumstances or conducts, meaning to say implied or inferred by circumstances, or it can be written. So written agreement clarifies the terms, rights, and remedies only for existing goods and not for future goods. And once the goods are lost, the pledge is lost. So when the possession is no longer with the pawnee, so he loses the pledge. Now, who can create a pledge? So, owner of the good can create a pledge. Mercantile agent can create a pledge if the possession of goods or documents is with him with the consent of the owner. He acts in the ordinary course of business, and pawnee acts in good faith without the knowledge that the agent lacks authority. In all these cases, mercantile agent can create a pledge. A person under voidable contract can create a pledge until unless the contract is not rescinded. So until not rescinded, the contract, a voidable contract, is a valid contract. So a person in possession under a voidable contract can also create a valid pledge, and seller who retains the possession may pledge goods even after sale if pawnee acts in good faith. Now pawnee can repledge goods to another lender, but only to the extent of his interest. Original pawner retains the primary rights to reclaim goods upon repayment of the debt to first pawnee. Even if goods are with the second pawnee, repayment to first pawnee restores the pawnee's right. Now, what are the rights of pawnee? So, there's a right of retainership. So, the pawnee can retain possession of the pledged goods not only until the original debt or obligation is repaid, but also for interest on debt or all proper and necessary expenses incurred for preserving the pledged goods. While ordinary expenses allows the pawnee to retain the goods, extraordinary expenses cannot um, create a lien. The pawnee cannot retain the pledged goods for debts or obligations unrelated to the original pledge, and the pawnee has same remedies as an owner against third party who interferes with the pledged goods. Now, in case there is a default by pawner, the pawnee has three options. He can sue the pawner, he can retain the goods, or he can sell the pledged goods. If he sues the pawner for repayment of debt or performance of the promise, he can do it. Now he has a concurrent right to sue and retain the goods. So he can right to retain uh, the goods, and then he can sue for the debt. So there, it is a concurrent right. He can do this at the same time, right? And then there is an alternative right that he can either retain the goods or he can sell the goods. So this is concurrent and this is alternative right. So concurrent or alternate, but again he has to provide a reasonable notice. And after the sales, if the proceeds are greater than the debt, so the pawnee should return the surplus, and if the proceeds are less than the debt, then the pawnee still remains liable to pay for the balance. And pawnee can sue third party the damages shared between pawnee and pawnee, and there's a limited interest of pledge, so it is valid only up to the extent of pawnee's interest. So in event of loss or damage, while in possession, the pawnee steps into the shoes of owners for legal purpose. If goods are stolen or damaged, the pawnee can file a suit against the wrongdoer, and any damage which is recovered are shared between pawnee and the pawner according to their respective shares. Now, rights of pawner. So, the pawner is the person who delivers the goods as security for loan or obligation. Even though the pawnee holds the goods, the pawner still enjoys certain protection under the law. He has a right to receive a notice of sale. So, the pawner must receive reasonable notice before the pawnee sells pledged goods in case of default. He has a right of surplus proceeds. So, if the pawnee sells the pledged goods after giving reasonable notice, any amount exceeding the debt must be returned to the uh, pawner, and he has a right to redeem. So, the pawner can redeem the goods even after the stipulate repayment date, provided the pawnee has not yet sold the goods. Uh, with rights comes the duties of pawner. So, the pawner has certain duties to protect the pawnee's interest and ensure smooth handling of the place. So, the pawnee must inform the pawnee about any material defect or extraordinary risk associated with the goods. He has to pay for any preservation expenses which are necessary expenses incurred by the pawnee to preserve the goods. If the pawnee sells the goods in a forced sale and the proceeds are less than the debt, the pawnee must pay the balance. The pawner must own the good at the time of pledge, and bank typically requires a written pledge agreement covering that all the goods and associated documents of title are deposited. There is a declaration that the pledge covers existing and future debts, interest, and expenses. The pledge acts as a continuing security without limitation. Pawner ensures goods are insured adequately and maintains agreed margin. There is a commitment to pay all amount secured by the pledge on demand, with the right of sale in case of default and the right of the bank to ensure goods or hire brokers with the cost borne by the pawners. Pawners submits periodic stock statement and allows inspection by the bank. There is a declaration that the bank's journal lien right remains unaffected. With respect to advantage, there is ease of sale. So, since the pawnee has the custody of goods, sale in case of default is straightforward. Uh, Close supervision can be done by the pawnee, which prevents the pawner from creating subsequent charges or manipulating the stock. Even if goods are lost or damaged, bank can recover under insurance, and pledge requires less documentation and legal formalities when we compare it with mortgage. What are the precautions in pledge? So it ensures pawner has clear title to goods. We draft a complete pledge contract covering all the clauses. We maintain full cover over pledged goods. We display signboards at the godown stating that the goods are pledged. Exercise ordinary prudence in preserving goods to prevent loss of value. We conduct periodic inspections to verify quality, quantity, and valuation, and to ensure maintenance of reasonable margin throughout the loan period. Now let's understand the distinction between pledge and lien and pledge and hypothecation. So with respect to right to sale, pawnee has right to sale in case of pledge. There is no right to sale in lien, whereas pledge, in pledge the pawnee has right to sale. Pawnee acquires special property in the goods, so general ownership remains with the pawner. In lien, there is no transfer of interest. The lien holder only retains the possession. Pledge can still be enforced, can still enforce the debt through legal remedies. Lien disappears immediately if possession is lost. Pledge is assignable, whereas lien is not assignable. In hypothecation, the main difference is of possession. So possession is delivered in case of pledge, whereas it is not delivered in case of hypothecation. Pawnee can sell the pledge goods in case of pledge, and in case of hypothecation, lender must first take the possession before selling the goods. The applicability of pledge is with respect to movable assets, shares, or goods, whereas hypothecation is used in case of loan is where the loan is given against vehicle, loan is given against the stock or accounts receivables and inventories. Now let's understand about some of the important case laws. So first we have Movi Mercantile Bank versus Union of India. So here a company entrusted railways with boxes and endorsed the railway receipt to the bank. Railways failed to deliver the goods. Bank filed a suit for recovery of the value of goods. So it was held that the bank can recover the value of goods because the pledge can be created by endorsement of the railway receipt, because it is a constructed delivery and constructed delivery is sufficient. Actual delivery is not mandatory. Bank as pawnee had right of the owner under the pledge. Lalan Prasad case. So in Lalan Prasad versus Rehmat Ali, a loan was provided with a pledge of uh, some arrows scraps. The pawnee lost the possession of goods. So the decision of this case was that the pawnee can sue for debt recovery only if he is able to return the goods to the pawner when the debt is repaid. So pawnee's right to file a suit is conditional on ability to return the goods upon redemption. Then we have Bank of Bihar versus State of Bihar case. So here the bank lent money which is secured by sugar pledge. Government seized the sugar and sold it to recover the government dues. Now, the decision of this case is that the government cannot override the pawnee's right, and the bank is entitled to recover the money from the government. So the pawnee's right are legally protected even against third party claims. And then we have Standard Charter Bank case. So here it was held that the pawnee is entitled to accreditations as part of security. Upon default, pawnee can sell pledge property including accreditation. So if there is any increase in value during the pledge period, it belongs uh, to the pawnee. But again, pawnee can use it as part of the security. Now let's move forward to mortgage. So mortgage is a way of using immovable property as security for a loan. So mortgages are a type of charge which are applicable on immovable property, and it has been defined under Transfer of Property Act, uh, section 80, section 58 to 99, and section 102 to 104 are the relevant sections for us. So it is defined under TPA of 1882. So, when a borrower gives a mortgage, they transfer an interest in the property. So, keep that in mind. In a mortgage, there is a transfer of interest to the lender. So, the person who is transferring the interest is known as mortgager, and the person to whom the interest is being transferred is known as the mortgagee. And this transfer of interest is particularly to secure repayment of money lent or to be lent. So, the mortgager transfer interest. The purpose is to secure the money. Uh, and this money could be which have been already been borrowed or money to be borrowed in the future, and the liability arises from non-performance of some obligation. So bank deals with immovable property, security is created when there is transfer of interest, and it does not apply to movable property. For movable property we have pledge, we have hypothecation. uh, so this is sale. In sale there is a transfer of ownership, right? So, in sale, there is a transfer of ownership. In mortgage, there is transfer of interest. And if the value exceeds 100 rupees, so the sale must be done via registered document. The lift property happens when the seller gives the buyer possession or someone the buyer directs. So, this is different from mortgage, which is not transferring full ownership, but only creating an interest in the property. Definition of mortgage is provided under section 58A. So, section 58A states that a mortgage is a transfer of interest in specific immovable property to secure repayment of money advance to be advanced or arising out of particular pecuniary liability. Essential elements is that there is a transfer of interest. A mortgager must transfer some interest in the property, and the purpose is to secure the loan. Mortgage is the person who transfers this interest. Mortgage is the person in whose favor uh, this interest is being transferred. Mortgage money refers to the money which has been lent by the bank, this mortgagee. It includes principal and interest amount, and mortgage deed is the instrument which is used to transfer. So we just like we have a hypothecation deed, pledge deed. Uh, so we also have a mortgage deed. So eligibility to mortgage, who can transfer this interest, who can be a mortgager. So any person who's competent to contract is eligible to transfer the property, and he can be an absolute owner, a co-owner, a karta of HUF, a guardian, or the executor or administrator. So executor or administrator can also mortgage property belonging to the deceased person. Now let's understand about the types of mortgages. So there are particularly 6 types of mortgages, starting with simple mortgage. A simple mortgage is when a person borrows money and promises to repay it but does not hand over the property to the lender. If the borrower fails to repay, the bank can go to the court and get the property sold to recover the money. So the borrower keeps the possession of the property, and the borrower personally promises to repay the money. If the borrower defaults, the lender can approach the court to sell the property. The key features are that the lender cannot sell the property directly. There's no right to the mortgagee to sell without the court intervention. So court intervention is required. If the property does not cover the full debt, the borrower remains personally liable for the balance. The lender cannot claim rent or produce from the property, and the lender does not take the possession of the property. A registration is required if the loan amount is more than rupees 100. Mortgage by conditional sale. So here the borrower pretends to sell the property. There's an sale. Ostensible sale is there. So the borrower pretends to sell a property to the lender on the condition that if the loan is not repaid on time, the sale becomes final, and if the loan is repaid, the property returns to the borrower. So, to create an mortgage by conditional sale, the property is ostensibly sold, but it is not a real sale. If the repayment is not made, the lender can get a court decree to make the sale absolute, and the borrower loses the right to redeem the property. The sale becomes absolute. There is no personal promise to repay, and the lender cannot claim other assets if the property sales is insufficient. The bank does not prefer mortgage by conditional sale because there is no personal liability of the borrower. Recovery depends on court intervention, and there is no recourse to other assets if sale proceeds are insufficient. Usufructory mortgage. In usufructory mortgage, the borrower gives possession of the property to the lender. The lender can use the property and receive rent or profit to pay off the interest on loan. The lender is legally in possession, and the lender can collect rent or profit instead of charging interest. So, if there is no repayment, personal repayment promise exists, the lender cannot sue for money, and no specific repayment time is there. So, the lender can keep possession until the debt is repaid. And if the borrower does not redeem in 30 years, the lender becomes the absolute owner. Again, this is not preferred by bank because recovery may take a very long time, and again there is no personal guarantee to repay. English mortgage. An English mortgage is where the borrower transfers the property absolutely to the lender, but the promises to repay the loan by a certain date. Once repaid, the lender transfers the property back. So there is an absolute transfer to the property to the lender. There is a personal promise to repay by a specific date. Conditions are there that the property will be retransferred once repayment is done, and the lender can sue and sell the property if repayment fails. And this is the most common type of mortgage uh, which banks are involved in. So, mortgage by deposit of title deeds and equitable mortgage. So, equitable mortgage is not defined under the Transfer of Property Act. It is mortgage by deposit of title deeds. Um, so, deposit mortgage by deposit of title deed is a way of giving a loan against property without creating a formal mortgage deed. So instead of registering a legal mortgage, the borrower gives the original document of ownership of the property to the bank as security, and according to Section 58F of the Transfer of Property Act, this is allowed in certain towns or other towns which are notified by the state government. The property itself may be anywhere, only the place where the deeds are deposited, it matters. And what are the document of title? So, document of title are papers that prove the borrower legally owns the property and has a right to use and enjoy it. A sale deed, conveyance deed, any legal instrument showing the ownership is a documents of title. And in Syndicate Bank versus Modern Title and City Works, the court clarified that title deeds are legal papers proving a person's right over a property. With respect to key features, to create a mortgage by deposit of title deeds, some of the conditions are to be fulfilled, like delivery of title deeds. So the borrower must give deed to the bank and its authorized agent. There must be an intention to create the security. The location restriction are there, so the deed must be delivered in a notified town. The property can be anywhere, but the deed must be delivered in a notified town. There are three ingredients uh, that a debt exists. There should be a deposit of title deeds and the intention that the deeds are for the purpose of securing the debt. There is no need for a written mortgage deed. So, unlike other mortgages, an equitable mortgage or a mortgage by deposit of title deeds does not require a mortgage deed signed and witnessed. It does not require registration, and other type of mortgages must be in writing and registered, apart from mortgage by deposit of title deeds. Now, there is a certain procedure to create this particular type of mortgage. The usual steps involve the title clearance certificate, which is obtained from a lawyer confirming that the property is free from legal disputes and it can be sold. Land records are searched and ownership is checked. So, you have to check as a bank records for last 30 years to ensure no income branches exist. Then the original title deeds are delivered personally by the borrower or authorized agent in the notified town. Bank prepares a memorandum of entry. It records the equitable mortgage. Paid the memorandum as per state laws. Stamp duty is paid, and registration is not required. And in if a company is borrowing, it must pass a board resolution authorizing an officer to deposit the deeds. After the memorandum is recorded, the charge is filed with the registrar of companies. Uh, with respect to merits, it saves registration charges. It is quick, simple, minimum formalities are required, and it is confidential. It does not attract public attention, protecting the borrower's privacy. With respect to demerits, court intervention again is required in case of default. So, if the borrower default, the bank must go to the court to sell the property, which is time consuming. Uh, there are trust property issues. If the borrower holds the deed as a trustee, the beneficiary claims uh, prevail over the bank's mortgage. So, bank must carefully verify the title before accepting the deed, and always a risk of subsequent mortgage is there. So, the borrower might create another legal mortgage with a different lender. In India, a deposit of original title deed ensures priority. So, the equitable mortgage prevails over any later mortgage. In England, however, subsequent legal mortgage can override an earlier equitable mortgage, but this is not the case with in India. Anomalous mortgage, it has not been defined. It is simply a special type of mortgage which can be created by mixing different type of mortgages. So any mortgage which does not fall under the category of simple mortgage, mortgage by conditional sale, usufructuary mortgage, English mortgage, or mortgage or by deposit of title deeds is an anomalous mortgage. It is essentially a catch-all category of mortgages that does not fit neatly into other types. It must be a mortgage according to Section 58 of the Transfer of Property Act. It has been negatively defined. This means it is not defined by what is not, that is, it should not be any of the standard type of mortgage listed above. It is a combination of different mortgages, often as like combination of a simple mortgage, usufructuary mortgage, and mortgage by conditional sale. Uh, in some regions, local practices may create other forms of anomalous mortgage. Think of it like a hybrid mortgage, tailored to specific needs, often created by customs or agreement between the parties. Now, let's understand priority of mortgages. So, the law decides whose mortgage take precedence if multiple mortgages are created over the same property. As a general rule, Section 48 of the Transfer of Property Act states that there is a priority. Priority is based in time. So, first in time is the first in right. Any later created mortgages are subject to earlier ones, but special cases exist. So, Section 47 of the Registration Act 1908 specifies that even if a mortgage is registered later, and if it is executed earlier, then the execution date decides the priority. For example, mortgage A was executed on January 1st, 2025, but was registered on February 1st, 2025, and mortgage B was executed on say January 10th, 2025, but it was registered on January 20th, 2025. So according to date of registration, mortgage B should prevail, but this is not the case because mortgage A was executed earlier, although it was registered later. So mortgage A has priority based on execution date. Priority between registered and unregistered instruments. So normally, registered instruments have priority over unregistered ones, but there are certain exceptions. Prior mortgage by deposit of title deeds is not affected by later registered mortgages, as this type of mortgage does not need registration. Some rules are also borrowed from ancient Hindu law and English law principles like delivery of possession impacting priority. With respect to limitation for filing a suit to recover mortgage debt by sale of mortgage property, the limitation period is 12 years, and for foreclosure of mortgage property, the limitation period is 30 years. And now, what does this term foreclosure means? Foreclosure means that the bank can take ownership of the property to recover its dues. So, for foreclosure, it is 30 years, and if the borrower fails to repay, the bank can file a suit to sell the mortgage property within 12 years. What is the difference between a mortgage and a pledge? Pledge is created with respect to a movable property. Mortgage is with respect to immovable property. Number one, the borrower keeps the ownership. Lender only keeps a limited right. In mortgage, legal ownership passes to the lender, but the borrower has the right to redeem it later. Foreclosure is not allowed in pledge, and it is allowed in mortgages in certain cases though, but it is allowed on the type of mortgage and court decrees. Enforcement of mortgage. So, with respect to type of mortgage which are preferred by bankers, so mortgage by deposit of title deeds, simple mortgage, and equitable mortgage is the most common practice. But these two types of mortgages are preferred by the bankers. With respect to enforcement of mortgages, so bank can recover mainly by two ways: by sale without court intervention and enforcement through court. So these are the two methods by which banks can recover their dues. So under section 69 of the Transfer of Property Act, the lender can sell the mortgage property without going to the court in specific cases. So if it's an English mortgage and neither party belongs to specified region or a class, if the mortgage deed gives explicit power to the bank to sell the property, and the mortgage, if the property mortgage is in major cities which are notified by the government. But there are some conditions before exercising this uh, sale. So the borrower must give a written notice, the default must continue for 3 months, and interest of at least 500 must be unpaid for 3 months. So these two conditions are to be fulfilled before selling the property. And with respect to distribution of sale proceeds, you have to first pay all the costs and expenses related to the sale, repay the mortgage amount and other dues, and thirdly, if there remains any balance, it goes to the property owner. And there is legal protection to the purchaser, that the purchaser title cannot be challenged for irregularities, and remedy for irregularity lies only in damages against the mortgagee, and nothing else. And SARFAESI Act. So bank can also use SARFAESI Act for loan above 1 lakh to take possession and sell the mortgage property without court intervention. And magistrates can help in forcible possession if it is required. With respect to enforcement through court, so when court intervention is needed, banks file a civil suit to recover dues. This is common for loans below 20 lakh rupees, or when section 69 conditions are not met. For loans above 20 lakh rupees or DRT, the help of DRT can be taken. Uh, some of the key points are that you have to file suit in the court with jurisdiction over the mortgage property. You include all the subsequent mortgages. Uh, you have to include all the subsequent mortgagees in the as defendants for multiple debts. Sue on all debts together unless the court permits separate suits. You have to ensure claims are within the limitation period. If personal covenants is to be enforced, court gives a two-stage decree, a preliminary decree and a final decree. Preliminary decree. So this particular decree gives time to the borrower to repay, and in final decree, if borrower fails, bank can proceed to sell the property with the help of court existence. So for 20 lakh or more, you can use uh, debt recovery tribunals, and for 20 lakhs and less, civil suits are to be filed. We have discussed these pointers, okay? So don't worry, we have discussed it. Lease of immovable property. So what is a lease? A lease is an arrangement where the owner of the property allows someone else to use and enjoy the property for a certain period or even indefinitely. In return, the lessee, so the person who's transferring the property, who's transferring this right to enjoy. So see, sale is a transfer of ownership, mortgage is a transfer of interest, and lease is a transfer of right. Okay. So the person who transfers this right is known as lessor, and the person to whom this right has been transferred is known as lessee. So lessee is the person who is actually enjoying the property. In exchange, he gives a rent or a premium. So it should not be confused with sale, because sale is an absolute ownership. A lease is only a transfer of possession or enjoyment. The ownership remains with the lessor. Duration of lease for agriculture or manufacturing purposes. If there is no written lease or no local usage rules, so for agriculture or manufacturing purpose, lease is assumed from year to year, and either party can end it by giving a notice of 6 months. For any other purpose, the lease is assumed from month to month, and it can be terminated by giving a notice period of 15 days. Now, Chapsi Bhai, Ganjiji Bhai Danand versus Purushottam is an important case to understand. In this particular case, a lease was allowed on in somewhat 1906. So, in 1906, a lease was allowed on a land for 30 years at an annual rent. It states that the after the lease period, the lessee could keep using the land, pay rent annually, and even transfer rights to his heir. The dispute here is the lessor built a nearby industrial structure and the lessee claimed it was a permanent lease. Now, the court decided that the lease was for lessee's lifetime and not permanent or fully inheritable. Just because the lease allowed heirs to succeed does not automatically make it permanent. A court should examine the substance of the lease and its term to decide whether it is permanent, lifetime only, or it is limited. Accessions is considered part of lease during its term. If added unlawfully, it must be returned after the lease ends. So, how lease are made? Leases for year or more must be created through a registered instrument. If it is for short-term leases, it can be done orally with delivery of possession or by a registered lease. If a leasehold property is mortgaged as security for loan, the original lease agreement serve as a title document. Lease agreement must be stamped and registered. Unexpired lease period must cover the bank's repayment schedule, and sometimes a tripartite agreement is made between the banks. So, lessor and the lessee should be the part of that tripartite agreement. Lease deed should include a clause allowing the lessee to mortgage the property, or the lessor must give a no objection certificate authorizing for this mortgage. Right of appropriation. So, the right of appropriation comes in play when a debtor has multiple debts with a creditor, and it is about deciding which debt a payment made by a debtor will be applied to. In banks, this often happens when a customer has more than one loan account, and the rules are covered under section 59, 60 and 61 of the Indian Contract Act. Now, the key idea is that debtor can specify which debt a payment should go towards, but the creditor has the choice to accept or reject this request. You should not confuse appropriation with set off, because in a right of appropriation, payment is applied before the debt matures. For example, if a fixed deposit is used to pay a specific debt before its maturity, it's appropriation. But in right of set off, the payment is applied after the debt matures. For example, using the matured FD amount to clear a loan balance. So, the timing here matters. So, if it is before maturity, it is appropriation, and if it is after maturity, it is set off. Uh, Now, let's understand what a charge is. A charge is essentially a type of security a company creates to borrow money or secure a debt. When a company takes a loan or issue debentures, it often pledges some of its asset or rights as a security, and this pledge is called the charge. Under Section 77 of the Companies Act 2013, the word charge includes a wide variety of assets and situations such as charge on debentures, charge on unpaid capital, charge on immutable property, on book debt, immovable property, floating charge, charge on unpaid calls, charge on ships or shares in ships, or charge on intellectual property. So, intellectual property is goodwill, patent, license, trademark. Um, its simple terms, a charge is any asset or right of a company pledges to secure a loan or obligation. There is a duty to register a charge according to Section 77, subsection 1 of the Companies Act. Any company creating a charge on its property or asset, whether in India or abroad, tangible or intangible, fixed or floating, does not matter. They must register the charge with the Registrar of Companies, and the registration must include the details of the charge and the instrument creating it, which should be signed by both the company and the charge holder. This ensures that the charge becomes public knowledge. protecting the interest of all parties and avoiding disputes over who has the right over the asset. With respect to registration of immovable properties, the mortgage or lease deed must also be registered with under the Registration Act, except in case of equitable mortgage and registration under SARFAESI, under SARFAESI and SARFAESI. So, under Section 23 of the SARFAESI Act, banks and financial institutions can file details of charges with SARFAESI. Registration with SARFAESI is not legally mandatory, but banks usually require it. Once a security interest is filed with SARFAESI, it counts as a personal notice from the date of filing and it gets priority over any later security interest created to the same property. Types of securities interest commonly registered with SARFAESI includes mortgage by deposit of title deeds, mortgage of any other immovable property, hypothecation of machinery, stock, receivables or book debts, intangible assets like patent, copyright, trademark, know-how, licenses, franchisee right, and under construction property rights. So, under construction property rights are also secured by agreements other than mortgages. There are three charges which are does not require registration. They are guarantees, charges arising by operation of law, and hundi. Hundi is a traditional negotiable instrument used in India. Type of charges. So we can classify charges into two categories: fixed and floating. A fixed charge is a specific charge. It is attached to a specific property or asset of the company. So the bank or lender can sell that specific asset if the company defaults, and the charge is clearly defined on the asset. It gives the lender a strong right to recover the dues from that specific property. A floating charge, on the other hand, is journal and not attached to any other specific asset. It floats over the company's overall assets, and the company can deal with these assets in ordinary course of business until something triggers the charge. A floating charge uh, converts into a fixed charge if the company stops business or goes into liquidation or the creditor intervenes. Uh, for example, they appoint the receiver or any event mentioned in the charge deed, it occurs. And once crystallized, the charge becomes attached to the company's asset at that point and it has priority over unsecured creditors and some other claims in liquidation. It is treated like a fixed charge over the assets at that moment. For registration, the time limit is 30 days. The ROC can extend it by another 30 days, and in exceptional cases, the registration may still be allowed for further 60 days. So, procedures include using of certain forms like Form CHG1. It is for charges other than debentures. CHG9 is for debentures, and CHG5 is used to intimate certification of the charge, that is, when the loan is repaid. A copy of the charge documents must be filed with the ROC, verified and certified. Now let's talk about consequences of non-registration. So non-registration does not make the charge invalid itself. However, in case the company goes into liquidation, unregistered charges are not valid against liquidator or other creditors. Court have clarified that unregistered charges can still be enforced by the bank against the company as long as the company is operation and not in liquidation. Unit number 27, documentation. In this particular unit, we'll understand what is the need for documents, what are different types of documents, and what is the documentation procedure. We'll wind up this class by checking your progress and doing some practice questions. So, when banks give loans, they do not rely on trust alone. They rely on legally enforceable documents, and this documentation particularly is a core part of the credit management in banks. So these documents act as a proof that borrower has taken the loan, the borrower has agreed to pay the loan, and the bank has legal rights over the security. Bank has the right over the security which has been offered. And there are some key laws governing loan documentation in India. To name a few: Indian Contract Act, So Indian Contract Act provides the rules about valid contract, void contract, consent, minor contract. So contract with minor is void because minor is not competent to contract. And then we have other laws like Partnership Act, Companies Act, Indian Registration Act, Limitation Act, Indian Stamp Act, so on and so forth. So if the bank do not follow them, the document may be invalid in court, making the loan recovery difficult or sometimes impossible. So, for example, if a bank signs a loan agreement with a minor for buying a car, it is void ab initio, meaning to say void from the very beginning under the Indian Contract Act, unless it is for basic necessity. So, the bank will not be able to recover the loan given for purchasing a vehicle unless it is necessity, of course. So, what are the needs for loan document? Loan documents serve multiple functions. Number one, they identify the borrower. So, borrower identification. Now, when I say borrower identification, they ensure the person or entity taking the loan is clearly identified. The name, the address, ID proof, all these are taken. So, secondly, uh, we identify the security. Record details of the asset pledged as security. Example are the property details, gold description, FD number. Then a written record showing the bank gave money to the borrower. So this is a written evidence, written proof or evidence. The documents establish borrowers and guarantors legal duty to repay. So there is a repayment obligation. The ensure repayment obligation. Then they enables the bank to file a case and recover money in courts if the borrower defaults. So legal enforceability is there, and uh, the documents creates a charge on security. It gives the bank the legal right over the pledged or mortgage assets until the loan is repaid. Then we have different types of documents. In particularly, we'll understand about DPN, bill of exchange, agreement in forms. Uh, Demand promissory notes are meaning to say borrower promises in writing to repay the bank on demand with the agreed rate of interest. So they must satisfy Section 4 of the Negotiable Instrument Act. Section 4 particularly defines the promissory note. So they are used when no fixed repayment is mentioned. No fixed repayment is mentioned. So they are particularly used in this scenario. Uh, the stamp duty is fixed across India under the Indian Stamp Act, and they must be paid before signing. DPNs can vary for fixed or floating rates, single borrowers or joint borrowers, joint and several liability. So the customization is particularly available. With respect to execution, they must be fully filled in, stamped, and signed before being valid. Bill of exchange is a written order from the borrower to pay a fixed sum to the bank or its order. So this is an order to pay. Agreements, they are detailed contracts stating all the terms and conditions of the loan, and with loan reference. So Indian Contract Act is the reference law for agreements. It contains loan amount, interest rate, what will be the penal interest, margin percentage, repayment schedule, bank's right on default, detail of the securities, and the stamp duty varies from state to state. Stamp duty varies and in DPN, the stamp duty is fixed across India, but this is not the case with respect to the agreements. Then we have different types of agreements like pledge agreement, hypothecation agreement, term loan agreement, clean loan agreement, guarantee agreement, interest agreement, so on and so forth. Last but not the least, forms. So forms are supporting documents. They are not promises or contract, but they shows the intention, the borrower's intention. So this is the main purpose of uh, the forms to give instruction or authorization related to documents. They show borrower's intention. For example, authorization form, payment instruction form. So they particularly show borrower's intention, and the purpose is to give instruction or authorization related to the loans. Then we have documentation procedure. Documentation procedure includes all these steps: selecting of correct set of documents, stamping of documents, amount of stamp duty, filling, execution, legal procedure, keeping documents valid, safekeeping and preservation of documents. So let's understand each of them, starting with selection of correct set of documents. So it depends on the type of loan, whether it is a cash credit, term loan, um, or a overdraft. Again, then the type of security, whether it is pledge, hypothecation, mortgage, and who is the borrower. So is it individual or a partnership or a company? So it the selecting the correct form of set of documents actually depend on these three things. Now banks have pre-printed forms with built-in options for various cases, and staff must ensure correct clauses are selected in order to avoid the legal issues. Number two is stamping of documents. So the purpose is the proof of paying stamp duty, which is a government tax. Indian Stamp Act of 1899 requires uh, that the documents should be stamped. The key sections involve section 17, 18, 19, 35. So section 17 states that document in India must be stamped before or at signing. So they must be stamped before or at signing. Section 18 states that document made abroad must be stamped within 3 months of arriving in India. Section 19 states that foreign bills or promissory notes must be stamped before acceptance or payment, and section 35 states that unstamped documents are invalid in court unless the duty is paid and the penalty is paid. So unstamped documents are invalid unless duty and penalty, which can be up to 10x, is paid. Then we have types of different types of stamp, like stamp paper, government printed papers of specific value, adhesive papers. They are stuck on pre-printed forms and they must be cancelled, so they cannot be reused. So there is a cancellation rule, section 12. Section 12 says that if they're not cancelled, the stamp is treated as unused. So if not cancelled, stamp is treated as unused. Then we have stamp duty. Stamp duty is like a tax paid to the government on certain types of document to make them legally valid. Some documents have the same stamp duty all over India because they are covered by central laws. So the stamp duty is uniform across India. So the promissory note, bill of exchange, share transfer, deeds, receipts, letter of credit, insurance policies have uniform stamp duty across India, and then there are other documents which have different stamp duties in different states because state have their own laws for them. Example, hypothecation, pledge agreements, power of attorney, lease agreements, mortgage deeds. Uh, so particularly which state stamp duty applies. So the state where the document is first signed or the transaction is completed, uh, their stamp duty applies. And if the document is unstamped, you can still use it as evidence in court after paying the extra stamp duty plus a penalty. All right. Why it matters? So if the stamp duty is not properly paid, the document might be rejected as evidence. And since the stamp duty law change, bank must keep themselves updated. Filing. So filling. So banks use printed forms using with blank spaces. These need to be filled in before the borrower signs them. The key points with respect to filling involves you have to fill every blank space exactly as per the loan sanction terms. You never leave blank or blanks or leave multiple options without cutting out the ones which are not applicable. Once the borrower signs, the document is final, so no changes can be made without their written consent. You should avoid overwriting if you make a mistake. Don't overwrite. Draw a line through the wrong part and write the correct part neatly. And you have the borrower sign next to the correction. Uh, you have to fill the whole document in one sitting and with the same ink, same handwriting. Otherwise, it might look suspicious, like the bank have added things later. So filling is done. Then you have the execution of documents. Execution means signing the documents to make them legally binding. The signature must match the loan application and the specific signature which is already present with the bank. They must match. If signing is on behalf of someone else, you have to mention their capacity clearly, whether they are partner, trustee, director, guardian of the minor, what is their capacity, you have to clearly mention. And if the borrower is a minor, only guardian can sign for them, both as themselves and on behalf of the minor. Normally, bank makes the borrower sign every page. So every page has to be signed, right? Reason being, the borrower cannot later say that they didn't know what was on a certain page. That's why bank made them sign every page. If there are corrections in the document, they must be signed fully by the borrowers, and execution must happen in presence of bank official. The bank keeps a record in a register with date and time of signing, details of the document signed, and confirmation that contents were explained in a language which is understood by the borrower. And again, signature of two bank officials are there. Legal procedure after execution. So this is basically signing. So what is the legal procedure after signing? So some documents need extra legal steps after they are signed. Otherwise, the bank may lose its right over the security. So for loans to limited companies, certain forms must be submitted to ROC when it is with respect to company. The forms must be submitted to registrar of companies after taking charge over the company's assets. So this ensures that the bank's claim is officially recorded. For registered mortgages, the mortgage deeds must be registered with the registrar of assurances within 4 months of signing. If not registered, the bank may lose priority rights to recover its dues if other creditors comes in. So, if these legal steps are missed, the bank's claim might be treated as unsecured, and the documents might not even be allowed as evidence in the court. Keeping documents valid. So, loan documents have an expiry date for taking legal action, and this is known as limitation period. Now, this limitation period is governed by Limitation Act of 1963. The limitation period expires. The bank cannot take legal action to recover the dues unless fresh documents are signed. Limitation period varies on the document. For DPN, it is 3 years, and for mortgage, it is 12 years. Um, if you want to extend the limitation period, then there must be an acknowledgement of debt before expiry. So, get the borrower's written acknowledgement before expiry of the period. And if the borrower pays a part of the loan before the expiry, it extends the period. So, the part payment proofs must be signed by the borrower or the agent. The limitation period has already expired. So, fresh documents must be signed, or section 25(3) can be used of the contract act. So, the borrower can make a new agreement, new written and signed promise to pay a time bar debt. So, this creates a fresh cause of action, right? And mere acknowledgement of debt is not enough. So, a mere acknowledgement, this is not enough. And mortgaging property in exchange for a time bar debt is valid because it's like paying through the property value. Safekeeping and preservation of documents. So, loan documents are valuable proofs of the bank's right, and they must be stored safely for many years. Why is it important? Because if the borrower defaults, the bank needs these documents to recover the dues. So we have a strong storage requirements with that the documents should be kept in a fireproof and theft-proof cabinet, and they must be keep under personal custody of an authorized official. No unauthorization is allowed. So the custody should be with authorized official. If the person in charge changes, there should be a formal handover process. Now, for how long they should be kept? What should be the duration? So, until all dues are fully recovered, and even after recovery, you should keep them for a legally required period. So, as a modern practice, instead of keeping documents at each branch, banks now store them at central hubs or nodal points for a region or a zone. Now let's check your progress. As per the Stamp Act, the document executed in India, they must be stamped before or at the time of execution. So D is the correct answer. Which one of the following statements is not true? The court can condone delay in filing suit as per Section 5 of the Limitation Act. An agreement is not stamped before or at the time of execution in India. The defect can be cured by paying penalty when the borrower acknowledges the debt before expiry of limitation period. The period of limitation is extended by one more period. If the borrower makes part payment into the loan account before the expiry of limitation period, the period of limitation extended by one more period. So these three are correct. B is correct, C is correct, and D is correct. So these are true. Uh, Leaving us statement A. So even if we don't know what is the correct answer, we can eliminate it. So A is the correct answer for this question. Non-performing assets or stressed assets. So we'll cover unit number 28. In this particular unit, we'll understand what is a non-performing asset. We'll understand about income recognition policy. How do we compute gross advances, non-performing assets? What is an asset classification? So we classify assets into substandard assets, doubtful assets, loss assets. We'll learn about provisioning norms, how to write off loans, what are the prudential norms applicable to restructuring. So we'll understand about some other aspects. We'll wind up this class by doing our practice questions. So let's begin. Lending is the main business of banks, but it comes with a big challenge. Not all loans are repaid on time. And to make sure banks present their account fairly and maintain financial discipline, Reserve Bank of India introduced prudential norms for income recognition and asset classification. Now, these norms are in line with global practices and were recommended by Narsimham Committee. They deal with three aspects. Number one, income recognition, how banks should record income from loan. Number two is asset classification, how loans should be categorized depending on whether borrowers are paying on time. Number third is provisioning. How much money banks should set aside to cover possible losses from bad loans. Now let's understand what is a non-performing asset. So simply stating, an asset becomes non-performing asset when it stops generating income for the bank. Now what is an asset? Asset in banking context means loan, advances, and a leased asset. So for bank, when bank lend to someone, bank earn interest. So a loan is an asset for bank. And when it stops generating income for the bank, this means that the borrower has not paid interest or principal for a specified period. And a loan is treated as a non-performing asset if it is a term loan and overdue is for 90 days or more. If it is a cash credit or overdraft, if the account is treated as out of order, if it's a bill purchased or discounted, uh, and the bill remains unpaid for more than 90 days, if it's a crop loan, if it is a short crop loan, so if dues remain unpaid for two crop seasons, and if it is a long duration crop, if dues remain unpaid for one crop season, and if it is a securitization transaction, if the liquidity facility remains unpaid for more than 90 days, and in derivative transaction also, if receivables remain unpaid for more than 90 days after the due date. So simply stating, a loan does not bring income to the bank for 90 days or more, it becomes non-performing assets. So this is the criteria for classifying whether an asset has become a non-performing asset or not. So when we say overdue, overdue means any payment due to the bank that is not paid on scheduled date. For example, the bank is expecting the payment on 10th of August, but the payment was not made on that date. The date was the scheduled date. On scheduled date, the loan becomes overdue and it is not paid on that time. So it becomes overdue. So the payment has to be made on the scheduled date. It does not happen on that date. So simply stating, it becomes overdue. And what is an out of order? So an overdraft or cash credit account is considered out of order when the outstanding balance is above the sanction limit or drawing power for 90 days continuously. And the balance is, if the balance is within the limits, but there are no deposit or credits made for 90 days, and if the balance is within the limit, but the deposits made are not enough to cover interest charge for 90 days. So the status becomes out of order. This means that even if the account is not overdrawn, if the customer is not actively maintaining it or paying interest, the account is still treated as a non-performing asset. So I hope it is clear what is a non-performing asset, what is out of order, and what is overdue. Now let's understand about income recognition. So banks must follow objective rules for recognizing income and they cannot rely on subjective judgments. The key principle is no income from NPA. No income from NPA. Meaning to say, bank must not record interest from NPAs unless actually it is received in cash. Even if government guarantees the loan, interest cannot be booked unless it is realized. So income to be recognized only on actual receipts from NPA. If income is from secured advances for loans backed by deposits, insurance policies, etc. So interest may be booked on the due date provided the margin is sufficient. For fees and commission, if a loan is rescheduled or renegotiated, fees earned must be recognized gradually over the extended period of time. For reversal of income, so when a performing loan turns into an NPA, the bank must reverse income already recorded but not actually received. This ensures that the bank's profits are not inflated, and this applies to interest on loans, fees and commissions accrued, and financial charges on the leased assets. Recovery appropriation. So when a borrower makes a payment towards a non-performing asset, bank must decide whether to adjust it against interest due or principal due. If there is no clear agreement with the borrower, bank must follow uniform policy across all accounts. Importantly, bank cannot show interest as income if it is repaid using fresh loan from the bank itself. Interest application. So once an account becomes a non-performing asset, the bank must reverse unpaid interest already charged to the borrower. No fresh interest should be applied. However, banks can keep track of such interest in memorandum account just for record keeping and not for profit calculation. For calculating total advances, such interest is not included. And reporting, so every year bank must report their NPAs on 31st March after audit, and this includes both domestic and foreign NPAs. So foreign NPAs is loans at overseas branches, and they must report figures like gross advances, gross NPAs, net NPAs, and this comes to the question how they are computed. So now let's understand how they are computed. So what is a gross advance? Gross advance means total loan given by bank. So this is total loan given by bank. Hence, it includes both standard assets, loans which are being repaid properly, and gross NPAs loan where repayment has stopped or is overdue. So, gross advances includes standard assets plus gross NPAs. Now, gross NPAs, so these are the loans where the borrower has stopped repaying for 90 days or more, and it includes principal amount due and interest amount also. Gross NPA percentage is calculated by dividing gross NPA by gross advances and multiplying it by 100. Net advances are calculated by taking gross advances and then subtracting all the deductions. So deductions include the provisions, um, guarantee, which insurance covers on deposits, part payment received but which is kept in suspense account, sundry account deposits, floating provisions. So these all are included under deductions. So net advances are calculated by taking gross advances and then subtracting certain deductions. Net non-performing assets. So gross non-performing assets minus deduction equals to net non-performing assets. And as percentage, it is net NPA divided by net advances into 100. Now, there are certain clarifications that gross figures shows the overall loan book. Net figures show the real risk after provisions, and regulators, auditors, and investors use this number to judge how healthy a bank is. Just a moment. Okay. Asset classification. So there are three categories in which NPAs are classified. So not all NPAs are the same. Bank divides them into three categories. Number first is substandard assets. These are loans that have been NPAs for up to 12 months. Now they have weakness and there is a chance that the bank may suffer loss if issues are not fixed. Then there are doubtful assets. See, these are the loans which remain substandard for more than 12 months. So it becomes doubtful. These loans have all the weaknesses of substandard assets, but with a much higher risk. Recovery of full amount is highly doubtful. And then there are loss assets. These are loans identified by the bank, auditor, or RBI as irrecoverable. Even though small recovery may be possible, they are essentially worthless as assets. So ideally, they should be written off. Loss assets are written off. Guidelines for classification of assets. So bank need to classify assets correctly and consistently. Some of the important rules are number one, temporary issues, accounts with temporary issues. So a loan should not be called NPA just because of small short-term issues such as late submission of stock statement, temporary excess drawing above limit, if there is any delay in renewing loan limits. So in these cases, a loan should not be called as non-performing assets. However, if stock statement remains older than 3 months, it becomes irregular account. And if irregular drawings continue for 90 days, the account becomes non-performing asset. If loan limits are not renewed within 180 days, it also becomes non-performing asset. And the borrower pays back overdue principal and interest, the account can be upgraded back to standard. So the NPA can be upgraded to standard if areas are cleared. Number two, account regularized near balance sheet date. So if a borrower deposit money just before March 31st to make the account look good, bank must be careful. If the account still shows weakness, it should remain non-performing asset. The facility, the classification should be borrower wise and not facility wise. So if one loan of the borrower becomes non-performing asset, all loans given to that borrower must be treated as a non-performing asset. For example, if a borrower has a home loan and a business loan, and one of the loan become non-performing asset, then the other must also be classified as non-performing asset, and it should not be facility based. We should not see it uh, from one loan. We should see the overall loans. And derivatives contract also, if the overdue receivables from derivatives, so the positive M2M value is not paid for 90 days, then also it becomes a non-performing asset. Consortium advances, so sometimes a borrower takes big loans uh, that is too large for one bank to handle. In such cases, several banks come together and give the loan jointly, and this is called consortium loan. Each bank has its share in the loan and in the recovery. For asset classification, every bank will look at the repayment received for its own share. And to avoid confusion, the participating banks must get their share of recovery transferred from the lead bank. Now, what is a lead bank? The main bank managing the consortium. Lead bank, the bank managing the consortium, or get written consent for such transfer. This ensures each bank record the account correctly in their own books. Accounts where security values erode due to fraud. So sometimes the borrower commits fraud or the value of security collapses so much that the recovery becomes doubtful. In such a cases, banks should not wait for the loan to pass through the usual stage, which is substandard. What is the usual stage? Substandard, doubtful, and loss. So this is the usual stage. The bank should not actually wait for these stages. Instead, the account should be straight away classified as doubtful or loss asset. Advance to PACS or FSS under on lending system. So what is PACS? It is primary agriculture credit societies, and FSS is farmer service societies. So PACS and FSS borrows from commercial banks and further on lend to farmers. Now, if PACS default in one crop season or two crop seasons, well, one crop season with respect to long-term loan and two crop season with respect to short-term loan, only that specific facility becomes non-performing asset. Other loans given to primary agriculture credit societies or farmer service societies, they remain unaffected. However, if the bank directly gives a loan to an individual farmer who is also a member of PACS and one of his loans become NPA, then all his direct loans are treated as NPA. Why? Because we are classifying the loans borrower wise and not facility wise. Advances against fully secured assets like term deposits, NSCs. So if a loan is given against safe securities like term deposit, national savings certificate, Kisan Vikas Patrika, Indra Vikas Patra. So these loans are not treated as non-performing assets because the bank already holds fully secure assets. But this rule does not apply to loans against gold, government securities, or other marketable securities. Keep that in mind. Loans with moratorium. So, industrial and agriculture project loans often have a moratorium period. What is a moratorium period? It is time during which repayment is not expected. So, interest becomes due only after the moratorium ends, and only if interest is unpaid after the due date, NPA classification starts. And for staff housing loans, where interest is payable after principal repayment, where interest is not overdue from the first quarter, they becomes NPA only when there is a default in paying principal installments or interest after it becomes due. Agriculture advances. So for short duration crops, loan become NPA if it is overdue for 2 crop season, for long duration for 1 crop season. Now, who decides crop duration? It is decided by state level bankers committee. So state level bankers committee decided the crop duration, and if there is a natural calamity, if flood, drought, or other calamities affect repayment, banks may convert short term loans into term loans. They can reschedule repayment or give fresh short term loans. Now these restructured loans are treated as current dues and not NPAs. Similarly, rural housing loans under government schemes, so like Indra Awas Yojana, Golden Jubilee scheme. So repayment schedule must match the crop cycle of the farmer. Government guaranteed advances. So there are central government guarantees and state government guarantees. In central government guarantees, even if overdue, these are not classified as NP unless the government refuses to honor the guarantee when invoked. But banks cannot recognize income unless interest is actually received. And for state government guarantees, if overdue for more than 90 days, they must be treated as non-performing assets. Projects under implementation. So when banks finance large projects, repayment depends on the date of commencement of commercial operations. And RBI has laid down detailed norms for handling delays and changes. So if there's a deferment of date of commencement of commercial organization, then the banks can allow extra time without downgrading the loan within the limits. If there is a change in ownership, if the project changes hands within allowed timelines, bank can still treat it as standard. If it is deemed DCCO, if a project has multiple units and some starts working, those can be treated as operational for classification. For cost overrun, extra loans for cost overruns follow specific asset classification norms. Um, Income recognition. So the project loan is standard. Bank can recognize income on accrual basis. And if it is substandard, income is recognized only on actual receipts, meaning to say cash basis only. If debt interest is converted into instruments like bonds, equity, then those follow restructuring norms. Post shipment supply credit. So this refers to credit given to exporters after they ship goods abroad. For countries where ECGC cover is available, ECGC is Export Credit Guarantee Corporation. So if ECGC cover is available, Exim Bank provides a guarantee come refinance scheme. If the exporter defaults, Exim Bank pays the bank within 30 days of invoking the guarantee. To the extent Exim Bank pays, that part of loan is not treated as non-performing asset. Export project finance. So sometimes bank finance large export projects where an Indian company export goods or services to another country. Now, the importer may pay the full dues to the bank in their own country, but due to political reasons, the money cannot be remitted to India. In such cases, the lending bank is not at fault and neither is the importer. If the bank can show documents providing that the importer paid on time, then the loan will not immediately be classified as a non performing asset. Instead, the bank is allowed to wait 1 year from the date of deposit. Transfer of loan exposure. So sometimes one bank transfers its loan exposure to another bank or financial institution. And for such transfers, the rules of asset classification and provisioning are as per RBI Transfer of Loan Exposure Directions 2021. This means that whichever bank currently holds the loan must follow the RBI guidelines for recognizing NPAs and setting aside the provisions. Credit card accounts. So, a credit card account become NPA if the minimum amount due is not paid fully within 90 days from the payment due date. If payment is missed, the account is reported as past due to Credit Information Company (CICs). However, banks can charge late payment fees or report the account as past due only if it remains unpaid for more than 3 days after the due date. Upgradation of restructure accounts. So sometimes when borrowers faces difficulty in repayment, bank restructures the loan, changes repayment term like extend, tenure, reduce installment, etc. And a restructure account is considered substandard initially. It can be upgraded to standard only after 1 year from the date uh, when the first payment becomes due under the new schedule, provided the borrower makes timely payment during the year. If performance is not satisfactory, then the account classification is done as per earlier norms, and provisions made earlier can be reversed if repayment is satisfactory after 1 year. Takeout finance. Takeout finance is mainly used in long-term infrastructure projects. Here, one bank finances the project initially but later transfers the loan to another bank or financial institution. That institution is known as takeover institution as per the agreement. Between financing and takeover, there may be delays and defaults by the borrower is possible. So, the bank which currently has the loan in its book must classify it based on the repayment record, and if the borrower defaults before takeover, the loan must be marked as NPA by the lending bank. The takeover bank, once it acquires the loan, must also treat it as NPA from the actual date of default, even if the loan was not yet in the books. General norms for provisioning. So, now let's understand the provisioning norms. So, basically, there's a risk that the borrower will not repay, and if repayment not happens, the asset becomes non-performing assets. To deal with such situation, RBI has laid down provisioning norms. These are the rules for banks to set aside a certain percentage of money against different categories of assets. If it is a loss asset, then a loss asset is one where recovery is considered impossible. So banks are required to write off such assets, and if they are retained in their books for any reason, they must give 100% provision. Doubtful assets alone become doubtful if it remains in the substandard category for 12 months, right? The provisioning depends on whether there is a secured portion or not. If it is unsecured, so for unsecured provision portion, 100% provision must be made, meaning to say there is no realizable security. And if there is a secured portion, provisions vary depending on how the assets had remained doubtful. For up to 1 year, 25% of provision is required. For 1 to 3 years, 40% of provision is required. And for more than 3 years, 100% of provision is required. For large non-performing assets, bank must conduct annual stock audits by an external agency to verify the security value, or get immovable properties revalued once in 3 years. Substandard assets. So there's a general provision of 15% of the outstanding amount. Unsecured substandard assets. For unsecured substandard assets, there's addition of 10% provision. So you make extra 10% provision, making it 25%. For infrastructure project loans with escrow arrangements, are to be made at 20% instead of 25%. Now, let's understand unsecured exposure. So, these are the cases where the bank has little or no tangible security to fall back upon. For unsecured doubtful assets, you make 100% provision. An exposure is treated as unsecured if the realizable value of security is less than 10% of the outstanding amount. Now, licenses, rights, or permissions, they cannot be treated as tangible security. So, loans covered only by such rights, they will be considered unsecured. In infrastructure projects like road projects, where there are annuity receivables or toll rights, they may be treated as tangible asset if they are legally enforceable, and bank must disclose separately the amount of loan which are backed by intangible assets. Standard assets. So standard asset is a performing asset where there are no defaults. Even though these loans are safe, RBI requires bank to make a general provision as a precaution. Now the rate depends on the type of loan. If it is a farm credit, housing loan, loan to small and medium enterprises, then a provision of 0.25% is required to be made. If loans are provided to commercial real estate, then 1%. For commercial real estate, residential housing, it is 0.75%. For housing loans at teaser rates are low initial rates which becomes higher at the later duration of time. Then 2% is required, and this reduces 0.4% 1 year after reset if the account remains standard. For restructured loans under natural calamity reliefs, the provision required is 5%, and for all other standard loans including medium enterprises, it is 0.4%. Now these provisions on standard assets are not deducted from gross advances while calculating NPAs. They are only shown separately as a safety buffer. Unhedged foreign currency exposure. So sometimes borrower have loans or commitments in foreign currency without proper hedging. If the currency fluctuates sharply, repayment capacity may be badly affected. To cover this risk, banks must make extra provisions depending on the borrower's riskiness. So the likely loss is up to 15%. There is no extra provision required. If it is 15 to 30%, then 0.2% of the exposure is required, or 20 basis point. For 30 to 50, 40 basis point or 0.4, 50 to 75, 60 basis point or 0.6, and 75% basis point 0.8% of the exposure is extra required as provision. Here EBID is equals to a profit after tax plus depreciation plus interest plus lease rentals. So it shows borrower's ability to service debt. Creation and utilization of floating provisions. So every bank must have a board approved policy for creating floating provisions. These floating provisions are created separately for advances, loans given to customers, and investments. So investments are money invested in securities or bonds. Unutilized floating provisions. So these are the floating provisions as special reserves. They cannot be used freely. Their usage is controlled by RBI and the bank's board. So there are certain cases where it is allowed to use these floating provisions. So when you are getting approval from bank board, they are allowed only under extraordinary circumstances first, and only after getting approval from the bank's board and taking prior permission from RBI. So extraordinary circumstances means situations that are unexpected, exceptional, and not recurring in the normal course of business. These fall into three categories: general events like civil unrest, collapse of country's currency; market events such as complete financial market meltdown that affects all banks; or credit events only for very unusual and several credit loss. The floating provisions cannot be reversed to P&L account. They can only be used for making specific provisions in extraordinary situations. For reporting, they can either be netted off against gross NPS or be counted as part of Tier 2 capital, but limit of 1.25% of risk weighted assets is maintained. And banks must also provide full disclosure about floating provisions in notes on account or notes to accounts um of their balance sheet. Additional provisions. So apart from regulatory minimum provisions, bank may voluntarily make extra provisions at higher rates. Now these are different from floating provisions. For NPAs, bank may set aside more than minimum required provision if they do it consistently year after year. For standard assets, bank can also create higher provisions for stressed sectors like real estate sector, power sector, even if those loans are still standard. Provision on leased assets. So when banks give out loan through leasing arrangement, they must also make specific provisions depending on the quality of those assets. Now, if there are substandard assets, so these are lease assets that have just turned problematic, but not yet doubtful or loss asset. Now, for provision, 15% for secured and for unsecured, 25% extra 10% is required. It is same as before. And for doubtful assets also, it is same what we have discussed earlier, 100% for unsecured. For secured, it is classified into three categories: up to 1 year, 25%, 1 to 3 year, 40%, and for 3 years, it is 100%. For loss assets, 100% of the provision is required. Provisions under special circumstances, advance against deposits or instrument. So if a borrower takes a loan against their own deposits, like a fixed deposit, uh, KVPs, NSCs, the bank still may needs to make provisions. The provision depend on how the loan is classified, whether it is standard, substandard, doubtful, or loss. Interest suspense account. So when interest is overdue, instead of adding it to income, banks put it in an interest suspense account. This account cannot be treated as part of provision, and first it should be deducted from the outstanding loan balance. After that, the banks make provision on the reduced balances. Advance covered by ECGC guarantee, Export Credit Guarantee Corporation. So ECGC provides insurance cover to banks on export loans. If such a loan become doubtful, the bank make provision only on the amount not guaranteed by ECGC. Before provisioning, the bank should deduct the realizable value of securities. Advances covered under CGT MSC or CRG FTLIH guarantees. So these are schemes for micro and small enterprises and low income housing. If such loans become NPA, banks do not make provision on the guaranteed portion. Provisions are required only on the amount which is beyond the guaranteed portion. Reserve for exchange rate fluctuation account RERFA. When loans are given in foreign currency or linked to foreign exchange currency, depreciation can increase the loan outstanding. So banks should not normally revalue such loans. If revaluation is required, any loss must be charged to P&L account. And if there is a gain due to revaluation, it must be fully transferred to provision for that asset. Country risk provisions. So if bank lend money abroad, they face country risk of default due to political or economic condition in that country, and the provisioning depends on ECGC risk rating of that company. So if the risk is insignificant, then the provision requires 0.5. Again, low is 0.5. For moderate, it is 5%. If it is high, 20, very high, 25, restricted or off credit to 100%. So it ranges from 0.25% to 100%, and it depends on the risk category, risk rating, which is done by ECGC. This is in addition to the provision based on asset classification. Foreign branches of Indian banks must include their host country's exposure, and lower provisions may be used for short term exposure where the exposure is less than 180 days. Liquidity facility for securitization transaction. If a bank provides liquidity support for securitization deals and the amount is outstanding for more than 90 days, then it should be fully provided for. Derivative exposure. Credit exposure from derivative transactions like interest rate swap, credit default swaps, gold contracts, they also attract provisions. And the provision should be same as for the standard asset of the counterparty. Housing loan at teaser rate. So some bank gives housing loan at teaser rate, meaning to say they charge very low rate of interest initially, but with time the interest rate increases. So the risk is the borrower may struggle to pay once the higher rates kick in, and to cover this risk provisioning on standard assets under such loan is 2% initially. After 1 year of reset, if the loan amount remains standard, provisioning reduces to 0.4%. Large borrowers. So, as per RBI guideline, for very large borrowers, if the banking system's total exposure to the borrower exceed the normally permitted lending limit, banks must make additional provision of 3% on incremental exposure. Provisioning coverage ratio. So, provisioning coverage ratio is the ratio of provisions made by the bank to gross NPAs. In simple words, it shows how much of the bad loans are covered by the bank's provision. But there are certain guidelines for the banks. Like banks were told to maintain a PCR of at least 70%. If provisions are more than required, the extra amount should be kept in a special account called counter-cyclic provisioning buffer. This buffer can be used during an economic-wide downturn, but only with RBI's prior approval. If bank must disclose its PCR in the notes to account of the balance sheet so that stakeholders know how safe the bank is against the loan losses. Writing of NPAs. So according to Income Tax Act 1961, interest income from NPA it is taxable, but it is taxable only when it is actually received or credited to the P&L, whichever is earlier. The provisions made by non-performing assets, they are not tax deductible. This means bank cannot reduce their taxable income just because they made provisions. However, if banks write off the loans, they can claim tax benefits as per the rules, and recoveries made later from written off accounts must be shown as income and taxed accordingly. So banks can decide to write off loans centrally at the head office even if those loans still appear in the branch book. And before doing so, bank must ensure that the provisions are made as per RBI's assets classification rules. Banks must try all possible recovery methods before fully or partially writing to of an account, and full details of all write-offs, including technical write-off, uh, must be disclosed in the annual financial statement. Non-performing asset management, effective mechanism, and granular data. Now let's understand why NPA management is important. The quality of a bank's loan reflects its financial strength and health. Now, high NPA means weak financial health. So, effective management it is very critical. Uh, what banks must do is that they should put in place a strong MIS system. Uh, to detect early warning signals of financial stress at individual level or at segment level, they should be able to detect early warning signals. So at individual level, for example, one borrower is showing repayment issues, or at segment level there is a problem in an industry or geographic region, to use these warning signals to create a preventive asset quality management system. This includes transparent restructuring, and the aim is to preserve the economic value of the borrower and the business. We should also ensure reporting consistency. So reporting consistency should be maintained. Information submitted to the regulatory or statutory authorities they should match with the bank's internal MIS report. There should be no inconsistency between these two. And banks must maintain a detailed system generated data on NPAs and restructured assets, including opening balances, if there is any new addition in the NPA, if there is a reductions, closing balances, provisions, and technical write-off. Framework for resolution of stressed asset. So there should be an early identification and reporting of stress. So bank must identify signs of trouble in a loan account as early as possible. For this purpose, RBI has introduced special mention accounts, SMAs. So if a borrower misses repayment of principal, interest, or any other due, the account is classified into one of these: SMA 0, SMA 1, or SMA 2. If the payment overdue is 1 to 30 days, 31 to 60 days, and 61 to 90 days, and accordingly, special mention accounts are provided. For revolving credit facilities, there is no SMA 0. So there is SMA 1 if the outstanding continuously exceeds the limit or drawing power for 31 to 60 days, or if the excess balance, if this continues for 61 to 90 days, then it is classified as special mention account 2. Account that crosses 90 days, if they cross 90 days, they becomes non-performing assets. With respect to reporting, so the bank must report all such SMA accounts to CRILC, mean to say Central Repository of Information on Large Credit. Now, this reporting is mandatory if the borrower has an exposure of 5 CR or more. And these reports must be sent monthly, and a weekly report must be sent for fresh defaults. Implementation of resolution plans. So once stress is identified, bank need to act quickly. The rules apply to scheduled commercial banks except RRBs. All India term lending institutions like NABARD, National Housing Bank, Exim, SEDB, Small Finance Bank, and large NBFCs. Steps involved is that you generally review, and review period is of 30 days. So once a default occurs, lender have 30 days to review the borrower's situation, and during this time they decide whether to restructure, regularize, sell the loan, change ownership, or start insolvency proceedings. Then there is a intercreditor agreement. Intercreditor agreement. So if restructuring is chosen, all lenders of that borrower, they must sign an intercreditor agreement, and any decision approved by 75% of lender by value or 60% by number will be binding on all the members, all the lenders. Timeline of resolution. So once the review period ends, bank must implement uh, the resolution plan within 180 days. The review period starts either from the default date or the RBI specific reference rate. So reference date for exposure greater than 2000 crore is June 7, 2019. For 1500 to 2000 crore, it is January 1st, 2020. And for exposures which are less than 1500, the dates are yet to be notified. There are some types of resolution plans like regularization, sale of loan to another investor, change in ownership, or restructuring of loan terms. There are certain implementation conditions. So if the exposure is 100 CR or above, any restructuring or ownership change needs an independent credit evaluation by authorized credit rating agency. All conditions prescribed by RBI, they must be met. If restructuring, the restructured terms or conditions are complied with, or if recovery or there is sale, then the bank's exposure is fully extinguished. Delayed implementation. So if banks fail to implement a viable resolution plan within timelines, they must make additional provisions. If it is not implemented within 180 days, then there is an additional provision of 20%, and after 365 days there is an additional provision of 15%, meaning to say total 35%. This ensures bank don't delay actions and take the problem seriously. Now let's understand some other aspects with respect to this framework. So prudential norms are there. So RBI's norm on restructuring or ownership change must be followed, whether done under IBC or outside it. If banks try to hide bad loans or keep evergreen stressed loans, then the RBI will take strict action. Bank must disclose details of resolution plans in their financial statements, and there are certain exemptions. So these rules do not apply to MSME covered by separate guidelines for revival and rehabilitation, and borrowers where RBI has already directed banks to start insolvency under IBC. Prudential norms applicable to restructuring. So first of all, we need to understand what is restructuring. So restructuring is a process in which a bank or lender gives a special concession to a borrower who is in financial difficulty. The main purpose is to help the borrower survive financially and at the same time ensure that the bank has a chance to recover money. Now, this may involve you change the repayment term, you roll over existing credit facilities, so giving the borrower more time to use the current loan accounts, or provide additional funds, or you settle with extended time. So you agree to accept a lower amount or a structured payment where the payment period is more than 3 months. Now, banks must have a clear board approved policy for this on when and how restructuring can be done. This policy should define the warning signals of financial difficulty. Both qualitative and quantitative parameters are to be considered. Now, what are the signs of financial difficulty? What are the indicators of financial difficulty? So, if there's a default in repayment, there's a likely default in future, uh, delisting of securities happens. So, if the borrower's listed shares are being delisted due to financial weakness or regulatory non-compliance, so we call it that the securities are delisted. If there's a weak cash flow, the actual or projected earnings are insufficient to service the current loans. If the account is already in NP or if there's a poor credit rating. So these are some of the indicators of financial difficulty. Asset classification. So RBI has actually set specific rules to ensure restructuring is not misused. Number one is asset classification. When a loan is restructured, it is normally downgraded as an NPA substandard, even if it was standard before restructuring. Its classification will continue as per aging norms, how long it has remained overdue. There are certain conditions for upgrade. So special rules exist for upgrading restructured accounts back to standard. If it is MSME borrowers with a total exposure of 25 CR, they have separate slightly relaxed norms. And for other borrowers, the rules depend on loan size, asset classification at the time of restructuring. Provisioning norms. So, when a loan is restructured, the bank may set aside money to cover potential losses. If a restructuring plan is submitted under IBC, then the provisions already made are frozen for 6 months from submission of the RP or up to 90 days after the adjudicating authority approves the plan, whichever comes earlier. If provisions are less than required, then the bank must increase them. If the adjudicating authority rejects the plan, the freezing benefits and ends immediately and non-provision norms apply. MSME restructuring has separate guidelines from the RBI. Additional finance, so sometimes bank provide additional finance during restructuring. So this additional finance is treated as a standard asset during the monitoring period as long as the borrower performs well. If the borrower again defaults, the additional finance will also be downgraded to the same category as a restructured debt. Similarly, interim finance under IBC is treated as a standard asset during the insolvency resolution process. Income recognition norms. So, when a borrower account has been restructured, the way banks record interest income depends on whether the account is standard or an NPA. If the account is standard, interest can be recorded on an accrual basis. So, even if it has not been actually received, it can be recorded. Now, if it is NPA, then it is recognized only when the bank actually receives it. For additional finance given to the borrower whose original loans were already NPAs, so interest is recognized only on the cash basis unless ownership of the borrower company changes. Conversion of principal of interest. So during restructuring, part of the loan or unpaid interest may be converted into debt instruments, equity, or funded interest term loans, a loan created out of unpaid interest. These new instruments will be placed in the same asset category as the original loan. Change in ownership. So if the ownership of a borrowing company changes, the company's loan can be treated as standard, but only if conditions prescribed by the RBI if they are followed. So if the account fails during this period, it goes into a fresh review process, and bank can reverse provision only after the monitoring period ends and performance is satisfactory. Sale and leaseback transactions. So if a borrower sells an asset to another party and then leases it back, this will be treated as restructuring if certain conditions are met, like the original borrower is in financial difficulty, more than 50% of the buyer's revenue from that asset depend on the payment from the seller. And thirdly, at least 25% of the buyer's loan for purchasing that assets come from the lender who already had exposure to the seller. Refinancing norms. So if borrower takes a new loan to repay or refinance an old loan, it will be treated as restructuring if the borrower is in financial difficulty. This applies when the refinance loan is taken from lender in the Indian banking system or with the support of Indian bank like guarantee, letter of credit, comfort letter, etc. Takeout finance means again long-term project loans initially funded by one bank but later transferred to other bank as per the prior agreement. These transactions are governed separately under RBI's detailed guidelines on income recognition, asset classification, provisioning, and capital adequacy ratio. Regulatory assumptions. So, when debt is converted into non SLR, uh, the usual restriction on banks' exposure to such securities it does not apply. When the debt is converted into the equity shares, during restructuring, it is exempt from regulatory limits on capital market exposure, para-banking investments, or interest group exposures. If we are restructuring fraud or willful defaults, let's understand SEBI regulations as well first. So, under certain condition, exemption from SEBI's ICDR, issue of capital and disclosure requirement, they are allowed. And for issuing equity during restructuring the price of shares, it will be determined as per a specified formula or methodology rather than the usual pricing rules. Now, let's move forward to fraud or willful defaulters. Normally, fraudulent or willful defaulters are not eligible for restructuring. However, if the existing promoters are replaced by the new ones and the company is completely separated from the old management, then only the bank may consider restructuring, and this is allowed without affecting any criminal proceeding against the old promoter or the management. Willful defaulter and non-cooperative borrowers. So, bank faces different kind of borrowers, different kind of defaulters, but there are two special categories that require strict action. So, willful defaulters and non-cooperative borrowers. Willful defaulters are borrowers who deliberately do not repay loans even though they have the capital to do so. Sometimes they divert funds for other purposes or even dispose of the secured assets without the bank's knowledge. And non-cooperative borrowers are the borrowers who refuses to share information with banks. They avoid meeting, they do not cooperate in the recovery process, and their behavior makes it difficult for the bank to resolve the problems. Now, provisioning for these willful defaulters are to be made. So, bank must maintain 5% provision for the standard accounts where the directors listed are willful defaulters. If it is a substandard asset, uh, and in case of secured loan for up to 6 months, the provisioning is 15%, and when it crosses 6 months, the provisioning increases from 15% to 25%. For unsecured loans, for unsecured loans, again, for if it is up to 6 months, 25%. If 6 to 12 months is there, then it goes on to 40%. You should not give any new facility to any willful defaulter if they are deliberately not cooperating. Then the bank can tag them as non-cooperative borrowers, giving notices, and this information is also reported to central repository on large credits. In any fresh loan to such borrowers, it will require higher provisioning by the banks. However, such new loans will still be treated as standard assets. Dissemination of income to ensure transparency and to prevent misuse of the banking system. Banks must submit details of willful defaulters where the loan amount exceeds 25 lakhs rupees to credit information companies within 1 month, and banks should report negligent auditors. So, if bank find that the company auditors have falsified accounts or failed in their uh, duty, they must file a complaint with ICAI. Such complaints are also forwarded to RBI, IBA, and Ministry of Corporate Affairs. If lawyers wrongfully certified a uh, property is clear legal title, or if valuer inflate the security values, then IBA circulate these names among banks and central registry, so, so that the future assignments avoid these uh, professionals. Banks loan for financing promoters contribution. So promoter contribution means the money that promoter, the person who start or run a company, invest in equity capital in their own company. As per RBI's rule, promoters should use their own fund for this contribution. Banks are not normally allowed to give loans to promoter for buying shares or other companies, but again, exceptions are there. So bank can lend money to specialized entities created only for the purpose of acquiring and reviving troubled companies. Such entities must follow RBI general guidelines. These entities should be financially strong and well capitalized, and their debt to equity ratio should not exceed 3 to 1. A specialized entity is a company, body, corporate, which is set up only for reviving these failing companies. And the promoter, it is promoted by individual institution or even government bodies. They are eligible to invest in same sector as stable companies they are acquiring. Credit risk management. So bank faces risk whenever they lend money. RBI has given detailed guidelines on how banks should manage the credit risk. Some important practices include independent credit appraisal, stress testing, scenario analysis. So, independent credit appraisal is that bank must do their own assessment of the borrower and the project. With respect to testing, scenario analysis, so especially for infrastructure project, bank should check how the project will perform if there are delays or cost overruns. You check promoter's equity source. So bank must verify where the promoter's equity money is coming from. Sometimes company use borrowed money from the parent company and show it as equity, which hides the true financial risk. So bank must ensure that the debt is not shown as equity in subsidiaries or special purpose vehicles. You have to verify the director. So each director has a unique uh, director identification number under the Companies Act, and bank must record this DIN and verify the director through independent sources. They should also check if any director are listed as defaulters or willful defaulters. Registration of transactions with CERSI. So CERSI is the central registry of securitization, asset reconstruction, and security interest. So central registry of securitization assets, reconstruction and security interest, in short CERSI. Any loan that involves security interest must be registered with SERC. If it's not registered, the bank cannot enforce its security right in case of defaults. Board oversight. So the board of directors of bank, they play a very important role in credit risk management. They should monitor asset quality. So the board must take proactive steps to stop the rise of bad loans and improve overall asset quality. They should use tools like central repository of information large credit. So bank must identify stress accounts at an early stage, and the board must ensure proper classification of such borrowers. Review of these classifications should be done regularly, for example, every 6 months. Unit number 29, important laws relating to recovery of dues. So, in this particular unit, we'll understand about Recovery of Debt and Bankruptcy Act. So, earlier it was Recovery of Debts due to Banks and Financial Institution Act, and in 2019, its name was changed to Recovery of Debts and Bankruptcy Act. Then we'll move forward to SARFAESI Act, IBC Act, Legal Service Authority Act, Law of Limitation. In the end, we'll do our practice questions and we'll wind up this session. So let's begin. Recovery, we all know that recovery of money is not always smooth for the banks. They need to explore legal avenues. They need to knock the doors of the court. And for this very purpose, going to a civil court is not always an easy task. And that's why there are certain enactments which Parliament provided for the easy recovery, and we'll discuss them one by one. So we'll start with Recovery of Debts and Bankruptcy Act. So recovery through civil courts was actually a major hurdle. Many assets, huge assets, were blocked as unproductive assets, and the process of recovery required a considerable time. And due to this, the Parliament passed an enactment which was known as Recovery of Debts due to Bank and Financial Institution Act. It was passed in 1993, and it enacted DRTs, Debt Recovery Tribunals. So the bank and the financial institution need not to go to the civil court for the recovery. They can approach debt recovery tribunals for speedy recovery, a faster recovery. And in 2019, the name of the act was changed to Recovery of Debts and Bankruptcy Act. So in this particular act was challenged by Delhi High Court Bar Association before the Honorable Delhi High Court. The Delhi High Court decided that this act is unconstitutional and it hit Article 14, and hence this act is void. An appeal was preferred to the Supreme Court. The Honorable Supreme Court held that this act is constitutionally valid. It gave the green light to Recovery of Debt and Bankruptcy Act. The question was referred to the Supreme Court regarding the applicability of this act to cooperative banks. So it was decided that debt recovery tribunals is not applicable to dues of cooperative banks since they have a recovery mechanism and it is working fine. It is working satisfactorily. However, it is applicable to multi-state cooperative banks. The extent of this act is whole of India, meaning to say this act is applicable to whole of India, including Jammu and Kashmir. And this act was made applicable from 24th of June 1993. Though DRTs are established progressively across the country. So through DRTs, this act is made applicable. Now, what is the qualifying amount? Meaning to say, how much amount is due before a bank can knock the doors of DRT? So, the qualifying amount is 20 lakh rupees or more. This amount can be in consortium or by the bank alone. Meaning to say, if Bank A gave 10 lakh rupees and Bank B gave another 11 lakh rupees, so this qualifying amount is there. So, sum up is 21 lakhs. And as consortium, the banks can approach the debt recovery tribunal. Now let's understand some important definitions. Bank. So what is a bank? Bank means a banking company, uh, and it includes corresponding bank, state bank, regional rural banks, multi-state cooperative banks. Debt, what is a debt? Debt means any liability which is due from any person by a bank or a financial institution, and this includes consortiums of banks and financial institutions as well, whether it is secured or whether it is unsecured, whether it is under a decree or a arbitration. So it is a debt. So as per this definition, debt means any liability which is inclusive of interest, any liability inclusive of interest, not only the principal amount but interest also, whether it is secured or unsecured, doesn't matter. Any liability towards the debt securities which are unpaid, whether in full or in part, after a notice of 90 days. Keep that in mind. After a notice of 90 days, any liability under a decree of the or order of any civil court or arbitration or otherwise, or any liability under a mortgage or a subsisting or legal recovery. Financial institution. Financial institution basically means a public institution and an ARC, Asset Reconstruction Company, which has obtained a certificate of registration under SARFAESI Act, Securitization and Reconstruction of Financial Asset and Enforcement of Security Interest Act, SARFAESI in short. It also includes a debenture trustee which is registered with the board and appointed for secured debt securities and any other institution which the central government has notified. So it is a financial institution. What constitutes a debt? It is quite important for us to understand what is a debt, and it has been interpreted by different courts in different case laws. So in GV Films versus UTI, so this particular case belongs to year 2000. So in this case, it was held by the Madras High Court that the payment made by a bank by mistake is a debt. So if a bank made a payment to someone by mistake, so this payment is a debt. Person has to repay it. In State Bank of India versus SS Engineering Corporation, it was held that money overdrawn from a bank account without any overdraft facility is a debt, and it can be recoverable under Debt Recovery Tribunal Act. United Bank of India versus DRT. It is DRT. Uh, in this particular case was before the Honorable Supreme Court. So it was held that if a bank has alleged in the suit that the amount were due from the respondent as a liability of the respondent, and if the liability has actually arisen during the course of business activity and the same is still there, the same is still subsisting, then it is sufficient to bring that amount under the definition of the debt, and it is recoverable under DRT. However, in case of Bank of India versus Vijay Ram Nikolal, it was held that if an employee commits a fraud or misappropriation of money, then this amount is not debt. So you cannot say that if an employee has committed fraud or misappropriation of money, so you cannot term this amount as debt. Establishment, jurisdiction, and authority of tribunal. When we say tribunal, we are meaning to say debt recovery tribunal. So there is DRT, Debt Recovery Tribunal, and there is DRAT, Debt Recovery Appellate Tribunal, and we understand one by one. So, what is DRT? DRT is constituted under this Recovery of Debt and Bankruptcy Act. This is the first place where the banks approach that we have to recover this certain amount of money from these borrowers. Please help us. So, this is the first place, and if they are aggrieved with the order of DRT, they have the option to appeal to some authority, and this authority is known as DRAT, Debt Recovery Appellate Tribunal. So who established DRT? It is the central government. This DRT is made up of only one person called presiding officer. So Remember this name, presiding officer. This tribunal, DRT, it is made only of this person. Now, what is the term of this office and who is qualified to become a presiding officer? So, a person is qualified for appointment as presiding officer if he is or has been, or even if he is qualified to be appointed as district judge. So, either he was a former district judge, he is a current district judge, or he is eligible to become a district judge, then he can be appointed as a presiding officer. The term is 5 years or until the age of 65 years, whichever is earlier. Meaning to say, if Mr. A is appointed as a presiding officer and he is of 62 years of age, then as soon as he attains the 65 years of age, he will vacate his office. So, whichever is earlier. So, if he is 58 years of age, then he will serve the office for a term of 5 years. Okay. Now, let's move on to DRAT. Now, again, the central government has the powers to establish the appellate tribunals known as debt recovery appellate tribunals, and the central government is responsible to specify the areas within which the appellate tribunal may exercise its jurisdiction. Again, like similar to DRT, DRAT is also constituted of only one person, and this person is known as chairperson. Now, the qualifications are quite different for becoming a chairperson because DRAT holds a higher position than DRT. For example, you can understand DRT as an equivalent of civil court and DRAT as an equivalent of high court. So, for becoming the chairperson of DRAT, the person is qualified for the appointment of chairperson if he has been, meaning to say, is a former high court judge, or he is a high court judge, or he is qualified to become a high court judge, or he has been a member of Indian legal service and has held the post in grade 1 of that service for at least 3 years, or he is uh, he has held the office of presiding officer of DRT for at least 3 years. The term of office is 5 years or until the age of 70 years. Why? Because former DRT presiding officers are also eligible to become the chairperson of DRAT. Jurisdiction and authority of tribunals. So, a tribunal, a DRT, has a jurisdiction and power and authority to entertain the applications from the bank and financial institution for recovery of debts. Also, they can entertain applications under Part 3 of the Insolvency and Bankruptcy Code. DRAT, on the other hand, they handles the appeal uh, from the orders against DRT and order against Part 3 of the IBC. Now, the chairperson of DRAT, they enjoy the general power of superintendence, the general power of control over the tribunals. So, they can basically transfer any application from any presiding officer within his jurisdiction, or they can direct the tribunal to furnish periodical information relating to pending case. They can convene meetings and they can submit recommendations to the central government for action against any presiding officer for misbehavior or incapacity. Bar of jurisdiction of civil courts. So basically, after the constitution of DRTs, debt recovery tribunals, no civil court has any jurisdiction or power or authority to deal with recovery cases. Now, recovery cases of what? Where the qualifying amount is 20 lakhs or more. So, no civil court has the authority to entertain any case with recovery of 20 lakhs and above pertaining to dues to bank and financial institution. Now, again, we have to keep this in mind that this is not applicable to High Courts or Supreme Court, which are exercising their jurisdiction under Article 226 or 227. All right. Now, let's move on to procedure of tribunal. So, let's understand the procedure of filing application with DRT, their disposal, recovery of dues. So, first of all, for initiating recovery process, the starting point is giving notice to the borrower that we are filing an application with DRT. Once the notice is provided, we file an application to Debt Recovery Tribunal. Of course, the provisions of Limitation Act they apply. Let's first understand what is a Limitation Act, what purpose does it serve. So, in order to bring a case, bring a suit, bring an appeal, bring an application before any court or the tribunal, there is a particular time limit. So you cannot sleep over your rights. So for example, if the limitation period is 3 years, so you cannot knock the doors of the tribunal or the court after 5 years or say after 4 years. So in 2010, if the cause of action has arise, so you have to file the case within these 3 years. Now, you cannot wake up from your sleep and approach the court in 2014 or 2015 that your lordship, we were not able to proceed with this application because we were not aware or something of that sort. So, the Limitation Act actually prevents the banks or the financial institutions to bring their cases to the court. I hope this is clear to you. Now, the qualifying amount should be there. So, the amount due should be 20 lakhs or the more. The content of the application should be complete. The details should be provided to the borrower. The details should be provided to the borrower, the guarantor, the credit facilities, the outstanding and the other claims should be there. So, the content and jurisdiction have to be kept in mind. The application should include the prayer, the remedies, the interim reliefs, and with now electronic facility is there, so application statements they can be filed electronically. The jurisdiction have to be kept in mind that the application can be filed with the tribunal with the DRT with which has the jurisdiction to entertain the application. You cannot randomly submit your application to any debt recovery tribunal. The debt recovery tribunal again has a jurisdiction, and this jurisdiction is how does it is determined. So the branch or any office of the bank, the financial institution is maintaining account in which debt claim is outstanding, or the defendant, or where there are more than one defendants, any defendant at the time of making the application, he or she actually resides or voluntarily resides or carry on the business or personal works for the gain within the jurisdiction of that tribunal, and the cause of action wholly or in part arises sorry arises within the jurisdiction of that debt recovery tribunal. Now, other banks can also join the application. So, where a bank or financial institution has filed the application before the tribunal, and if for the same person another bank has to recover any debt, then the later bank can join this filed application at any stage, but before the final orders have been passed. Application requirement. So every application before the tribunal shall be in the prescribed format, and it should be accompanied with the prescribed documents along with the fees and the evidence. Tribunal process. So once the application has been received, the tribunal issues the summons. Basically, it calls out the defendants uh, against whom the application has been filed with a direction that they are required to show cause, within 30 days as to why the relief rate uh, should not be granted. So basically, why should not we take action against you? Why should not we give the relief to the bank? And they direct the defendant to disclose the particulars of the property or the assets other than the properties or assets which are offered as securities to the debt. Meaning to say, we need to know what assets or properties you have apart from the secured assets. Okay, and they restrain the defendant from dealing or disposing such assets on the properties which are disclosed pending the hearing and the disposals. And the defendant must file a written statement. Written statement meaning say defendant has to file his or her reply within 30 days, including set of claims. So if they have any claims against the bank or the financial institution, they should disclose it in their written statement. So defendant has certain rights. So set of claims are there, and then there are counter claims. So the defendant has any claim legally recoverable from the applicant, meaning to say the bank and or the financial institution, and they wishes to set off the applicant's demand with the certain sum of money must be set off with uh, they must be set off with the claims of defendant. So it should be filed in the written statement, or if they have any counter claim against the applicant, who is the applicant, the bank or the financial institution. So if defendant has a counter claim, they can also set up a counter claim for any right or claim in respect of cause of action, and this also have to be disclosed in their written statement. Securities and attachments. So if the tribunal at any stage or on the application of the applicant or along with the sorry, along with the particulars of property to be attached an estimated value, and they satisfied that defendant has an intent to obstruct the uh, orders or delay the orders or frustrate the execution of the orders. Now, if that is the purpose, then the tribunal can ask for the recovery or the tribunal can attach the property. So basically, you cannot sell the property, and if defendant fails to show cause as why he should not furnish security or fails to furnish security, then the tribunal may pass attachment orders. For attachment of property, the tribunal can pass a conditional attachment order of the whole or the part of the property. And in case of disobedience or breach by the defendant, then the person can be detained in civil prison for a term not exceeding 3 months. So, civil imprisonment can be ordered by the debt recovery tribunal, and tribunal can appoint, if they find it just and convenient, they may appoint a receiver of any property. They can remove any person from the custody or the possession of the property. We can give the possession or the custody to the person who is appointed as receiver, and they can confer powers to the receiver in respect of the property given in his possession for bringing the suit or to defend the suit. And they can also appoint a commissioner for preparation of inventory of the properties of the defendant, basically, or for the sale purpose. Interim final payment orders. So the tribunal may, after giving the opportunity to the both sides, can pass an order um, to the applicant and the defendant. So the order can be interim, meaning to say it is a part order, or the final payment orders can be passed. Recovery certificate. The presiding officer shall issue a certificate of recovery along with the final order for payment of debt along with the interest under his signature. Any recovery certificate issued by this presiding officer, this is equivalent to a decree of court. And when the property under the certificate recovery is situated in jurisdiction of more than one tribunal. So the issuing tribunal will send copies to the tribunal having the jurisdiction, and if the receiving tribunal finds that it has no jurisdiction, it shall return the certificate back to the issuing tribunal. And as a the sale proceeds of such company, they will be distributed among the secured creditor, and the surplus is paid to the company if the defendant is the company. Affidavit as evidence, so DRT can consider that any fact may be proven by the affidavit, and once affidavit is submitted, it will allow cross examination of the witness only if the tribunal is of the opinion that it is necessary to do so, because they have to uh, proceed with the application in a speedy manner. So they have a time limit for disposal. So the time limit is 180 days. And what happens if a person or the company is aggrieved by the order of tribunal? So they have the right to approach DRAT. So they can file an appeal to appellate tribunal DRAT, but the appeal must be filed within 30 days from the order, and there are certain conditions that if a person or the company has to file an appeal, they have to deposit at least 50% of the amount due as per the order. This amount can be reduced to 25%, not less than that. So the tribunal, the appellate tribunal can reduce the amount to be deposited, but again, it should not be less than 25%. And after hearing both the parties, the appellate tribunal can pass the orders. They can modify the orders. They can set aside the orders, and the appellate tribunal shall dispose of this appeal. They will try their best to dispose of this appeal within 6 months of the receipt. So they shall attempt the appeal to be disposed of within 6 months from the date of receipt. Recovery process and modes. So there's a recovery procedure. So on the receipt of copy of recovery certificate, a recovery officer is appointed, and that recovery officer has to proceed to recover the specific amount by attaching or selling the properties of the defendant. The property can be movable or immovable. So any of the property can be attached and can be sold in order to recover the amount. We can take in possession of the property. We can arrest the defendant if he is obstructing with the procedure. Uh, we can send for the detention in prison, but again, the provision of arrest should be used in line with the decision. So George Verghese was the case. Let me write it down for you. George Verghese versus Bank of Cochin. So the guidelines issued by the Supreme Court in this particular case have to be kept in mind uh, arresting arresting or detaining the defendant in prison. Objection to recovery certificate. So the defendant is debarred from raising any dispute before the recovery officer, again for the about the correctness of the amount. So the recovery officer cannot entertain any objection. All right. RO, recovery officer, they will not entertain any request. They will not entertain any objection. So it is the presiding officer of the tribunal who issues the recovery certificate, and he is the person who is authorized to withdraw the certificate, to correct the certificate, to see if there is any arithmetic mistake. So it is the presiding officer of the tribunal who will receive the objections to the recovery certificate, and not the recovery officer. Say amendment of recovery certificate. So even though a certificate has been issued to the recovery officer, the presiding officer may grant time for the payment of the amount provided defendant pays a down payment of 25% at least of whatever is mentioned in the recovery certificate, and again they will give an unconditional undertaking to pay the balance within a reasonable time. Again, this reasonable time has to be acceptable to both the bank or the financial institution and the defendant. And if such time is granted, the recovery officer has to stay the proceeding until that time period is expired. Payment under recovery proceedings. So if after issue of recovery certificate, defendant makes any payment, then the presiding officer has to keep the recovery officer informed. As simple as that. Execution of recovery certificate. So while execution of recovery certificate, the recovery officer can require any person against whom the recovery certificate is issued to declare on affidavit about the particulars of his assets, like income tax area. So the recovery officer has the power to recover the amount in a similar fashion as laid down under the Income Tax Act. So these payments will be treated in a similar fashion as they are income tax areas. Then there are other modes of recovery, like from a debtor of defendant. Mean say if any amount is due from any person to the defendant. For example, if A is defendant and A has to recover money from B, then the recovery officer will ask B to pay the amount to the recovery officer and not to the defendant. However, this provision exemption of the amount from attachment as provided in CPC, it applies from a bank or financial institution. So when such notice is issued to a bank or any financial institution, it shall be not be necessary to produce any passbook for any purpose for payment. Provision of DRT has overriding effect for any such requirements. Property under notice. So when such notice is issued in relation to any property, when any claim made against such property is void. So if you make any claim against the property uh, for which the notice has been issued, then those claims will not be entertained, they will be void. But again, if third persons have vested rights in those property, they can raise their claims, and we'll discuss about it, don't worry. From holders of defendant's property. So these provisions also apply to any person who is holding any money for on or account of the defendant. So in case there is a joint holding, then the equal share of the joint holder is, they are presumed that it belongs to defendant. For example, A is defendant and A holds a joint property with B, and this property say is of 1 crore, then it will be presumed that A has a share of 50 lakhs in this property, and this amount can be recovered. Third person is not liable. So if any person receiving the notice from recovery officer is not liable to pay or is not holding anything on behalf of the defendant or for the defendant, then they can object to the such notice and they will not be liable. So if third person is innocent, uh, acting in good faith, then this third person will not be liable. From a court holding money, so if a court is holding money belonging to defendant, then the recovery officer may apply to the court that uh, the court will pay the money to the recovery officer. Payment by third person. So if a person pays to recovery officer as per the notice served, then he is discharged from the liability. Now here if B pays to a recovery officer, then B is discharged from his liability. So this third person If he or she makes the payment, then they will be discharged, and if they fail to pay, then the recovery officer may serve them with the notice, and they will be treated like the defendant. They will be deemed to be the defendant. Appeal against order of recovery officer. So when recovery officer attaches the property, sells the property, and it is possible that third party have any interest in such property, and that interest gets affected. So they can file an appeal to the DRT within 30 days. Uh, and thereafter, the DRT may allow the appeal and may set aside they can modify the order, they can set aside the order, or they can either confirm the order. Power of tribunal and appellate tribunal. So they have the power to lay down their own procedure. They are not bound by CPC, Civil Procedure Code. So they are not bound by it. They are guided by principles of natural justice. And hence they have their power to lay down their own procedure. How will they function? Powers of civil code. So the DRT and DRAT, for the purpose of discharging their function, they have the power similar to the power which are vested to a civil court. Transfer of pending appeals. Keep that in mind that limitation period also applies. So it applies to DRT and DRAT. Transfer of pending appeals. So if a specific appeal is there, there is a case, and application has been filed for the transfer. So the tribunal DRAT has the power to transfer that appeal from one tribunal to another tribunal. Chairperson, presiding officer, staff of appellate tribunal and tribunal. So they are deemed to be public servant for the purpose of IPC, now BNS. So they will be deemed to be public servant, whether chairperson, presiding officer, staff of appellate tribunal or tribunal, they all are deemed as public servant. Overriding effect of the act. So the provision of this act, they have overriding effect when there is inconsistency with any law, or if any instrument is there and there is any inconsistency, then this act will override, meaning to say it will surpass that other law, and this particular act will prevail. Uh, in Allahabad versus Canara Bank, viral filaments versus Inducent Bank. So, in all these cases, the Supreme Court held that this act supersedes, overrides the Companies Act. DRT Act, again, it is exclusive for debt recovery, and proceedings cannot be stayed or transferred to a company court. So the adjudication is exclusive. They have the jurisdiction of civil courts, and so sorry, the jurisdiction is exclusive, and the jurisdiction of civil courts and company courts, they are out. They are not applicable with respect to these recovery cases. So, DRT proceedings cannot be stayed by a company court, nor proceedings can be transferred to a company's court. All right. And when no winding up order has been passed against the company, the distribution of money realized under DRT uh, among banks, financial institutions, they are to be prioritized subject to the principle of CPC and principle of natural justice. When winding up of proceedings are pending in company court, then the distribution of money under DRT among banks and other secured creditors is there. But the employees whose dues are there with the company, they will also be treated as secured creditors, uh, and the distribution between those secured creditors and the workmen should be on the pari passu basis, on the equal basis. Doctrine of election. So basically, the banks and financial institution has the right uh, to either choose DRT or the SARFAESI Act. So banks and financial institution can withdraw their DRT application to pursue actions under SARFAESI Act. Now the question is whether we have to withdraw the application from DRT, then only we can proceed under SARFAESI Act. So question arises before the Honorable Supreme Court in Messrs. Travancore versus Union of India in 2006, and Supreme Court decided various points. So the Supreme Court observed that the election for election there should be three elements. Number one, there should be existence of two or more remedies. Number two, now the remedies have inconsistencies. So there is inconsistency between the remedies. And number third, you have choice of choosing any one of the remedies. So if any one of the element is not there, then the doctrine of election is not applicable. So there is no inconsistency between the remedies, then also the doctrine of election does not apply. Now, SARFAESI is enacted to enforce the interest in financial assets which belongs to the bank or the financial institutions, and the DRT is tribunal which is created by statute. It has no inherent power which exists in civil court. Uh, so the controversy whether the doctrine of election is there, so whether you have to withdraw the DRT application in order to proceed with SARFAESI Act. So it is not there because there is no inconsistency exists between DRT and SARFAESI remedies, and hence doctrine of election cannot be then the doctrine of election is not present at all. So these three remedies, sorry, these three elements should be present in order uh, to say that doctrine of election applies. Since there is no inconsistency between the remedies, uh, doctrine of election is not there, and hence withdrawal of DRT application is not a precondition for SARFAESI Act. Now let's move on to SARFAESI Act. Let's introduce it. SARFAESI Act. So this act was actually a landmark enactment for banks and financial institutions. So it introduced major changes in legal framework for the recovery. It streamlines the functions of reconstruction companies for dealing with financial assets of banks and the financial institutions. So this particular act empowers the banks and the financial institutions to enforce their securities uh, even without the intervention of the court, uh, either court or the DRT. So the power given by this act, it has an overriding effect on other laws in this aspect. The power are also over and above other remedies. So other remedies are available, and these powers are over and above these other remedies by filing appropriate proceedings either in the civil court or the DRT. Now let's understand the fundamental aspects of SARFAESI. So this particular act has brought a legal framework for securitization of financial assets, reconstruction of financial assets, power to enforce securities for recovery of dues to banks and the financial institutions, and the provisions for reservation, for provisions for registration of transaction of securitization, reconstruction, and creation of the security assets. The extent similar to DRT Act, it is applicable on whole of India. Now, the applicability of this act is up to the banks, to the financial institutions, ARCs, debenture trustees, and other notified companies by the central government. Uh, Securities interest. So, the provisions relating to the enforcement of security interest, it applies to cases in which security interests are created by for due repayment. So, this the act has presupposed that there is an obligation. So, number one, there must be an obligation, and it is presumed, it is presupposed that there is an obligation on the part of the borrower to repay the loan, and if they are unable to repay the loan, then the securities which are available to the banks or the financial institutions, they can sell the securities to recover their amount. There is a qualifying amount in order for the applicability of this act. There is a qualifying amount of 1 lakh rupees, and the amount due should be more than 20% of the principal amount and interest. And if these conditions are met, then SARFAESI Act is applicable, else the SARFAESI Act is not applicable. So, the qualifying amount we have just discussed it. There are certain exclusions to the act. So, this act is not applicable on agricultural land. It is not applicable on pledge which are created under uh, the pledge which are created on movable property. So, this particular act is not applicable on lien of any goods or money created under Indian Contract Act, pledge of movable property, creation of securities interest in any vessel. It is not applicable on vessel, on the aircraft. If the security if the security interest for repayment basically is not exceeding 1 lakh rupees, or 20% amount is not due, then this act is not applicable, and it is not applicable over agricultural lands as well. If any property is not liable for attachment or sale of CPC, then this act is not applicable on those securities as well. So, these are certain exclusions from the SARFAESI Act. So, SARFAESI Act particularly is not applicable in those scenarios. So, if there is a lien, there is a pledge, or created on vessel, aircraft, agricultural land, so on and so forth. Priority. So, as per the amendments of SARFAESI Act, secured creditors have a priority over the claims over uh, with, uh, when compared to unsecured creditors. So, secured creditors have the priority over and above all the claims, including any debt, revenue, tax, or cess which is due or payable to the government or local authority. The constitutional validity again was challenged, and it was held that this act is constitutionally valid in Mardia Chemicals versus Union of India. Only one provision was made unconstitutional. Uh, the provision was that the borrower can file an appeal to DRT only after depositing 75% of the amount claimed by the lender. So, the Supreme Court declared this unreasonable, arbitrary, and this was amended to 50%. Now, let's understand some important definitions. So, asset reconstruction is basically acquisition by any ARC, any asset reconstruction company, of the right or the interest of bank or the financial institution in a financial assistance for realization of such financial assistance. So, in simple words, it is nothing but takeover of the loans or advance. Asset reconstruction is nothing but takeover of the loans or advances from bank or financial institution, and the purpose is the recovery. Hypothecation is basically a charge. We have studied hypothecation if you remember. Hypothecation is nothing but a charge which is created on movable properties. It can be future, it can be existing, and it is created in favor of secured creditor. In hypothecation, there is no delivery of possession. Delivery of possession is a key feature of which charge. When we say of movable property, the possession is given in pledge and not in hypothecation. So hypothecation is a charge on movable property. Movable property can be existing or the future, and it is created by the borrower. In whose favor it is created in favor of secured creditor, and when it is created, there is no delivery of possession to the creditor, and it also includes floating charges. Obliger. Obliger means a person who is liable for the payment, to pay a financial asset or to discharge any obligation in respect of financial asset, whether existing, future, conditional or contingent. So it is a person who is liable to originator. So who is an originator? Originator is the owner of the financial asset which is acquired by ARC for the purpose of securitization or reconstruction. In simple words, originator is no one but the bank. So obliger is the borrower, and borrower is liable to the bank or the financial institution. So we have understood originator. Securitization. Securitization means acquisition of financial asset by ARC from any originator. Originator means the bank or the financial institution, whether by raising of funds by ARC from qualified buyers by issue of security receipts representing an undivided interest in such financial assets or otherwise. So basically, this is a process where non-liquidated financial assets are convertible into marketable securities. So it is a securitization is nothing but a process where non-liquidated financial assets, they are converted into marketable securities, that is security receipt, and these marketable securities are then issued to the investors. So the process is known as securitization. ARC, Asset Reconstruction Company. So a company should obtain a certificate from RBI in order to be called an ARC, an Asset Reconstruction Company. And ARC should maintain NOF, net owned funds, of 300 crores. Earlier it was 100 crores, but this limit was raised to 300 crores. So they can raise funds through issuance of security receipts. So they can raise money for their acquisition by issue of security receipt under schemes which are formulated by ARC themselves. And there are certain conditions for registration as ARC, that they should have not incurred any losses in last 3 years, last three preceding financial years. The directors have the experience. No director is convicted for any offense. They should make adequate arrangements for realization of financial assets which are required, and they shall be able to pay the periodic returns or redeem the respected due dates. The investments which are made by the qualified buyers, and they should comply with the norms of RBI. Acquisition of rights of interest in financial assets. So an ARC must have a board approved financial asset acquisition policy. The ARC can acquire the financial assets of any bank or financial institution in two ways. Number one, by issuing a debenture, a bond for the security, and number two, by entering into an agreement with the bank or the financial institution. So they can acquire by issuing the debentures or bonds, or they by entering into agreement with the banks or the financial institution. A securitization transaction, it involves two stages. And yes, these agreements are to be under this SARFAESI Act, they are exempt from the stamp duty. So if a question comes whether the agreements are liable for the duty, yes or no, so you will have to mark no. Now, securitization transaction, it involves two stages. Number one, the acquisition of financial assets which have the undivided interest, and second, the issue of the security receipt in favor of investors. And what is the purpose? The purpose is very simple, to raise the money from investors by issuing these securities. ARC becomes the lender. So if the bank or financial institution is the lender and the right has been acquired, so that financial asset has been acquired by ARC, then this ARC is deemed to be the lender. As simple as that. So if bank is the lender and this financial asset is acquired by ARC, then automatically this ARC becomes the lender. And if there is any liability or commitment to be discharged from the side of bank, those commitments or the liabilities, they will not be passed. Only the rights will be passed from banks to ARCs. No liability of ARC, no liability of the bank will be passed to ARCs. So if there are any pending cases, pending appeals or proceedings of whatever nature which are related to the asset, and it is pending by the bank or against the bank, it will not get discontinued. Okay, they will continue uh, even if the financial asset has been acquired by the ARC. There are certain key documents which are connected with securitization transaction. We need to understand them. Number one is offer document. So an ARC which intends to issue a security receipt, they shall make the prescribed disclosures. By and large, the full details and particulars about the financial asset should be given. The loan details of the bank should be given. Who is the trustee? All of these details are to be there in the offer document. Debentures. A debenture is issued to the bank or the financial institution for the payment of consideration for the acquisition of financial asset. So what ARC does? ARC acquires that asset. ARC uses securitization process. Uh, ARC will redeem the money. They will collect the money, and this money will be passed on to the banks and the financial institutions. And for this similar purpose, the debentures is to be issued to the banks and the financial institutions. And the rate of interest which is offered in the debentures, they cannot be less than 1.5% above the bank rate. So this interest cannot be less than this. Obviously, if they want to give more, they can give more interest rate to the debentures. And the period of re- redemption, it should be less than 6 years. It should not exceed 6 years. An agreement should be there, and security receipts, it should be in favor of the investors. So these are the key documents in securitization. Notice to obliger and discharge of obligation. So when the bank or financial institutions uh, decides that the asset is now been acquired by ARC, a notice has to be given of such acquisition to the borrower and the concerned registering authority. And giving this notice is optional and it is not compulsory under this act. So it is not essential to give the notice. Issue of security receipts and raising funds by ARC. So in ARC, an asset reconstruction company may, after acquisition of any financial asset, they can offer security receipts to the qualified buyers or such category of investors, including non-institutional investors. So this security receipts, they can be issued to qualified buyers or non institutional investors, but they cannot be issued to public. Individuals are barred from making any investment in ARC, and these security receipts will not be issued to the general public for subscription. Condition for the issue: so for ARC to raise the fund from qualified buyers, certain conditions are to be met, like separate scheme should be formulated for acquisition. Now, scheme wise and asset wise distinct account should be maintained. Realization of financial asset should be held separately, and in case there is no realization and repayment, uh, there is no realization repayment for the QBs, the qualified buyers, that in holding not less than 75% of the total value of the security receipt issued, they are entitled to call a meeting, uh, and they are entitled to pass a resolution. So there is no repayment. The qualified buyers holding greater than or equal to 75% of the security receipt, they can convene their meeting and pass a resolution which is binding on the asset reconstruction company. Separate trust. So when separate schemes are made and funds are raised, the provisions of SARFAC, they do not directly provide for setting up trust for each scheme. However, for legal effect, there should be a separate trust. Uh, in eventuality of liquidation of ARC, the money does not pass on to liquidators, and the beneficiaries get the money on priority, uh, and their distinctiveness. Registration exemptions. So registration of security receipt is required if it is creating, declaring, assigning, limiting, or extinguishing any right in an immovable property. So in that case, registration is mandatory, it is required. Until and unless it is not happening, no registration is required. But if any right is created, assigned, liquidated in immovable property, then the registration is required. There are certain other functions of asset reconstruction company, like they act as agent for the bank, they act as managers for the secured asset, they act as receivers if they are appointed by the courts or the tribunals. Resolution of dispute. So if there is any dispute between the bank or the financial institution, bank, financial institution and the ARC, uh, that dispute will be resolved by arbitration, as provided as per the provisions for Arbitration and Reconciliation Act of 1996. The provisions of mandatory arbitration and conciliation, they are not applicable to the dispute bar against the borrower, but where the dispute is between ARC and banks, financial institution or the qualified buyers, then they will be resolved via conciliation or arbitration. National Asset Reconstruction Company. So it has been set up with an initiative to clean up the stretched asset where the exposure is greater than 500 crores or above in the banking system. They offers adaptable acquisition structures comprising of a mix of cash and security receipts to the selling banks and the financial institutions. Uh, Mainly the focus is on aggregating stressed assets for effective resolution. So the acquisition process is administered by the financial asset acquisition policy, which are framed under the guidelines for ARC, and the stress is for effective resolution of these stressed assets. Measures of asset reconstruction. Now let's understand these measures. Cognizance of other laws. So the powers which are provided under SARFAC Act, they are subject to the provisions of other existing laws, meaning to say power to take various measures for asset reconstruction which are contained in SARFAC. They are provided without any prejudice to any other law. All right. Secondly, permissible measures for asset reconstruction company. So, number one is to change or take over the management. Management of whom? The business of the borrower, right? It is the business of the borrower. So, a borrower unit which has been classified as NPA, but it is still functioning. So, it can be treated differently by the banks because it is still in function. Now, this business might provide certain revenues to the bank, to the financial institution, and hence, if they find that the management was incompetent, they will take over the management, and this power can be exercised even when there is no default. Keep that in mind. So, if there's the management is found to be incompetent, then uh, the asset reconstruction uh, companies can take over the management, sale or lease of business. So, asset reconstruction companies are currently not permitted to resort this measure until RBI provides guidelines. So, you cannot sell or lease off the business. Rescheduling of debt payment. So, every asset construction company should have its policy, which is approved by the board of directors, laying down broad parameters for where the debt can be rescheduled or not. And in case there is a certain exposure of ARC to a borrower in respect of resolution plan, then the ARC should also sign inter-creditor agreement, in short ICA. Inter-creditor agreement should be signed. Uh, Enforcement of security interest. So, the consent of secured debtors holding not less than 60% of the amount outstanding to a borrower, it should be obtained for this purpose, for the enforcement of security interest. Settlement of dues. So, every ARC shall frame a policy laying down the broad parameters for settlement of debts due to the borrowers. Taking possession of secured assets. So, it should be done in accordance with the provision of SARFAESI Act. Conversion of debt to equity. So, every ARC shall have its policy laying down the parameters in uh, where the debt can be converted into equity, meaning to say the shares of the borrower company. Enforcement of security interest. So, under SARFAESI Act, secured creditor can enforce the security interest. Just a second. Yes. So, let's understand general condition first. So, under SARFAESI, secured creditors have this right to enforce the security interest created in their favor without the intervention of any court or the tribunal. And this power has an overriding effect with respect to Transfer of Property Act. Secondly, the borrower must be classified as non-performing assets. So, the secured creditor must provide a notice to the borrower who has been defaulted in making the payment and who is classified as non-performing asset, and this notice has to be provided within 60 days. Debenture trustee, they may also enforce the security. So, this is the notice that we were talking about. We'll understand it again. So, the notice has to be provided within 60 days to the borrower, stating that you should discharge your liabilities in full, and this notice should include the amount payable to uh, the financial institution, if there is any secured interest, its details, uh, when the default has occurred, what is the overdue period, what is the date which has been classified as non-performing assets. um, the documents should be provided, securities provided, and the executed document should be there, and the borrower The borrower cannot transfer property which has been mentioned in the notice. If he or she does it, then it will be a violation and that would be a punishable offense. The notice should also highlight the consequences. The consequences can be legal, and the penalty which can be imposed on the secured, uh, which can be imposed by the secured debtors on the borrowers. Now let's understand Mardia chemical case. So this was the case where the constitutional validity was also challenged. We have just read about it. So there are certain guidelines which were laid down by the Supreme Court in this particular case, that the secured creditor must apply his mind to the objection which are raised by the borrower in response to the notice. Secondly, an internal mechanism should be there to consider the reply of the borrower. There may be some meaningful consideration in the objection raised, and their rejection should not be a ritual exercise. They should follow the actions. The reason for overriding the objection must be communicated to the borrower within 15 days, and the borrower cannot seek any injunction or any stay during this process. Now let's understand creditors' right after default. So if the borrower has defaulted, what are the rights of the creditor? Uh, so if the borrower fails, creditor can take measure under SARFAESI Act to recover the dues without the intervention of the court. Borrower can stop transfer if dues and expenses are cleared before sale or transfer. So if the dues are cleared via sale, then the borrower can stop proceedings under SARFAESI Act. If the sale has been postponed, then the creditor office can bid on behalf of the creditor. So if there is a postponed sale, the creditors officer, they can bid on behalf of the creditor, and in case of there are multiple creditors, the action can be taken only by 60%, only by the creditors who are representing not less than 60% of the value. Appropriation of sale. So where does this sale proceeds gets appropriated? Firstly, it goes towards the any cost, charges or expenses which are incidental towards the preservation, protection of the security, any insurance premium, those can be recoverable from the borrower. Secondly, the dues of the secured creditors are settled. And thirdly, if there is any surplus left, then it will goes to the borrower himself or the person who is entitled to with respect to rights and claim. So the cost has been settled, the dues has been settled, and if there is any surplus, it will goes to the borrower himself. There are certain special situations. So in case the borrower is a company and it is under a winding up process, then the dues payable to the workmen, they will be equivalent. Pari passu means on the equal footing. They will be on the equal footing with the secured creditors. If sale does not recover full dues, then the creditor have the right to approach the civil court or the DRT in accordance with the qualifying amount. So if 20 lakhs or more, DRT. If 20 lakhs is not, the condition is not met, then to the civil courts. And the creditor may also sell any pledged goods, or they can proceed against the guarantors uh, independent of secured asset. So if there's a secured asset, it doesn't matter. They can sell the secured asset and they can also proceed against the guarantor. Safeguards and authority. So the enforcement should be proper. It should be fair, and the authorized officer must be of chief manager level of a public sector bank or equivalent. The borrower cannot transfer any secured asset without the creditor consent. If he or she does it, then it is a punishable offense where the imprisonment can be of 1 year or fine or both. A procedure of for possession and sale. If it is a movable property, then where the possession of secured asset is to be taken by the secured creditor, it should be done in the presence of two witnesses. And a Panchnama should be drawn in a prescribed format where the inventory of the property which is taken in the possession should be prepared and a copy is given to the borrower. Then the value is estimated, and at what price we will sell it, uh, it is there. So what is the estimate value or the reserve price, the price below which we will not sell? So it is a reverse reserve price. It is fixed. Assets should be preserved and they should be insured until the sale has happened, so that if there is any damage, no loss uh, is incurred. If it is perishable, if the movable property is perishable or it is costly to maintain, then we'll try to sell it immediately. Will not wait to get it perished. There are certain sale methods like quotation, tender, auction. So we'll resort to the best method. Uh, we can also include a combination of the methods. Then a notice is provided to the borrower. Uh, a notice of 30 days is provided. A certificate of sale is issued, which shall be a prima facie evidence of the title of the purchaser, and it should also be published in two leading newspapers. It should also be published in two leading newspapers, including the local vernacular language. So, notice in newspaper deemed to vacate office. Uh, so, the valuation of the property, it is the manner and effect of, sorry, takeover of management. So, a notice is provided. Okay, so we skipped one slide. Let's talk about first the procedure and possession of sale where it is immovable property. So, after movable property, if the security interest has been created in immovable property, then what should be the steps that we should follow? So, it serves as we serve a possession notice to the borrower. It should be affixed to the property and published in newspapers. We obtain the valuation and we fix the reserve price. In this case, also will provide a notice to the borrower. We can sell below the reserve price only if the borrower and the creditor consents, because it is the minimum price below which we will not sell. The purchaser obtained deposit 25% of the amount, and the balance should be paid within next 15 days. Maximum 3 months can be provided to the purchaser. On full payment, sale certificate is provided. Role of magistrate. So, for taking possession or control of the secured asset of or its sale or transfer, the secured creditor can take the help of Chief Metropolitan Magistrate, CMM for short, or DM, the district magistrate. For this purpose, a written request is submitted to the authorities, and on receiving such request, the CMM or the DM take the possession of the security and the documents thereafter. Now, let's talk about manner and effect of uh, management takeover. So, firstly, there should be a notice which is provided in newspaper. So, the notice is to be provided in two newspapers deemed to vacate office. So, on publication of such a notice, the director of the company um, are deemed that they have vacated their offices. Custody and control. So, all the property and effect of the business of the borrower, they are deemed to be in the custody of the appointed director or the administrator, and those appointed director and the administrators, they are uh, empowered to take any step, uh, necessary step into their custody or under their control. So, this is one and same. Effect of takeover in case of company. So, when the borrower is a company, The shareholders cannot lawfully appoint any person to be a director. This right is not provided to them no more. Resolution of shareholders can be effected only with the approval of the secured creditor, and no proceedings for the winding up or for the appointment of a receiver shall lie except with the consent. Post recovery. So, on realization of debt in full, the secured debtor shall restore the management of the business. Subsequent security interest. So, secured creditors and creditors holding order of attachment, they shall have priority over all subsequent security interests which have been created on the property or by any transfer of sale, lease, assignment, license, or any other instrument. No compensation will be provided to the directors whatsoever for the loss of office uh, or for any premature termination of any contract. The remuneration will not be provided. Right of borrowers and others, right to prefer application to DRT. So if the borrower is not happy with the decision of DRT, if any person including the borrower, uh, they are not happy with the decisions, then the borrower has the right to prefer an application to DRT. This has to be done within 45 days. If they are aggrieved with the decision of the DRT, then they can prefer an appeal to the appellate tribunal within 30 days, and they have to deposit the amount 50%, which can be reduced to 25%. The DRT also in this particular case is required to dispose of this application within 60 days with a maximum period of 4 months. Right of borrow for compensation cost. So if DRT or the appellate tribunal holds the possession of secured asset it is not in accordance with the provision, they can direct the secured creditors to return the asset to the borrower, and the borrower is entitled for compensation as well as the cost which is determined by the tribunal. Central registry. So the central government has set up a central registry for registration of securitization, reconstruction, and creation of security. So these are there are certain other acts as well for the registration, like Registration Act is there, Companies Act, Patent Act, Design Act, Motor Vehicle Act, etc. So the registration is in addition to the with these respective acts. So registration with the central registry, it is in addition to the respective registration which are done under the other acts like Registration Act, Companies Act, Patent Act, Design Act. So this is in addition to them. Modification of security interest should be registered with the central registry, and the central registry became operational on 31st of March 2011. So it functions under central government. And what is the central registry? It is CERSI, the Central Registry of Securitization and Asset Reconstruction and Security Interest of India. In short, CERSI. So it is the central registrar. Non-application of the provision we have already discussed in the exclusions. Let's understand the other aspects of SARFACI Act. So, good faith protection. The secured creditors and the officers, they are protected for their action which are taken in good faith. Offenses by the company. So, if company commits an offense, the company and every person who is at the time of the offense was committed was in charge, then he will be responsible to the company for the conduct of the business of the company, and they shall be guilty of the offense and liable, and they will be punished accordingly. No civil court jurisdiction is there. So the SARFACI has conferred jurisdiction to DRT or the appellate tribunal. Therefore, for any such matter where the empowerment and jurisdiction is to DRT or DRT, the jurisdiction of civil court is ousted, it is excluded. Overriding effect. So as we have seen that for particular uh, points, the SARFAC prevails over other conflicting laws, but uh, compliant acts, sorry, like Companies Act, SABE Act, it is in addition to these acts, but not, it does not override these acts. It is in addition to these compliant acts like Companies Act, SABE Act, Recovery of Debt and Bankruptcy Act, etc. Limitation period for taking action, you must take action within 3 years from the cause of action, from the date when the cause of action arises. If you approach the court after these 3 years, your application will not be entertained. Introduction to Insolvency and Bankruptcy Code. So now let's understand this major code. So Insolvency and Bankruptcy Code, this is a landmark enactment. Prior to this, there are multiple overlying laws that govern uh, various facets of the corporate processes, insolvency processes. They are not comprehensive at all. So the IBC uh, is of major relief when it comes to insolvency and bankruptcy process in India. So it has essentially three sets of provisions. So the matters relating to insolvency and liquidation of corporate debtors. Number one, where the default amount is 1 crore rupees. Number two, of individuals, partnerships, and firms where the default amount is not less than 1000 rupees. And then the matters which are related to the Insolvency and Bankruptcy Board of India. So to whom the IBC applies? It applies, it covers the insolvency, liquidation, voluntary liquidation, bankruptcy of companies, LLPs, incorporated bodies, guarantors, partnership firms, individuals, personal guarantors to corporate debtors as well. So all of this is covered under IBC. Now let's understand four key terms: insolvency, bankruptcy, financial creditor, and operational debt. So these are basically operational creditor. So let's first understand insolvency. Insolvency is when a person or an organization is not able to meet its outstanding debt towards its lender. So it can be resolved by restructuring the debt or by writing it off, or if it is unresolved, it stays unresolved, then the assets can be sold to pay off the outstanding debt. Now, what people does it? They match the insolvency with bankruptcy. So they consider it as one and the same thing, but it is different. Bankruptcy is when a person voluntarily declares himself as insolvent. So bankruptcy is rather amicable than insolvency. When a person declares himself insolvent before the court of law, the court is responsible to liquidate the personal property. So in bankruptcy, it is the court that liquidates the personal assets of the person. So it provides a fresh lease of life to the insolvent. Financial creditors are the person who, or the organization who has given you a loan, a debt. Basically, there's a financial contract. So there's an exchange of money. In operational debt, the claim is in respect to the provision of goods or services. So a workman, if the salary of a workman is not given, it is an operational debt. And if the money of a creditor is not given, then it is a financial debt. It is financial creditors. Let's understand certain key definitions. A charge is an interest or lien which is created on the property of or asset of any person or any of its undertaking, as the case may be. It also includes mortgage, corporate debtors. Corporate debtor means a corporate person Who owes any money? So who's a corporate person? A corporate person is a company which is defined under the Companies Act, LLP, which is defined under LLP Act, or any other person incorporated um, for that time being enforced. So it is a corporate person. Security interest. A security interest means any right, a title, interest, or a claim to the property which is created in favor of a secured creditor by transaction or by creating any charge. The charges which we have already discussed in our unit number 26, mortgage, hypothecation, assignment, pledge. So different types of charges can be used in order to create a security interest. Pillars of IBC. So there are four pillars, rather five pillars actually. So there are mainly five pillars: Insolvency and Bankruptcy Board of India, Insolvency Professional Agencies, Insolvency Professionals, Information Utilities, and Adjudicating Authorities. So these are the five key pillars of Insolvency and Bankruptcy Code. So let's understand one by one. Insolvency and Bankruptcy Board of India. So it was established on 1st October 2016, and it has regulatory oversight over insolvency professional agencies, and information utilities. So the Insolvency and Bankruptcy Board of India is responsible to write and enforce rules with regard to the processes, mainly corporate insolvency resolution, corporate liquidation, individual insolvency resolution, individual bankruptcy under IBC. So it writes and enforces these processes. The board composed of a chairperson, three members ex officio. They should not be below the rank of joint secretary from Ministry of Finance, Ministry of Corporate Affairs, and Ministry of Law. So one from Ministry of Finance, one from Ministry of Corporate Affairs, one from Ministry of Law. In total, three. One member should be nominated by RBI, and five other members, at least three, should be whole-time directors, which are nominated by the central government. The term of chairperson and the members, other than these official members, it is that of 5 years or 65 years of age. Now let's discuss about insolvency professional agencies. So before that, let's quickly understand the powers and functions of Insolvency and Bankruptcy Board of India as well. So the board shall register insolvency professional agencies, insolvency professionals, information utilities, and it renew and withdraw, suspend, cancel their registrations. Secondly, they can carry out the inspection investigation against insolvency professional agencies, insolvency professionals, information utilities. They can specify the standard of functioning, they can issue necessary guidelines, they can make regulation and guidelines on the matter related to insolvency and bankruptcy. Now let's understand insolvency professional agencies. So a person carrying on the business as insolvency professional agencies, they should enroll insolvency professionals as its members, and they provide a certificate of registration which is issued by the board. So these agencies basically regulate the activities of insolvency professionals. So they grant membership to the persons. They lay down the standard of professional which is conducted by insolvency professionals. They safeguard the rights, privileges, and interest of insolvency professionals, and they can suspend and cancel the membership of insolvency professionals. So insolvency professionals are the persons who assist in completion of insolvency resolution, liquidation, and bankruptcy proceedings, and they are governed by insolvency professional agencies. So basically, in any insolvency resolution, liquidation, bankruptcy, the insolvency professionals, they can take actions like individual IRP, insolvency resolution process, or corporate IRP, or a fresh start of order, or individual bankruptcy process, or liquidation of corporate data firms. So these actions can be taken by insolvency professionals. Information utilities. So information utilities, they collect, collate, and authenticate the financial data, and finally disseminate the financial data. So they maintain electronic database on lenders and the terms of lending, so the delays can be eliminated, and the disputes uh, when a default arises can take place. So person to carry on a business of information utilities, they shall obtain registration from whom? From the IBBI, the Insolvency Bankruptcy Board of India. So they provide the information utilities. They provide specified services, including core service to any person. If such person complies with the terms and conditions. So any person who intends to submit financial information to information utilities or access the information, they shall they have to pay a specified fees, and they submit the information. Adjudicating authorities. So adjudicating authority is different for different entities. For corporate person, the adjudicating authority is National Company Law Tribunal, and appellate authority is National Company Law Appellate Tribunal. For individual firms, it is DRT and DRAT. And for any appeals, appeals should be filed within 30 days before the appellate authority, and appeals to the Supreme Court can be filed if the question is on the question of law and not question of fact, and it should be filed within 45 days. The ground for appeal can be that the approved resolution plan is in contravention of the law, there is any material irregularity, the debts owed to operational creditors have not been provided, the resolution plan does not comply with the criteria which has been specified by the Insolvency and Bankruptcy Board of India. Now, civil courts don't have the jurisdiction uh, here as well. Uh, the jurisdiction exclusively lies to NCLT or DRT, as the case may be, and where an application is not disposed of within the period which has been specified in the Insolvency Bankruptcy Code, then every reason has to be provided why there's a delay in disposing of the cases. Insolvency and Bankruptcy Fund. So this fund has been formed for the purpose of insolvency resolution, liquidation, and bankruptcy of the persons under IBC. The source of fund is mainly the grant by the central government, amount deposited by the persons as contribution, amount received from other sources as fund, and the interest or other income which arises out of the investment. So a person who has contributed, uh, they can actually withdraw the money from this fund, but it should not be more than what he or she has contributed or the organization has contributed, and the withdrawals can be for the payment to the workmen, for the protection of assets, uh, and for bearing the cost of the proceedings. Insolvency resolution process for companies and LLPs. So if the default is above 1 crore, the creditor may initiate insolvency resolution process. There are two stages which have been prescribed. One is insolvency resolution process and other is liquidation. In insolvency resolution process, the financial creditor assess whether the debtor business it is viable and whether they should continue the business, whether they should rescue the business or and restructure the business so that they can get their money back. And the second is liquidation. So if the insolvency resolution process, if this fails, then the if the insolvency resolution process fails, or the financial creditor decides to wind up and distribute the assets to the debtor, then the then liquidation comes to place. Corporate insolvency resolution process, CIRP, if in short, it can be initiated by the financial creditors, by the operation creditors, or by the corporate debtors as well. So, who can initiate CIRP? This will be asked by you in your exam. So, it can be initiated by financial creditor, operation creditor, or the corporate debtor itself when a default is committed by the corporate debtor. So, it should be completed within 180 days. A CIRP shall be completed within 180 days from the date of admission of the application. And the adjudicating authority may provide an extension of 90 days. A one-time extension it is there of 90 days uh, from the and the duration of CIRP, including the time for the legal proceeding, it shall not exceed 330 days from the insolvency commencement date. The committee of creditors should be appointed. They should appoint a resolution professional. So the committee of creditors is required to appoint a resolution professional, and it should be appointed within 7 days. The resolution professional prepares a information memorandum to resolution applicant. It submits the resolution plan to COC. The formulated resolution plan is submitted to COC for its examination, for its approval. Once it is approved, it is examined by adjudicating authority. So once it is approved, it is submitted to adjudicating authority and it is examined by the adjudicating authority. If it is in compliance, then the adjudicating authority issues the approval letter, and the RA should obtain necessary legal approvals, and it has to be done within 1 year of plan approval. Insolvency resolution process for companies and limited liability entities. Again, let's understand now the liquidation procedure. So let's talk about the liquidation process now. The adjudicating authority can order for liquidation of a corporate debtor if the resolution plan is not received, if the resolution plan is received but has been rejected for non-compliance, if the resolution professional informs about the decision of the committee of creditors to liquidate, or if the corporate debtor has contravened the resolution plan. In that particular scenarios, the adjudicating authority can order for the liquidation, and the adjudicating authority issues an order for liquidation, makes a public announcement and send the order to the authority with which the corporate debtor is registered. On passing an order for liquidation, the resolution professional, on submission of a written consent of the adjudicating authority, uh, they act as the liquidator. So the RP is now the liquidator, obviously after the consent of adjudicating authority. So let's understand the liquidation procedure. So the liquidator forms an estate of the asset. So basically the list of the asset of the corporate debtor from which we can extract our money. So it is known as the liquidation estate, and it is hold in fiduciary capacity. After listing all the assets, the liquidator collects the claim of creditors, and this exercise is done within 30 days from the date of commencement of the liquidation process. The liquidator then apply to the adjudicating authority for any avoidance of any kind of preferential transactions. So they apply to the adjudicating authority. For companies, it is NCLT. Then the liquidator apply for the avoidance of undervalued transaction. So then there is an avoidance of undervalued transaction, and if the adjudicating authority is satisfied that the undervalued transaction were deliberately entered into by the corporate debtor for defrauding the creditors, then it may restore the position as it existed before. So if defrauding is the motive, then the restoration is possible by the adjudicating authority. And if a corporate debtor is a party to the externate credit transaction, then the receipt of financial or operational debt during the period within 2 years has to be submitted, and the resolution professional may apply for the avoidance. The secured creditors can either relinquish the security interest or they realize it in the specified manner. Then there is a distribution of the assets. The proceed from the sales of liquidation, they shall be distributed in a specified manner in order of priority. And the dissolution is now complete. The liquidator, after all assets of the corporate debtor are fully liquidated, they will apply to the adjudicating authority for the dissolution. The corporate debtor is dissolved now on the order of adjudicating authority, and the copy of the order is provided within the next 7 days. Fast track insolvency resolution professional. This is in respect of corporate debtor. If in case there is an application for the fast track insolvency resolution professionals profession, if there is a So IBC has provided a fast track insolvency resolution process in respect of corporate debtor. This is basically in case the application is provided for fast track corporate insolvency process, and this can be in respect of a corporate debtor who is below a level which is notified, or he belongs to a notified class. The time limit is to complete the FIRP is 90 days, and extension of 45 days can be provided. This is the extension period, not more than that. So a creditor or the corporate debtor can file for application for fast track insolvency process, and the process of CIRP is the same for FIRP as well. Pre-packaged insolvency resolution process, it is mainly for micro, small and medium enterprises. The corporate debtor shall obtain an approval from its financial creditors representing not less than 66% of the value. The resolution plan has to be submitted within 90 days, and this process must be completed within 120 days from the date of commencement. A declaration is provided, so the adjudicating authority declares the moratorium, appoints a resolution professional, makes a public announcement, and the moratorium duration is again provided on the order. The corporate debtor then the list of claims is provided, preliminary information of memorandum is provided. The corporate debtor within 2 days of commencement submits the RP about the list of claims, about the preliminary information memorandum. The management shall continue with the board of directors or the partners. Within the next 7 days of commencement, the RP shall constitute a committee of creditors, and this committee of creditors may resolve to initiate CIRP. After this pre-packaged insolvency resolution plan commences, but before resolution approval. Voluntary liquidation of corporate persons. So a corporate person may initiate voluntary liquidation proceeding that should meet again certain conditions, certain procedures, procedural requirements are there. So the provisions related to the liquidation process shall apply to the voluntary liquidation proceedings. If any person initiates pre-packaged insolvency resolution process uh, or with the intent to defraud any person, then they will be penalized. The penalty shall not be less than 1 lakh rupees, but it may extend to 1 crore of rupees. Insolvency resolution and bankruptcy for individuals and partnership firms. So it applies where the amount is more than 1000 rupees. The amount should not be less than 1000 rupees. And our resolution professional is appointed by the adjudicating authority upon receiving the application. So, who is the adjudicating authority in this case? DRT is the adjudicating authority. The moratorium uh, on all dates begin upon admission, and it lasts until 180 days. So 180 days period is provided. Then the creditors, if they have any objection, it can be raised within 10 days regarding any inclusion of debt, or if any details are missing. Within 10 days, uh, they can raise an objection. Insolvency resolution process. So an application is initiated. This application can be initiated by the debtor or by the creditor. There is an interim moratorium which is provided on filing the application. The insolvency resolution process provides an interim moratorium in relation to all debts, and it ceases on the date of admission of such application. The appointment of RP is done by the AA, meaning to say the adjudicating authority. The RP, resolution professional, within 10 days of his appointment submits a report recommending the approval or the rejection. Moratorium, it commences upon admission for 180 days. Public notice is provided, uh, inviting claims within 7 days, and the claims must be submitted within 21 days. The claim registration is there, so the creditors register the claims with the resolution professional. Repayment plan. So, with the help of the resolution professional, the debtor shall prepare a repayment plan containing the proposal to the creditors for restructuring his debts or his affairs. There is a meeting of creditors for repayment plan. Uh, Order of adjudicating authority is provided. The AA approves or rejects the repayment plan on the basis of the report of the meetings of the creditor, which is submitted by the RP. Then there's an implementation and supervision of the repayment plan. And finally, on basis of repayment plan, the resolution professional shall apply to the adjudicated authority for discharge orders in relation to the debt which is mentioned in the repayment plan, and the adjudicating authority passes such discharge orders. Bankruptcy order for individuals and partnership firms. So, an application for bankruptcy of a debtor may be made by a creditor, which is individually or jointly with other creditors, or by a debtor to the adjudicating authority, and this must be done within 3 months of the order which is passed by the A. When the application is filed, an interim moratorium period commences, and the adjudicating authority appoints the bankruptcy trustee or nominated, which is confirmed or nominated by the board. The AA passes the bankruptcy order. He passes it within 14 days of receiving the confirmation or nomination of the bankruptcy trustee boards. Administration and uh, distribution of estate of the bankrupt. So, the bankrupt's affair are basically first investigated. What are the affairs of the bankrupt? How things are going on? Then the estate list is realized. It must be assisted by the trustee, and they follows the prescribed duties. The bankruptcy trustee then, while discharging his function, sells any part of the estate, but the receipt must be provided. It must be given to prove any claim and to arrive at dividend in respect of such dues. The bankruptcy trustee may, with the approval of COC, they can carry on the business of the bankrupt as well. A specific uh, the specified debts are paid first. Basically, in priority, they are paid, and the surplus applies to the interest and partnership debts proportionately. If there is any appeal, it can be filed to uh, DRAT within 30 days. So, from DRT, the appeals can be filed to DRAT, and from DRAT, the appeals can be filed to the Supreme Court within 45 days. So, from DRAT order, it goes to Supreme Court within 45 days. And if a debtor or creditor provides information which is materially false to the RP, then this is a punishable offence. And the fine can goes up to 5 lakh rupees, or imprisonment, or both. So, imprisonment can be of 1 year, fine can be up to 5 lakhs, or both can be awarded. Let's understand Legal Service Authorities Act. This act was mainly constituted to provide legal services at free of cost to the weaker section of the society, to provide the competent legal services, free legal services to the weaker section of the society, to ensure that there is an opportunity for securing justice. It is not denied only because they are economically weak, or for other disabilities. And this Legal Service Authority Act, under this Legal Service Authorities Act, lok adalats are organized. So they are organized by state authorities, district authorities, Supreme Court legal service committees, High Court legal service committees, Taluk legal service committees. So these lok adalats are organized by these different um, committees. A lok adalat can compromise or can settle between the parties to a dispute, but again these disputes are this should be of non-compoundable, they should be of compoundable offenses. They cannot handle non-compoundable offenses. Non-compoundable offenses are one which cannot be collated together, like murder, like robbery, dacoity. They are non-compoundable offenses, right? Petty theft, it is a compoundable offense. So if the offenses are non-compoundable, they cannot be entertained by the lok adalats. There is a monetary ceiling with respect to civil disputes that can be settled. So up to 20 lakh rupees civil disputes can be settled by the lok adalats. Keep that in mind. This figure is important for you. The award which is provided by the lok adalats, it is deemed as a civil court decree. Any court fees, if provided, and then the matter has been referred to the lok adalat, if the matter has been settled, then the court fees is refunded. And if the parties are the parties have approached to the lok adalats, and an award has been uh, provided, then that award will be binding and non-appealable, because it is provided by an amicable settlement between the parties. It is provided by the consensus of the parties, and that's why this award will be non-appealable in any court of law. Law of limitation, the last law of the class. So the Limitation Act has a significant application with respect to suits, appeals, applications, and all legal actions can be taken within this provided period. So the period of limitation is always in relation to a document which entitles the beneficiary to take an action in the court of law. It means the period prescribed for any suit or appeal or application by the schedule which has been provided under law of limitation itself. The prescribed period means the period of limitation computed in accordance with the provision of the Limitation Act of 1963. So a suit must be instituted, uh, the appeal should be preferred, and the application should be made within this prescribed period only. If not, then the suit, the appeal, the application will not be entertained in the court of law. There are certain things which we have to keep in mind, that the suit should be instituted in, in the proper court, to the proper officer, and when the court is closed, then the application can be instituted when the court reopens. So that particular day when the court is closed, it can be excluded from the computation of the period of limitation. Any application or appeal other than execution petition may be admitted after the prescribed period if the applicant can show cause that there's a reasonable excuse for not submitting the application within time. For example, he has met with an accident, he was hospitalized, and that's why he cannot uh, bring his application to the court. And in that scenarios, the court can excuse the delay. There are certain exclusions which which are not considered while computing the period of limitation. So it excludes the day from which the period is reckoned, the first day. It excludes the day of judgment, the time which is required to obtain the copy. Uh, if there is any injunction provided, so during the stage of injunction, it excludes the time for obtaining government consent, government sanction, and if the defendant is absent from India or central government territories, then that particular time period is also excluded from the computation. The fresh period of limitation arises if when the period of limitation is subsisting, any payment has been made, or the acknowledgement of debt is made in writing, which is signed before the period of before the prescribed period. Then in that case, a fresh period of limitation is there. So this is the schedule. So there's a description of suit, the period of limitation, and the time from which this period begins. You only have to just read it once. No need to thoroughly memorize it. So when you see, you will see a general pattern that most of these cases, the description, the period of limitation is 3 years. For immovable property, always remember that the period of limitation will be more. So it is 12 years, 30 years, 12 years. For foreclosure, it is 30 years. For possession of immovable property, it is 12 years. To enforce payment of money secured by mortgage, it is 12 years. Again, you will see this pattern: any suit by or on behalf of the central government or state government, 3 years. Where there is no limitation period, it is 30 years. For execution of decree, it is 12 years. For recovery of loss by fraud, 3 years again. Appeal, for appeal, period of limitation is less. Uh, Always it is less. So for filing appeal to high court, it is 90 days, and to any lower court, it is 30 days. Unit number 30, contract of indemnity. So in this particular unit, we'll understand what is a contract of indemnity, how is it different from contract of guarantee, what are the rights of an indemnity holder, what is an implied indemnity, is section 124 of the Indian Contract Act exhaustive or not, how is it applied with respect to bank. We'll check your progress and we'll do some practice questions. So without further ado, let's start today's class. So, what is indemnity? This particular word, indemnity, means to protect someone from loss or to save someone from harm or damage. In law, a contract of indemnity is an agreement where one person promises to compensate the other for the loss. And this loss may be caused by the person making the promise or by someone else. So, it is a contingent contract, which means the promise is only carried out if a certain event happens or does not happen. Until the event occurs, there is no obligation to pay. For example, suppose I say to you that if a particular person X sues you for a particular amount, say 20,000 rupees, I'll pay you for any loss you suffer. Now, here, the person who is giving the promise is known as indemnifier. The person who's getting protected is known as indemnified or indemnity holder. And if that particular person X sues you and you suffer a loss, I compensate you. Now, which section of Indian Contract Act defines the contract of indemnity? It is section 124. Section 124 states that a contract by which one party promises to save the other from loss caused by the conduct of the promiser himself or by the conduct of any other person is called a contract of indemnity. Now, who is the promiser? In that particular example, I am the promiser. I am promising you to save from the loss. So, I am the promiser and you are the promisee, the indemnity holder. Now, this definition covers only one type of indemnity where the loss is caused by a person's conduct. But courts have expanded this meaning through judgments, applying fairness and common law principles. There's a particular case law, Secretary of State versus Bank of India. Let's dwell into it. So here, Mrs. G owned government promissory notes and she gave it to her broker, Mr. A. Mr. A forged her signature and sold it to a bank. The bank, thinking everything was fine, got the note transferred in its name by the Government Public Debt Office. Later, Mrs. G found out and sued the government. She won the case and got the compensation. Now, the government in turn sued the bank to recover the loss. And the court held that the bank must indemnify, meaning to say compensate the government, even though the bank never directly promised to do so, because common law imposes such liability when someone's act causes loss to another. Now, insurance contracts are example of indemnity contracts. So, most insurance contracts are indemnity contracts. For example, a shopkeeper buys fire insurance for his warehouse, and if the warehouse catches fire, naturally the insurance company will pay the shopkeeper for his loss according to the policy and terms, of course, but only if the event actually happens. If fire happens, then only the insurance company will pay. And secondly, for the insurance, the shopkeeper has to pay the premium. And if both of these conditions are met, then only the insurance company will indemnify the shopkeeper for his actual loss. Now, how is it different from a contract of guarantee? We'll discuss contract of guarantee in our next unit, unit number 31. And in unit number 33, we'll understand a type of guarantee, deferred payment guarantee. But it is important for us to know how these two contracts are different, because in contract of guarantee, a person also guarantees to save another person from the loss. But here, the number of parties in a contract of indemnity are two: indemnifier and indemnified. So it is you and me. You are the indemnified and I am the indemnifier. I'll promise to save you from the loss. In guarantee, there are three parties: debtor, creditor, and surety. Now, let's take an example. For example, a person A approaches the bank for loan. Now, in this particular case, bank asks A if someone else gives a guarantee on your behalf. So A approaches you. You, my dear friend, can you guarantee that I'll pay my bank loan? You know Mr. A, he pays money on time. He has a good financial record. So you guarantees that if A defaults, I'll pay. So if A does not pay, bank will catch you. Bank will ask you to pay. Now in this particular case, bank is the creditor, Mr. A is the debtor, and you are the surety. You are saying that I am giving the guarantee, so you are the surety. So here three parties are involved. With respect to risk in indemnity, there is a contingent risk that it will arise only if the event happens or event does not happens. But in guarantee, the risk is subsisting, liability is continuous. Nature of liability in indemnifier's liability starts as soon as the loss occurs. In contract of guarantee, surety's liability is secondary and debtor is the primary liable for paying the loan amount. With respect to contracts, number of contracts, there is only one contract between indemnifier and indemnified, and in a contract of guarantee, there are three contracts. One with respect to debtor creditor, second creditor and surety, and third surety and debtor. So, if you pay on Mr. A's behalf, Mr. A automatically becomes liable to pay you the money. Now, the purpose for contract of indemnity is to reimburse actual loss, and in contract of guarantee, it is to assure creditor about repayment or security. With respect to form, a contract of indemnity can be express, meaning to say the words are written or spoken, or implied, meaning to say based on conduct. Whereas in guarantee, it is generally express. With respect to coverage, in contract of indemnity, only actual loss caused by the specified event is covered, but in contract of guarantee, it may cover the full debt or obligation of the defaulter, the debtor. Now, there are two forms of indemnity. Before proceeding to rights of an indemnity holder, let's understand these two forms: express indemnity and implied indemnity. So, express indemnity is a written contract where a person promises another person. So, if your goods are damaged during transport, I'll pay for the loss. So this is an example of express indemnity. And implied indemnity, so the case law which we have just discussed here. Secretary of State versus Bank of India. So this is an example of implied indemnity. Let's now move on to the rights of indemnity holder. So, according to Section 125, if the indemnity holder is sued because of a matter is covered in the indemnity and he is acting within his rights, so he can claim from the indemnifier the damages paid in the suit. So, if the indemnity holder has to pay money as damages in a court case, he can recover the entire amount from the indemnifier. Then he can also recover the cost of the suit. So, indemnity holder can also recover the legal cost of defending the suit, such as lawyer fees, court fees, and related expenses, but only if he did not go against the indemnifier's instruction. He acted wisely as a reasonable person would, and the indemnifier had authorized him to bring or defend the suit. And thirdly, amount paid in a compromise in a settlement can be recovered. So, if the indemnity holder settles the case outside the court, he compromised by paying money. So he can claim this amount from the indemnifier if the settlement was not against the indemnifier's order, if it was reasonable to settle even without an indemnity, and the indemnifier authorized the settlement. Specific performance. So there is a right to specific performance if the indemnity holder has already incurred an absolute liability, a confirmed obligation to pay, and the indemnity covers it. He can go to the court to force the indemnifier to honor the promise. Uh, but again, there are some conditions. There are some two factors to claim these rights. Number one, the indemnity holder must act within his scope of authority, and he must not break any specific instruction to the indemnifier. Uh, the factors which affect the claim are the damages, the cost, and settlement amount. So, with respect to damages, the court differ on when the indemnifier's liability starts. Some say it starts only after the indemnity holder has actually paid. Others says it can start earlier when the loss becomes certain. So, the preferred view is that it starts when the actual loss is when the loss is actually suffered. Secondly, the cost. Only reasonable cost can be claimed, like legal fees, travel expenses for the case. And with respect to settlement amount, settlements must be genuine without fraud or collusion and not against the indemnifier's instruction. Implied indemnity. So even if there is no written contract, sometimes the law implies one for from the circumstances. If a person does something at someone else's request and it turns out to harm a third party, even though the doer did not know it was harmful, the person who made the request must indemnify. So that particular case is an example of implied indemnity. Enforceability of a contract of indemnity. So the indemnifier's liability starts as soon as the loss of the indemnity holders becomes certain or imminent, even if he has not paid anything. So if a bank knows that a court has already ordered payment against its customer, the indemnifier's liability can start even before the bank actually pays, because the loss is definite. It is uh, imminent. Now, scope and application of indemnity contract to banks. What is the use of indemnity in banks? In banking, indemnities are very common. So, some of the examples include lost demand draft or traveler's check. So, customer must give an indemnity before getting a duplicate. So, the bank is protected if someone later presents the original. If bank issues duplicate fixed deposit receipt, so customer signs an indemnity bond. So, the bank can recover the money if the original is misused. And in death claim settlements, before paying legal heirs, banks may take an indemnity to protect against later claims from other heirs. Banks may also ask for extra surety if the amount is big, or if they don't know the customer well. And indemnity bonds are usually stamped as agreement, but if witnessed, they may be treated as bonds and attracts higher stamp duty. So this is it for today's class. I hope everything is clear to you. But again, if there are any doubts, please don't hesitate to ask them on our Telegram group channel, JIB Prep. We'll meet again with unit number 31, contract of guarantee. Till then, please take care.